Good morning, everyone, and welcome to all of you watching online and on Fios One News. I'm Alexis Christoforous.
And I'm Brian Sazi, and this is the first trade for Monday, October 28th.
Beating the street, AT&T posts a profit beat and lays out plans to deal with activist investor Elliott Management, while Spotify surges on strong revenue and a surprise profit. We're breaking down all the earnings news you need to know this morning.
Opening the doors to more mortgages, we speak live with HUD Secretary Ben Carson about some new moves that could let many more low-income borrowers get access to FHA loans.
And Tiffany soaring this morning in the pre-market on word of a $14 billion takeover bid. Why the owner of Louis Vuitton wants to take control of the iconic jewelry store.
Let's get a quick look at the futures here ahead of the opening bell. Green across the screen, a nice sea of green ahead of that big Fed meeting later this week. Stock markets are approaching or hovering around record highs. Dow futures up 129 points.
We'll get a full check on the markets in just a bit, but first we have some breaking news for you. The end of the U.S.-China trade war may be in sight. As he was boarding Air Force One to Chicago this morning, President Trump said he is planning on signing that Phase 1 trade pact at the APEC meeting in Chile. Of course, we'll have much more for you throughout the day here on yahoofinance.com. It looks like stock futures are responding positively.
Earnings season is still going strong, with more heavy-hitting companies unveiling quarterly reports today. Traders are already poring over results from AT&T and Spotify. Yahoo Finance's Emily McCormick is in our newsroom with the details. Emily, let's start with AT&T. Obviously, they reported earnings, but they had some big news on the activist front.
That's right. So AT&T's new 3-year turnaround plan at the behest of activist investor Elliott Management is what's really stealing the spotlight this morning. Shares were up in early trading after this announcement, even though there was a little bit of softness on the sales front on the third quarterly basis. So here are some of the new changes under this 3-year plan. So first, AT&T intends to appoint 2 new directors to its board. It's targeting hitting adjusted earnings per share of between $4.50 and $4.80 by 2022. Consensus had been for just $3.39 per share for that year. It also said it's not going to have any more acquisitions in the near term. Current CEO Randall Stephenson just said during an earnings call that AT&T plans to sell $14 billion worth of assets by the end of the year if they remain on track with that goal. He said, quote, "We're committed to an objective, diligent, and disciplined process. We'll analyze the merits of each of our businesses individually and as part of the whole, but let me be clear, we have no sacred cows," end quote. So they're definitely looking to reevaluate that portfolio. They also intend to separate the chairman and CEO roles. So Randall Stephenson, who is currently in both of these roles, is now set to depart sometime after 2020.
All right, well, I want to move on to Spotify now, also out with earnings. It looks like their subscribers showed some growth last quarter.
That's right. So really strong subscriber growth. They now finished the third quarter with 113 million paid subscribers. That's up 31% year over year, topping expectations for just around 111 million. Total monthly active users, paid or unpaid, were up 30% to 248 million. That was above estimates for 243.4 million users. So this strong user growth coincided with a number of premium subscription incentives. So they did launch a 90-day free trial offering for both the standard and student plans in August. They also said Southeast Asia remains the fastest growing region and that India outperformed internal forecasts by 30%.
All right, also CFO Barry McCarthy stepping down at Spotify. He was the one who was sort of the architect of the direct listing of Spotify on the New York Stock Exchange. Emily McCormick, thanks so much. Speaking of the stock exchange, let's head down there right now where Inez Ferre is standing by with some earnings reports this morning from Walgreens and restaurant brands. What did they have to say, Inez?
Yeah, that's right, Alexis. Walgreens is up more than 1% in pre-market. This is after they beat on the top and bottom line for estimates for their latest quarter. Walgreens also raised its annual cost savings target to more than $1.8 billion by the year 2022. Now, year to date, the stock is still down around 18%. And we're also watching restaurant brands. This is after their adjusted earnings and their revenue came roughly in line with Wall Street estimates. Popeye's comparable sales were up 15.6%. Burger King's comparable sales were up 10.7%. A big driver there was the Impossible Whopper. The Impossible Whopper drove 5% of comparable sales growth in the U.S. The challenge, though, was for Tim Hortons, with the company saying that it was a challenging quarter with comparable sales down 0.1%. And of course, there is a lot of anticipation here because Virgin Galactic will start trading today as a public company. It's a space tourism company which was started by Sir Richard Branson. They will be trading here. This is made possible because of a merger with Social Capital. It's a special acquisition company, and you can see right behind me an aircraft right there.
All right, thanks so much, Inez.
Thank you.
And we have news just into Yahoo Finance. The Trump administration is taking new steps to get more banks offering FHA loans. The Department of Housing and Urban Development and the Justice Department have reached a memorandum of understanding about prosecuting banks that violate the False Claims Act. They're hopeful that will get more banks involved in the FHA program. Housing and Urban Development Secretary Ben Carson joins us now from Austin, Texas, and our very own Brian Chung is here with us at the desk. Mr. Secretary, let me start with you. Why was this memorandum necessary right now?
Well, after the housing crisis, many of the banks were persecuted, I would say, for relatively minor infractions. Some of them were major infractions, but many of them were minor infractions. And there were mandatory minimum suspensions and huge fines associated with that. So many of them left. In fact, the base of people who were originating loans that are guaranteed by FHA went from about 45% to less than 15%, which is where it is now. Now, this is not to say that we don't very much appreciate the non-depository lenders who have filled in the gap, but we want to have a wide group of people who offer credit, particularly to low and moderate income individuals.
Hey, Secretary Carson, Brian Chung here. So on that point, you mentioned that most of the FHA-insured loans right now are actually being originated by non-banks. So is this an acknowledgement that you'd prefer that actually more of these FHA-insured loans be under the regulated and kind of insurance, at least covered banking industry, those that are insured by the FDIC? And is there a concern that maybe actually doing this would even expand the ability of some lenders to maybe falsely put people into FHA-insured loans, as the False Claims Act was originally designed to do?
Well, first of all, we very much appreciate the non-banks. We appreciate everybody. We want to expand the pool. That's the real key. No, I don't think it would increase the use of false claims, because in the memorandum of understanding that was signed between myself and the Attorney General very recently, we have placed a mechanism whereby HUD will evaluate each of the claims itself, and most of the things can be resolved administratively. And only in cases where they can't be will it then be referred on to the Department of Justice.
Secretary Carson, switching gears for a moment, you are one of the last remaining original members of President Trump's cabinet. And I'm just curious sort of what the mood is right now in the White House. You have the impeachment proceedings going on. We're facing an election in 2020. What's the mood like there?
Well, the mood has been much the same throughout the entire tenure. The administration has been largely under attack. The impeachment stuff has been going on since the beginning and continues to be the case. But, everybody in the cabinet recognizes that because we're a member of this administration, we're going to be more heavily scrutinized and attempts will be made to discredit you. That goes with the territory. For me, the real key is, why are we here? We are here to try to provide affordable, safe, decent housing to the people of this country and to enact policies that actually make sense. And I think everybody has kind of adopted that same philosophy.
Secretary Carson, on that point, something that that HUD is still grappling with, in addition to the FHFA, is the Fannie Mae and Freddie Mac conservatorship that is still in place right now. The Trump administration has expressed interest in trying to privatize those entities. What is the update on that? Will there be any sort of stance that you can provide right now in terms of what to do with both of those agencies?
Well, you know, it's one of the last residual problems associated with the housing crisis, the conservatorship, which has gone on for more than 10 years at this point, and places the taxpayers at risk. So obviously, we would like to, capitalize those entities and get them out into the private sector, as well as providing opportunity for other insurers to come into that market. And I think, we obviously have to have the appropriate type of government backstop, and we have, plans for that as well. So yeah, I think it's high time for them to move out of conservatorship.
All right, Secretary Ben Carson, great to see you. Thanks for coming on with us this morning.
My pleasure.
All right, let's take a look now at what is moving the European markets on this Monday. Things are higher, barely though for the FTSE 100, the CAC 40 up 13. We've got the DAX over in Germany up better than 60 points. Yahoo Finance's Tom Belger is joining us live from London. And Tom, European leaders have agreed that Brexit can be delayed by up to 3 months as Britain edges closer to an election. What else can you tell us?
This week was supposed.
Oh, it looks like we lost Tom there for a moment. We'll try to get him back for you in just a moment. Let's move on to News Bites. Mideast leaders are calling the death of ISIS chief Abu Bakr al-Baghdadi a major blow to the terror group. Suspected militants were seen picking through the rubble of his compound in Syria days after Baghdadi was killed in a U.S.-led raid. President Trump says Baghdadi ran into a tunnel with some of his children before blowing himself up. Terror experts warn Baghdadi's death may not stop ISIS as it tries to build a caliphate in the region. California wildfires escalated over the weekend due to rough winds throughout the state. California's governor declared a statewide emergency yesterday, ordering nearly 200,000 people to leave their homes. Millions of residents were also left without power as utility companies look to prevent more wildfires from spreading. Representative Katie Hill is resigning as a California congresswoman after an ethics investigation into allegations that she had an inappropriate relationship with a staffer in her office. The freshman congresswoman did not specify a resignation date in her letter, but Politico reports her departure may come as early as November 1st. And President Trump wasn't too welcomed at the World Series game in Washington, D.C. Trump was met with boos and disapproving chants of "lock him up" when appearing on the stadium's large screen at Game 5 between the Nationals and the Houston Astros. This was Trump's first time attending a baseball game since living in the White House. Pretty unusual for a president.
Exactly. Coming up here on The First Trade, going back to work. GM and the UAW agreed to a new 4-year contract. We'll break down what it means for General Motors and the rest of the big three automakers. Also, trying to fix Facebook. Our editor-in-chief Andy Sower looks at what can be done to fix false ads on the tech giant's platform. Taking another look at the futures here ahead of the opening bell. Lots of green on the screen to kick off this week. Dow futures up 135 points. The S&P 500 and NASDAQ nicely in the green. We'll be right back.
This morning, we're hearing from another one of the people who wants to be president, but this time it's a Republican who wants to unseat President Trump. Yahoo Finance's Rick Newman got to sit down with former Massachusetts Governor Bill Weld. And what did Bill have to tell you, Rick?
Yeah, there are three other Republicans other than Trump trying to become president in 2020. Bill Weld was a former governor of Massachusetts. He's a lawyer, and he strongly favors impeaching Trump and removing him from office. Now, that would benefit him, obviously, as somebody competing with Trump for the nomination, but let's hear his rationale for that.
I don't know. I hope it's Mike Pence. I hope the Republicans are going to remove this guy. And things, that's our insurance policy, among other things, against him spending $1 billion on Facebook ads and essentially buying the election. That sort of thing could happen in this guy's hands. I worry about that. I think the guy's a menace to the Republic, and I want to, I don't think this would be a bad precedent. Having the Senate vote to remove him. I think it could be a valuable precedent against the day when we might have another Nero or a dictator come along and try and take away our liberties as a country. And then we say, oh, no, there's guardrails for what a president can do, what the chief executive can do. Look back at the Trump case.
So you heard him. He compares Trump with Nero. He also said he thinks Trump is worse than Nixon.
Rick, what are Weld's chances here?
They're probably not zero. So if he's running against Trump in the primaries, yeah, they're zero. But what if Trump ends up not being the nominee? I mean, there is a pathway that Trump is not the nominee. He could quit. He's probably going to get impeached. He's probably not going to get convicted by the Senate.
Given his personality. But okay, you're
Unless
right.
it looks like he's going to have trouble in the Senate if he gets impeached. So there are actually three Republicans other than Trump running. There's Bill Weld, Mark Sanford, and Joe Walsh. And they kind of jokingly refer to themselves as the Three Stooges.
Yeah, joke, absolutely. Rick, switching gears while we have you, I'd love to get your thoughts on the new GM contract. And obviously, Ford and Fiat Chrysler are waiting in the wings here.
Yeah, so it's over, obviously, after 40 days or so. Thank God it's over. GM needed to get back to producing cars. The workers need to start earning money again. So this now goes to Ford and Chrysler. And the way this usually works is they take the deal negotiated with the first automaker and basically present it to the others and say, this is what we expect. The problem for Ford is less profitable than GM, and it actually has more U.S. workers than GM. So Ford is in a worse position in terms of accepting this type of deal, the pay raises that go along with it, more health care spending in order to keep the worker contribution at a very low 3%. So Ford, usually the other automakers just rubber stamp the deal, but Ford may not be able to do that. So we'll see probably within a few weeks whether
if they're not able to do that, do you think they could be facing a strike of their own?
There could be a strike
at Ford, you think?
Yes. Yep.
Do you think that it was
Fiat Chrysler would come last?
At the end of the day, was it worth it for these UAW workers to walk out, given the deal that they got?
They got some of the things they wanted. So yes, they got a faster pathway to permanent status for temporary workers. They got pretty good raises, and they did get to keep their out-of-pocket health care expenditures where they were.
That's huge.
So they don't have, that is a big, everybody in America knows that.
Yeah.
If you don't end up not having to pay more for health care, you count that as a win these days, because health care always goes up by more than inflation. What the workers did not get is the reopening of the 3 U.S. factories. And you can, now that this is over, you can kind of see GM's strategy in retrospect. They closed those factories last year without a doubt, knowing this was going to be an issue when it came time to renegotiate the union contract. And GM just held firm on that. They weren't going to give that back.
Yeah. And Rick, overall, it seems as though the costs of doing business for these automakers is about to go up at a very weird time for them.
Right, because we've probably already hit peak auto, and we're probably going to have sliding sales for some time. And of course, this is a very cyclical industry. So automakers get hammered when there's a recession. One of the first things you're not going to spend money on in a recession is a new car. The automakers know that. They've been going through this for decades. And one has to assume GM feels like this is a deal they can live with because they signed off on it.
Yeah.
And of course, now it's a race to who's going to bring out the electric cars in a big way to the mass market, and that's also going to be costly.
Yeah, and it's going to take a long time. We have the starter versions of electric vehicles here now, but they are still way too expensive for ordinary buyers. And the automakers know they have to make this transition. They have to get battery costs down. They have to get other costs down. But I've driven a bunch of electric vehicles, and they're very cool. I mean, they feel great. There are fewer moving parts, so probably less maintenance over time and things like that. Once we get there, we're not there yet.
We've got to get there.
There's a big transition coming. It's going to be slow and wrenching. But it's going to be cool when
and Tesla will keep them all on their toes.
Yep, they will.
All right, Rick Newman, thank you.
Thank you.
All right, let's go back now to the European markets, and as you can see, they are higher with the DAX up now 56 points in Germany, the FTSE 100 basically flat, and the CAC 40 in Paris up about 12. We've got Yahoo Finance's Tom Belger back with us from London. Tom, what is the latest on the Brexit delay, now being delayed by up to 3 months?
That's right. This delay is a major humiliation for Boris Johnson, who promised Brexit would happen this Thursday, come what may. But EU leaders have now agreed that Britain can stay in the club until up to, at the latest, the 31st of January, or before then, if Parliament can approve a deal before that date. The delay's been on the cards really ever since Parliament forced Johnson to request it against his will. So the pound's reaction's been fairly muted, though businesses have welcomed the extra time. Importantly, though, it paves the way now for a general election, with MPs set to vote tonight on a public vote in early December to try and finally break the Brexit deadlock.
And Tom, those HSBC earnings were pretty tough in the eyes.
Indeed, yeah, HSBC is really battling a perfect storm of challenges. It's particularly exposed to hotspots of political and economic uncertainty around the world. From the US-China trade spat to protests in Hong Kong, which is one of its main heartlands, Brexit, low interest rates, and it's seen then its third quarter profits sink. It's lowered its profit target for 2020, and it's announced a restructure today. So there's speculation over potentially major job losses, with the CEO saying today there's scope for cutbacks, and it's made it the biggest faller on the FTSE today.
Tom Belger, thank you. The opening bell is coming up here next on the first trade. Let's get a peek at the futures, though, real quick. Increasingly green on the screen to kick off this week. Dow futures up 141 points. The S&P 500 and NASDAQ nicely in the green. And let's get a peek overseas before we head to break.
Welcome back to the first trade. We're about 5 minutes away from the opening bell this Monday morning, and we have stock futures in rally mode with Dow futures up nearly 150 points. Let's go around the bell with Quincy Crosby, Chief Market Strategist at Prudential Financial, along with John McClain, Portfolio Manager at Diamond Hill Capital Management, and Yahoo Finance's Jared Blickery at the Wi-Fi Interactive Board. Great to have you all with us this morning. Quincy, I'd like to start with you. You know, we saw President Trump this morning come out and say as he was boarding Air Force One that he's going to go ahead and sign that phase one deal between us and China. It looks like the market is rallying on that. Do you think this might turn out to be a false rally?
Well, we've had so many zigs and zags, but I think if you looked at the market overnight and you looked at Asia, the Chinese press actually also, pushed towards this, and that was helpful. Also, what was very helpful on Friday was that Lighthouse, or the trade rep, he was positive, and he tends to be the one the market pays most attention to because he's not out there to pump up the stock market. He's got a very good reputation, excellent reputation, and he was actually, I think I saw him smiling. So that's a change. But if you notice, the market pulled back because it hit the headlines that Peter Navarro, who's been trying to get the president to turn down this phase one, that hit the headlines, and the algorithms went right after that and brought the market down. So this is positive. Look, for the market, they just want a viable truce. A viable truce, not one that ends, in 2 days or next week. And that would be helpful for the market.
John, isn't it bizarro that later this week the Federal Reserve might cut interest rates? We have stocks touching new records.
Yeah, I think so, because it is priced into the market. We're north of 90% that the Fed's going to cut later on this week. And really what we've seen is strong equity returns driven by declining interest rates. And if everything's okay on the economic front, then why is the Fed cutting rates? And will they return to hiking pretty quickly?
Yeah, that is sort of the question of the day. Should the Fed really be cutting at this point?
Well, what the Fed is doing is taking back what it did last year. I mean, last year at this time, you remember, going into the end of the year, the market was saying, Fed, you're making a policy error. We're going into a recession. Look at the defensives leading that market lower as we got toward the end of the year. So it takes about 9, 10, 11, 12 months before a rate hike or a rate cut actually works its way into the system. So the Fed is going to do it, and I think the big question for the market is whether or not they insinuate a pause, or do they say, look, we'll be data dependent. We're still there to help underpin the economy. We want to make sure the economic expansion remains intact. Those words are going to be crucial for the market. But overall, with the easing of the trade tensions, with Brexit looking as if there's more flexibility and may actually happen, the fact is that the market may not sell off as dramatically as everyone thinks if they say, this is it. And I don't think they're going to do that. They've learned the lesson. Mm-hmm. Don't be that emphatic, because the algorithms will hit you in a nanosecond, split nanosecond.
John, do you think the Federal Reserve is back to hiking interest rates early next year?
Again, I think they'll be data dependent. I think we get the cut here. And really, if we get a resolution to tariffs, if we figure out what's going on with Brexit and economic data starts to improve, then yes, I think we'll go back to hiking. I really think the Fed has been cutting to counterbalance the policy errors that we've made with tariffs and with global trade issues.
Jared, I see a lot of up arrows there on your world board.
Yes, lots of green around the world. We have the Shanghai and the Hang Seng up overnight about 0.85%. The Kospi in Korea up 0.25%. And then in Paris, also up 0.25%. That's a CAC 40. Frankfurt, we have the DAX up 0.5% with the market there at or around 2019 highs. London about flat, and then in the U.S. we have the S&P 500 set to open up in a few minutes at a record high. You can see this is going to change pretty soon, but should be seeing record highs in just a couple seconds here.
Okay, here we have a new trading day underway at the New York Stock Exchange and the NASDAQ. We saw stock futures rallying nicely into the open. Dow Jones Industrial Average going to start the day up 93 points. You know, John, I was looking at your note this morning, and you said stock valuations appear to be disconnected from economic reality. Are you trying to say that valuations are a little too rich right now?
Yeah, absolutely. Valuations are rich. For what we're seeing out of economic data, we continue to see deceleration in global growth across the board. And really what's helping valuations is quantitative easing across the globe, supportive monetary policy. And like we were talking about before, if the Fed suddenly goes back into hiking mode, that tailwind for risk assets turns into a headwind.
Quincy, are you surprised that the market is at a record? It doesn't feel like it's at a record. Look, everything we've been getting this year, trade tensions, some signs of inflation, record highs is pretty amazing.
It is pretty amazing, but the market tends to see changes in economic data before the actual economic data are released. And if you took a look at, for example, take a look at Germany. The data have been miserable, and yet the DAX has been moving higher. And look at the sectors leading that higher. Export related, the banks, probably factoring in all of the stimulus and also the easing of trade tensions. And that, I think, is going to help Chinese demand, even at the margin. It may take China, along with the stimulus they've introduced, and start to ease things. In terms of the economic data here, which I think is important, Friday we'll get obviously the employment numbers, but also the ISM manufacturing. And there is another tug of war in the market, whether the market, MARKIT, manufacturing report, coupled with the regional PMI's manufacturing reports that we've been getting, is actually telling a better story than the ISM manufacturing.
Do you think the data has bottomed? That seems to be the thesis prevailing the past couple of weeks.
Yes, that is it. Take a look at Caterpillar, just to give you an example. It got nailed. Granted, they said they're cutting production. But the fact that the market was able to bring CAT back and a number of other stocks in the industrials tells you that investors and traders think we are bottoming, and at the margin, demand will begin to inch higher.
Hopefully. All right. Well, John, if people are worried about earnings right now, I mean, we see a lot of the reports coming in and beating already lowered expectations. But when we look to the future, if investors are worried about that earnings growth and the health of earnings, where do they go right now for returns?
Yeah, I mean, I think that's a good point. Earnings are beating a very low hurdle at this point, and earnings growth has been effectively flat since the beginning of 2018. We think that it makes sense to trade up in terms of the capital structure, and what that means for us is potentially rotating a bit out of equities and into more fixed income, where you're higher up and you have a senior claim on the capital structure. So we think that more defensive posture makes sense, because I would disagree and say that economic data has bottomed, similar to interest rates and the lagged effect. Tariffs also have a lagged effect, and we have seen additional tariffs put on this year that really haven't worked its way through the system, I believe.
Where do you look within fixed income? Where are the opportunities best at the moment, John?
Yeah. If we think about ratings, we prefer the triple B part of the market to the double B part of the market, and the single B part of the market to the triple C part of the market. So what we're saying is really avoid the dodgiest names, the names that are over-levered and lowest in the capital structure. Avoid the loan market. It optically looks cheap right now, but it's going to get cheaper. And in fact, we actually are starting to find some value in energy, a place where we think investors have really thrown in the towel.
Sometimes it's cheap for a reason, right? So look out.
So very true. Jared, over to you at the Wi-Fi Interactive board.
Yeah, lots of green on the Dow Jones Industrial Heat Map here, and lots of individual names at record highs along with the S&P 500. Check out Apple, up 0.25%. Microsoft, up over 3%. This is a record high, finally breaking out. This could bode well for tech software, which has been under pressure for several weeks, actually 2 months going back. We have Cisco up 1%, Nike about flat, financials doing well as a 10-year T-note yield is up about 4 or 5 basis points. JP Morgan at or near record high as well, up 0.75% today and up 30% year to date. Lots of green going around today.
All right. Jumping off that, Quincy, do you agree with John that you should move some money out of equities and go into fixed income?
Well, yeah. I mean, you're going to find opportunities in fixed income, but on the equity side, we're in agreement with him in going into the companies with very strong cash flow, companies that will not disappoint you on dividends. But the fact is that the market had been very defensive, and I think we're inching more to taking on a bit more risk.
Quincy, what do you think a rally could look like going into year end? I imagine there's still that fear of missing out on Wall Street, and there remains a lot of money on the sidelines. Even in addition, there's still a lot of money parked in defensive stocks.
Well, absolutely. And what will happen is if there's better economic data that hit the headlines, you're going to see some of that money coming out in money market funds. We have more money in money market funds than we've had since the Lehman crash. And that money will probably come into the market if people feel more comfortable with the economic underpinning. And I think you're going to see it. I mean, I always look at that contrarian indicator of money going in there, and that fuels coming in. The other thing we are seeing, while volume is down, and many people say volume down is not it's negative indicator, but we are seeing the breadth in the market expanding. And coming into this period of stronger breadth, the market was pretty narrow, and that was disconcerting. That breadth is expanding.
That is definitely a positive thing.
It's
So, John,
positive.
what does a year-end rally look like to you? Are we going to see a pickup in volume, and who might lead us higher into 2020?
Well, I don't think we're going to have a year-end rally here. Again, I think you should continue to be you should expect to be disappointed by what we're coming out of global trade and Brexit continuing to get pushed out here. But if we do see a rally, I would agree it's going to be value over growth and kind of the cyclicals leading the way.
Quincy, are we talking potential year-end market melt-up?
Well, we could. You know, statistically, the end of this month, which is right now, is probably the best season for the market. Last year, you had the Fed hiking and then suggesting they were going to hike again this year. That certainly wasn't a great Santa Claus rally, except for January 4th, where they did a complete turnaround. So this year you have the Fed underpinning, and again, you've got better headlines, and it looks like the market wants to move higher. Again, I look at the stocks that had bad earnings, and then they turned around with a rethink in the market saying, wait a minute, maybe in early 2020, they actually have a better underpinning, solid empirical underpinning to actually move higher.
By the way, as we've been talking, the S&P 500 has now hit a new high at 3041.
This is fun stuff. Quincy Crosby, always good to see you. John McClain, always good to see you. Thanks so much, Jared. Let's head down to New York Stock Exchange floor and check back in with Yahoo Finance's Inez Ferre. Inez?
Yeah, guys, a lot of excitement here as the S&P 500 has hit a new record high right now. You're looking at it 3041 with tech leading the gains. And also traders here are waiting for Virgin Galactic to start trading. This is a space tourism company that was started by Sir Richard Branson. He is here on the floor of the exchange near Citadel, where the first trade is expected to start. This is possible because of a merger that Virgin Galactic did with a special acquisition company called a Social Capital, Head of Sophia. And also we're watching this morning PG&E just tanking, another day of the stock plunging down more than 25%. The company is planning another massive power shutoff between tomorrow and Wednesday. Last week there were media reports questioning the possibility if PG&E equipment had started the latest fire in Northern California. Also, there was a very bearish note last week from Citi saying that the probability that the stock could go to zero is at 75%. And meanwhile, Prologis, we're watching that stock after the company bought Liberty Property Trust, announced that it's buying Liberty Property Trust with an all-stock deal valued at $9.7 billion. This is to expand their warehouse and logistics footprint in places like Chicago, Houston, and Southern California. Alexis?
All right, the galactic buzz is happening there on the floor for you, Inez.
Yeah.
All right, thanks a lot. Oil in the spotlight for traders today after a weekly surge due to progress in the trade deal with China. Yahoo Finance's Jared Blickery over there at the Wi-Fi Interactive board with today's commodities report. So how's oil shaping up here on this Monday, Jared?
Well, oil's up just a little bit here. If we look at the overnight price action, last week, by the way, was the best week for oil, up about 5% in just over a month. And we can see underwater for most of the night, but got a surge here just after 8 a.m. We usually do see some kind of movement between 8 and 9 a.m. Let's take a look at a longer-term chart because we're going to see some consolidation after launching off this 51, 52 support level right here. We do have a trend channel in place, and we've kind of hit the upper end of it, maybe come down to 53, 54, test the lower end. But for right now, the short-term trend is up in crude oil.
And Jared, you're also watching gold.
Yes, gold is down just a little bit. It's still above 1,500. More importantly, still above this 1485 support line here. And we have been pointing out this false breakdown last week, but with the Fed and the ECB and the BOJ all meeting this week and expecting to ease further, that should give a little bit of a bullish impetus to gold futures right now. Now, one thing holding it back, though, is interest rates. 10-year T-note yield is up about 4 or 5 basis points today, so that is a little bit of a headwind for gold futures right now. Guys?
Jared Blickery, thank you. After years of helping people get engaged, Tiffany is receiving a proposal of its own. It has reportedly received a $14.5 billion takeover offer from Louis Vuitton. Yahoo Finance's Heidi Chung has more from our newsroom. Heidi, I've been hearing this rumor for 10 plus years. Break this down for us.
Hey, Brian. Yeah, so Tiffany shares are actually soaring quite a bit this morning, about 28%, after Louis Vuitton parent company LVMH proposed this deal for an acquisition about a little bit earlier this month. But it was an all-cash bid offer, allegedly, and would value Tiffany at about $14.5 billion or about $120 per share. But as you can see this morning, the shares are trading above that offer bid right now. Tiffany's is likely going to reject this bid, however, according to a report from the Financial Times. But if this deal does go through, Brian, it would be the largest ever acquisition by LVMH. But this kind of deal offer kind of makes sense here because, one, we have a fast-growing luxury jewelry market, and LVMH just wants more of that, even though they are already exposed with their ownership of Bulgari. But second, Tiffany has a really, really big presence here in the U.S., so this would open up that portfolio for them and give LVMH more exposure here in the States as well.
Do you think that they're just going to play hardball, that Tiffany may reject this in the hopes that Louis Vuitton ups the ante?
That could be the case, Alexis, but one thing that we do want to mention is that LVMH looks quite well positioned here with a really healthy balance sheet to actually go through with a deal and purchase like this. But I do want to mention that Tiffany's right now is actually trading quite cheap relative to its 5-year historical average, and the multiple looks very attractive at this level. So there are some concerns out there by analysts saying that, Tiffany's could become even cheaper than it is right now, so LVMH might be better positioned if they wait a little bit here.
You know what I'm thinking? I'm thinking a deal like this, right, Brian and Heidi, tell me if I'm wrong. If we're talking recession is imminent, you wouldn't do a deal like this. So obviously Louis Vuitton's feeling pretty good about the economy right now.
Well, Tiffany might want to take this money and absolutely run. This is a company that has struggled historically too, and not a lot of growth areas. The company has failed in watches, and they're still not able to, I think, successfully open up stores beyond these big giant flagships all over the world.
But isn't it a good sign, Heidi, that a deal wants to happen, that Louis Vuitton wants a deal to happen here?
Yeah, so LVMH has actually been doing really, really well, even as we have this uncertainty in the environment and geopolitical tensions continuing. And so they see potential in this jewelry market. The jewelry and shoe industry is growing extensively in the luxury market here. So yeah, if Tiffany could actually say yes to this deal, it would be better for Tiffany's than it probably would be for LVMH.
All right, thanks so much. Heidi Chung in the newsroom. And this morning we are taking a deeper look at a big problem for Facebook, those fake or false ads from politicians that CEO Mark Zuckerberg and company refuse to censor. Editor-in-Chief Andy Serwer has been looking into this now. And Andy, you call this position sort of illogical and untenable. Why?
Well, I mean, on the face of it, Alexis, just look at it. We're running an ad. We know it's false, but there's nothing we can do about it. There's nothing we want to do about it. We're a platform. We're just all about being Switzerland here, and that's fine. And to me, and I think to most Americans, it doesn't make any sense. You don't see ads that are intentionally, knowingly false in legacy media, which is to say newspapers, television, billboards, and radio. It's a different thing, and it actually has to do with what governs these social media networks. It goes back to a 1996 law, Section 23 specifically, which designates Facebook, Twitter, and say YouTube as intermediaries, mere pass-throughs that are neutral, and so therefore they're not liable for the content that's on their platforms.
Andy, what do you think Facebook's commitment to journalism is?
Well, you know, Brian, it's interesting you asked that because on Friday, the company came out with a new news section where they're going to be doing deals with publishers, a lot of prominent publishers, and putting their content on a news section on their platform. They're going to be paying them, and they say this is a long-term relationship they're starting to have with these publishers. For me, I've seen this movie before, Brian, and and they'll go and do jobs like this or do deals like this with. Oops, we got some pyrotechnics.
Oh, look at that. Fireworks down there at the New York Stock Exchange. And of course, that is because Sir Richard Branson is there to kick off trading in his Virgin Galactic space. I've never, in all my years down at the exchange, I've never seen this one. It's going to be the first space tourism stock. And he is down there today as the company actually lists directly on the New York Stock Exchange. Is something we've been seeing more and more of. Spotify also went that way. The spacecraft is going to be able to carry 6 passengers, 2 pilots right to the edge of space. Interesting idea, and really a huge day, I would imagine, for the space industry overall, bringing a stock like this, a company like this, to the public market. What do you think, Andy?
Yeah, I mean, because, Alexis, it's the final frontier.
And Richard Branson is all over it.
Well, it's going to happen. And I mean, you think about the most prominent entrepreneurs on the planet, right? So think about this. Here's a group of Richard Branson, Jeff Bezos, Elon Musk, okay? They're all about getting people into space. And so at some point, I think in our lifetime soon, we're going to start to see this happen. I mean, it's happening right before our eyes.
I'm very curious of what those earnings reports will look like. I can't imagine this is a big addressable market, at least for right now.
Yeah, I don't think. I mean, it seems it's another business that's venture backed that is going to have losses from here until eternity.
Ooh, I like it.
Right.
I want to get back to Facebook for a moment because Facebook did take down a political ad from Lindsey Graham. So how is that different than what the other ads that it's talking about?
See, this is this intellectual triangulation, if you will. I can't even say it, that the company's gotten itself into. We'll do this, we won't do that, we're going to do this, it makes sense if we do that. They took down an ad that said that Lindsey Graham supported the new Green Deal, which he didn't. But I thought you said they weren't going to take ads down. They did, because this was done by a political action committee, a PAC, as opposed to the candidate himself or herself. Splitting hairs, does that make sense to anybody? It doesn't make sense to anybody. And that's the whole thing. This policy doesn't make sense. And I think at some point they're going to change it. Maybe Congress is going to have to strike down that law that I was talking about. In regular media, legacy media, it's actually governed more by court cases, Supreme Court cases and precedents going back to New York Times versus Sullivan in the 1960s.
That's right.
And so, that has to do with libel, and you can't put something up that is with reckless disregard for the truth or with malice, intentional malice. And so I think that would sort of govern these platforms a lot better. Interestingly, you mentioned the content they're going to have up there. That actually may sort of move this argument forward, Brian, with that new news section as well.
Yeah, well, lot to sift through. All right, Andy Serwer, thanks for doing your research for us on that.
And space.
And space.
The final frontier.
The great beyond.
Right.
Coca-Cola seems to have its Diet Coke and Zero Sugar soda franchises under control, but its core water business still needs some improving. And Brian, I know you dug a little deeper into this, and they own Dasani, they own Smart Water, but from what I understand, it only rose 1% revenues in that unit. Why is that?
Alexa, this is a tough topic to talk about after our space chat. I'm just saying, I just want to swab the deck on that one.
You can't get out of space, okay.
So the unit case volume for Coke, which is a key measurement for beverage companies, in their water business, which they call, quote, hydration business, it also includes sports drinks, only rose 1%. And trademark Coca-Cola in the third quarter saw volume rise 2%. So the water business has continued to struggle or not do as well as the other parts of the Coca-Cola brand. Year to date, the business, according to Nielsen, sales are flat. The overall water industry, their sales are 5%. I think Coca-Cola is looking at two things at least. One, more aluminum cans. So bye-bye the Dasani water bottles, more aluminum cans. Those are already hitting stores. And then also, two, enhancing the water it does have, more flavors, more nutrients, and a lot more marketing gimmicks.
So Powerade is a Coca-Cola product, right? What are they doing with the sports drinks, if anything, to sort of, rev things up there?
That is highly unclear. It's important to note that Coca-Cola did not want to share any of their plans with me regarding what they want to do to fix this business around. But I think they're very focused on the core water business. Powerade has been losing massive share, obviously, to Gatorade and even some of the other sports drinks out there.
Get ready for aluminum cans. Your water in an aluminum can.
Go figure. And make sure to turn into On the Move today at yahoofinance.com and on our app. They'll speak with Sir Richard Branson as Virgin Galactic starts trading at the New York Stock Exchange. That's today at 11 a.m. Eastern Time. Coming up here on The First Trade, market calendars. There's a lot going on this week, from Beyond Meat earnings to key news from the Federal Reserve. We'll go over all the big stories that you can expect.
And here's another look at how the markets are faring on this Monday. A pretty nice start to the week, I'd say. The Dow is up nearly 200 points on the hope that a trade deal with China is getting close. We've got the S&P 500 up 18 and the NASDAQ rallying 56. We'll be right back with companies and stocks to watch right after this.
Welcome back to the first trade, and it is a happy Monday indeed. Dow is up 173 points, the S&P 500 and NASDAQ solidly in the green.
Now for a look at some of the companies and stocks the Yahoo Finance team is watching for you today. Walgreens is out with stronger than expected results. The pharmacy giant posted earnings and sales that beat expectations last quarter, despite what the CEO called a, quote, challenging operating environment. They're also boosting efforts to cut costs and are now looking to trim $1.8 billion by the year 2022. Apple is getting an upgrade today from J.P. Morgan. The bank raised its price target on the tech giant from $265 to $275 a share. Apple is set to report earnings for the quarter after the bell on Wednesday. That stock, by the way, up over 50% year to date. And the parent company of Burger King and Popeyes reported third quarter earnings and revenue today. Restaurant Brands also saw sales rise 10%, thanks in part to Popeyes' popular chicken sandwich. Restaurant Brands also announcing Popeyes will be bringing back its spicy chicken sandwich. I know Brian is very excited about that. Investors are watching Amazon this morning after the e-commerce giant announced it is partnering with fintech company Paymentus to allow customers to use Amazon Pay. For utility bills, payments can be made online or by voice using, what else? Amazon's Alexa. And Taylor Swift, well, she's going to be headlining one of the biggest shopping days of the year. The singer will be behind Alibaba's Singles Day next month in Shanghai, just 1 month after she wrapped Amazon's Prime Day celebration. Come on, Taylor, what are you doing? You're working for both sides here. Swift will be featured in the televised and live-streamed concert 24 hours ahead of the shopping day. Alibaba expects over 100 million more shoppers than last year, and that's despite that slowdown we're seeing in China.
Going to be another blockbuster week for the markets. A lot of big names reporting earnings, and the markets will also have their eyes on Washington for the Fed meeting and key economic news. Alexis, after the close today, we have Google and a company we follow quite closely here, Beyond Meat, earnings hitting the tape.
Yep, and Beyond Meat could use a little good news because that stock is off more than 30% this month alone. So investors want to see the path to profitability. I feel like I say it almost every day, but that's what investors want now.
So true. And Beyond Meat, keep in mind, they put up a pretty good second quarter, but the stock has continued to sell off. A lot of negative notes out on Wall Street since that second quarter report.
Also, GM going to be coming out with earnings this week. That's tomorrow. We'll see if they talk at all about what the strike meant to their bottom line and what it's going to do to our earnings going forward.
And then we have Boeing CEO Dennis Muilenburg. He is going to be shredded before Congress tomorrow.
Yep, and they had those not too great earnings last week as well. Wednesday is going to be a real big one. We have tech giant Apple and Facebook out, also GE and Starbucks, and let us not forget, there's that little Fed meeting on Wednesday as well. Of course, it looks like the market has baked in that quarter-point rate cut. Anything more than that might get investors a little worried, like, is the Fed worried here that we're going to fall into recession? Anything less than that, we could see a big sell-off.
Is it Friday yet? It really needs to be Friday.
You.
But I'm also keeping a close eye on Kraft Heinz and Dunkin' Brands later in the week. We've gotten some very strong results from the restaurant sector. Obviously, restaurant brands this morning, so Dunkin' might be pretty good. Kraft Heinz has been pretty much a disaster going on the past year. A new management team there. I can't imagine any positive news will be coming from Kraft Heinz on earnings day.
And of course, Friday, in addition to all these earnings, we're going to get the jobs report. Economists expecting 85,000 jobs added last month. And of course, we will bring you live coverage of the jobs report right here on the First Trade. We start that day a half hour early at 8:30 a.m. Eastern, and we do hope you join us for that. That's going to do it for the First Trade for this Monday morning. I'm Alexis Christoforous.
And I'm Brian Sozzi. Now let's hand this off to Inez Ferre down at the New York Stock Exchange. Inez?
Brian, Alexis, the S&P 500 today hit a record high, and communication services and technology stocks have been leading the gains. If you take a look at the Dow, it's up about 180 points, being led higher by Microsoft, the best performer on the Dow this morning after that Pentagon contract of $10 billion, which Microsoft was awarded. Also, we're watching Tiffany this morning. Tiffany is surging. This is after the parent company of Louis Vuitton, LVMH, made an offer for Tiffany and Company for $14.5 billion or $120 per share. The board says it is reviewing the offer. And meanwhile, Virgin Galactic started trading here on the floor of the stock exchange, making history really because this is the first space tourism company to trade on a public exchange. This is made possible through a merger that happened between Virgin Galactic and a special acquisition company. Right now, you're looking at the stock that's trading at about $12.40 a share, and Yahoo Finance will be interviewing Sir Richard Branson, the founder of Virgin Galactic, later on this morning. Stay with us. Wi-Fi AM starts right after the break. Don't go anywhere. We'll be right back.
Good morning and welcome to Wi-Fi AM here at Yahoo Finance on this Monday morning. I'm Dan Roberts. We've got Brian Chung and Julia LaRoche here on the couches. All right, let's take a look at the markets and see how we're starting off the week. Very much in the green right now. Look at this rally on the Dow. The Dow is up 180 points or 0.7%. The Nasdaq is up 56 points and the S&P in the green as well, above 3,000. And President Trump tweeted just minutes ago, the S&P just hit an all-time high. This is a big win for jobs, 401ks, and frankly, everyone. Our country is doing great. Even killed long-sought ISIS murderer al-Baghdadi. We are stronger than ever before with great upward potential. Enjoy. So the president watching the markets closely. And of course, earnings season is still going strong. This morning, we just got earnings reports from AT&T and from Spotify, big names in tech and telecom. Yahoo Finance's Emily McCormick joins us now with more. Hi, Emily.
Hey, guys.
So last week we did Verizon, our parent company. Let's do AT&T. How did that earnings report go?
Well, the big story here is really about the 3-year turnaround plan that they just announced at the behest of Elliott Management. So they're an activist investor, came out about 5 weeks ago and said they'd taken a $3.2 billion stake in this company, really trying to push forward initiatives to turn around this stock price. AT&T has actually outperformed the S&P 500 for the year to date, but that's mostly because of the hopes of this kind of turnaround, and now we actually have details on that. So here are a couple of the points. Plans to appoint 2 new directors to the board. They're targeting hitting adjusted earnings per share between $4.50, $4.80 by 2022. So that's way above consensus for $3.39 that Bloomberg compiled analysts had put together. No more major acquisitions in the near term, and actually during the earnings call, CEO Randall Stephenson said that they're planning to generate $14 billion in asset sales by the end of the year. So really, the culling has come. He said there are no sacred cows. They're even looking at potentially divesting DirecTV. So really evaluating some of these portfolio components.
And paying off some of that debt. But my question is, why did it take an activist investor to do this? I guess this speaks to activism and the benefit to activism, because look how the stock's reacting. It's not just on the earnings report. If I had to guess, it's probably on some of those initiatives. So this is one to watch for sure.
Crack the whip, cut.
Right, and if we look at the earnings report, it actually wasn't particularly strong. I mean, they missed on sales revenue, missed on sales. Profit was just about in line with expectations. But if we look at their entertainment division, they shed 1.4 million pay TV customers. So that's the unit that includes DirecTV. So really seeing a lot of attrition there. That had started about 5 quarters ago, and it's just continued to accelerate.
How about management? So Randall Stephenson kind of in a weird position here, trying to appease Elliott Management. Any sort of provisions on his leadership at the company at AT&T?
So right now he is CEO and chairman of the board. They're actually going to be splitting those roles, and he's expected to depart after 2020. So it wasn't quite certain what that timeline would be for his departure. So it looks like he will now be staying through the end of next year and then looking for new management.
I saw a tweet summarizing the earnings announcement that basically said, AT&T says Elliott Management, not so bad once you get to know them, which was a funny take on the earnings. Let's talk about Spotify. How's Spotify doing? It looked like a big day for Spotify, and also really good numbers when you compare Spotify now to Apple Music.
That's right. So a really strong quarter, added quite a few more users than expected. So they finished 3Q with 113 million paid subscribers to Premium. That was up 31% over last year. Expectations had been just for 111 million. Also turned to surprise profit. So those earnings, again, a Swedish company, so they report in euros. So that was 36 euro cents per share versus a loss of 18 euro cents expected. Then revenue also coming in ahead. But they actually had a full section in their earnings report just on the competition. Now, these are Spotify reported stats, so, take them as you will. But they said relative to Apple, the publicly available data shows that we are adding roughly twice as many subscribers per month as they are. Additionally, we believe our monthly engagement is roughly twice as high, and our churn is about half the rate.
Shots fired.
Wow. And then some buzz about the C-suite too, right? Some changes up there?
That's right. So the CFO is departing. So Barry McCarthy is going to be retiring as Spotify's CFO. He's best known for really pioneering the direct listing. Spotify was the first major company to really list shares via a direct listing as opposed to initial public offering. So he will be leaving. JP Morgan's Doug Anmuth actually just wrote a note saying, while perhaps a bit earlier than expected, we do not believe the CFO transition comes as a major surprise. Paul Vogel, head of investor relations, is said to take over afterwards.
All right, both these names up a little today. AT&T up 5%, but Spotify up 12%. Emily, thanks so much.
Thank you, guys.
Well, China is going big on blockchain. A Chinese central bank official is urging Chinese commercial banks to use blockchain tech more. That's according to Reuters. Of course, blockchain is the peer-to-peer ledger technology that Bitcoin runs on and other cryptocurrencies run on their own blockchains. China also just passed a new cryptography law that will take effect January 1st. That is aimed at, quote, facilitating the development of the cryptography business and ensuring the security of cyberspace and information. That's according to the Chinese news agency Xinhua. And all this comes after President Xi Jinping said last week that he wants China's blockchain development to move forward at a faster pace. And of course, got to mention that Facebook CEO Mark Zuckerberg just last week in his testimony was warning that if the U.S. gets in Libra's way, China would come in and beat the U.S. in this area. All of this a little bit kind of backs up what Zuckerberg is saying, even though at the time people were like, oh, of course you say that, just kind of like a scare tactic.
I mean, it kind of makes sense because, look, I don't know if this is going to be something that benefits Bitcoin per se. You did see Bitcoin prices move over the weekend to the upside. But maybe it's China coming out with their own cryptocurrency. And if we're over here regulating, bickering over this, who knows what the implications could mean if China does develop its own cryptocurrency and gets it out at a faster pace.
Absolutely.
We talk about the war between AI, between the kind of space race, not a war, space race. Could it be a space race between cryptocurrencies?
Yep, crypto race.
One thing worth noting, though, is that the United States is also trying, expressing some interest, not necessarily in blockchain, but at least to build some sort of real-time payments infrastructure. The Federal Reserve has said that they want to do something like that by 2023 to 2020. Well, not exactly FedCoin, because again, Dan, there's a difference between blockchain and then the cryptocurrency itself. So not necessarily a Fed coin, but regardless, right? Like I sold tickets on StubHub this weekend, but it's going to take 6 days for that payment to actually hit my bank account. A lot of other countries don't have that issue because they don't have that gap between processing banks that takes multi-days
so
to
frustrating.
transact.
I feel like we are so behind in the payment space in the U.S. and you realize that when you travel abroad. I've been abroad to China where I've seen firsthand just how advanced they are, but even in Europe, it's kind of embarrassing that we are so far behind.
Absolutely.
So I hope we, get back on track.
Yep, and of course the initial value proposition of cryptocurrency was reduce friction, make payments faster online, so let's remember that. All right, coming up here on Wi-Fi AM, as wildfires spread across wine country, local businesses there are taking a hit. We will explain after a quick break. Welcome back to Wi-Fi AM. Let's see what markets are doing right now. All three major indices higher. The Dow much higher, up 170 points. Let's bring on Inez Ferre, live on the floor of the New York Stock Exchange for some insights. How you doing, Inez?
Good, Dan. Yeah, the Dow is up 175 points right now, and it's being led higher by Microsoft, the best outperformer right now. And if we're looking at the S&P, well, it's at a record high at 3041, and being led by technology stocks, by communication services stocks. And this morning we're watching Prologis. It's a little bit under pressure. This is because they've announced that they're buying Liberty Property Trust in a deal valued at $9.7 billion, including debt. That deal is valued at $12.6 billion. And this is really to expand their footprint when it comes to warehouses and logistics centers in Chicago, Houston, Southern California. There's been a lot of M&A activity when it comes to warehouses. You're looking at last month, we saw that Blackstone had said that it was going to be buying Colony Capital for a deal valued at $5.9 billion. Now, this deal that Prologis is, the deal of buying Liberty Property Trust will not only include existing warehouses, but it will also include buildings that are under construction, and also land where warehouses and logistics centers will be located, Dan.
Thanks, Inez, and we were there for the launch of SPCE, ticker SPCE, with Richard Branson and the pyrotechnics.
I sure was. I was actually standing about a couple feet away from him and just taking some video, and it was really, really exciting.
Good stuff, and there it is on the screen. Okay, thanks, Inez. We'll check back in with you soon.
Thank you.
And don't miss our live show On the Move. That is next up after our show at 11 a.m., where co-host Adam Shapiro will be at the New York Stock Exchange to interview Sir Richard Branson, the founder of Virgin Galactic, along with Chamath Palihapitiya, founder of Social Capital Heda Sophia Holdings, and George Whitesides, the CEO of Virgin Galactic. You will not want to miss that interview.
All right, PG&E is now shutting off power for 940,000 more homes in California, leaving nearly 2.7 million people without electricity. The stock getting hammered by about 20%. With one fire in Sonoma County in the north and another in Los Angeles County to the south, the planned blackout is now California's largest in history. In Northern California, gusts rolled as fast as 100 miles per hour, fanning fires in a situation that PG&E described as, quote, the most serious weather situation in recent memory. The blackouts and fires are affecting the area in and around Napa. Yahoo Finance reached out to Robert Mondavi, which is owned by Constellation Brands, which told us that as of this morning, the winery is still operating as usual. We've actually reached out to other wineries but have not heard back. So, guys, a pretty terrible situation unfolding in both parts of California. Again, in San Francisco and in Los Angeles, those huge populous areas just being ravaged by these fires. I mean, what's the impact of this going to be in your view?
Well, and it's worth mentioning that although we didn't hear back from those wineries, there are reports already of sort of just general concerns in that area for the businesses, because tourism to that area is going to, shut off completely for the next couple of weeks, whatever it is, however long the impact is. If you had a trip planned there in the next few days, I don't know what you're going to do, but you're not going to go.
No, and guys, I mean, this whole saga with PG&E goes back to last year. Remember the Camp Fire, the devastation that we saw in California. Looking at the stock, look, now it's below $4 a share, has just absolutely plummeted because of their role here. And I think now more than ever, it's just being amplified. People are talking about PG&E in a way that I have not ever seen before. I mean, I was just on Twitter, I was on social media, and you'd see people posting, all right, my power's still on. The next story on Instagram, all right, we're out, no ETA. There's a lot of frustration. California is so crucial to the economy of the United States. It's not just the wineries being impacted, the loss of homes. You're talking about businesses that can't operate.
And no one talks about their utility until the power's off. That's when you notice and complain about it.
Exactly. And this is the tough kind of situation here, is that we as a business program have to talk about the business angle of this thing. But this is a public utility that is affecting people's abilities to live in their own homes. People are fleeing right now from their own homes because of these fires. And we have to understand that PG&E, being that public utility, is currently going through bankruptcy filings. And there's this debate about what is going to be the structural solution to address this. We heard the San Jose mayor in the past say that maybe a good suggestion would be having the localities actually purchase some of the assets and some of the power lines from PG&E so that the localities can deal with it. But regardless, this is a long-term problem that California needs to address.
Absolutely, and we'll keep monitoring. We'll be right back here at Wi-Fi AM after a quick break.
Time for today's trending tickers. The first one is Walgreens Boots Alliance, the drugstore chain reporting estimate-beating earnings on the top and bottom line this morning. Thanks to dramatic cost-cutting initiatives, you can see the stock moving up about half of 1%. As part of an expense-saving plan launched last year, Walgreens has already been closing hundreds of stores across the U.S. and U.K., but the company now says it will try to cut an additional $300 million from its annual expenses. The company reported adjusted earnings of $1.43 per share on top-line sales of $34 billion. Again, guys, the story here being, let's save some money.
Yep.
I think this is a story across corporate America right now is cost-cutting efforts. So.
Well, one challenge specifically with Walgreens is that they purchased thousands of locations from Rite Aid, and now they've closed hundreds of those stores. So you kind of wonder, was that even a good idea to begin with if they purchased this huge network?
Well, you gobble up and then you close.
Well,
I mean, all these places overbuilt, too.
But also, yeah, they did overbuild. They're all in every single corner. And the story in retail is, how are you going to get people in the door? Like, what is it that's going to entice you? Because it's so easy now just to order everything online, especially when you think of, like, what you're going to buy from a drugstore. If you're not picking up your prescription.
I was just about to say, that's the one.
The only time I'll go is not just for a prescription, but I'm like, dang it, I need a cleaning product. I'm cleaning my apartment right now. Like, right now.
Yep.
And one problem
Overpriced
with Walgreens,
paper towels.
One problem with Walgreens too is, I mean, especially living in New York City, it's not necessarily brand recognition or, oh, I like Walgreens.
Well,
you just go to the closest. Well, right, but you go to the closest drugstore that's to you.
That is
and if
true.
that's not Duane Reade, then it's another store, right? But if it is Duane Reade, then congratulations, you're a Walgreens Boots.
And worth mentioning, even despite this beat, down 27% on the year. So.
Right. Yeah, having a tough time. But anyway, let's move on. Next up is Estee Lauder. Stock of the cosmetics brand is moving down by over 1% after Piper Jaffray downgraded the stock to neutral. Estee Lauder stock has been on a tear, up about 50% year to date compared to the S&P 500, which has gained about 16% during that same time. Piper Jaffray's comprehensive survey of teens from earlier this month highlighted declining spending on cosmetics, with Japanese rival brand Kosei leading the cosmetics space with its Tarte brand. Julia, apparently
Ryan, big fan of Kosei and
Tarte's
Tarte.
great. Well, Tarte's got a lot of vegan-friendly makeup. So, like, your brushes, they're not made from animal fur, I suppose. But I think that the Estee, not made, vegan friendly. The Estee Lauder story is interesting. One of the trends that Piper is referencing is this survey that came out. Teen spending in makeup is down 20%. Maybe you could attribute that to the whole Visco girl phenomenon going on of more natural, not so made up. But also, it made me look at Estee Lauder's portfolio, and they have a lot of brands that I didn't realize they own. They own MAC. They own a lot of hair product companies as well. Aveda's in there. Glam Glow, great for masks. So they have a diversified business because it's not just makeup products here, like Smashbox and Clinique and other types of makeup.
Well, we're talking about cosmetic brands and young people looking for other brands that might be more sort of
natural,
eco-conscious.
I think that's a big trend. Clean beauty is a big trend.
Right, and there was news that just came out about Shiseido purchasing Drunk Elephant. You know Drunk Elephant? That's skincare.
I'm gonna guess it's probably like a moisturizer. I don't know. I
have no idea.
I like my water-based moisturizer that I just picked up. Can't tell you much about it, but I like it. But clean beauty is here for the time being.
I mean, I think that's the story. It's consolidation. There's not many names out there anymore.
It's a disruption
right?
going on.
Yeah, seriously. So I don't know.
Yeah.
No dirty beauty.
I'm not a Visco
Like
Cam girl
beauty.
yet, so you know.
Yeah.
No, I still don't quite understand
brand recognition up yet.
If that tag means that it's been photoshopped or if it just means that it's authentic.
I think it means like you wear a sweatshirt and scrunchie and you wear chapstick.
It's been hard for me to
That's what it means.
learn what the Visco aesthetic is.
I was trying to learn because Miles wrote about it, I believe, in like the morning brief one morning. I'm like, that was the best explanation.
Because Miles is our resident Visco.
Yeah,
well, when
definitely
it comes
subscribe to our
beauty
morning
brands,
newsletter, guys.
I at least know about Ulta's Kylie Jenner lip kits and how well those did.
Yeah.
Because they were only sold in stores.
Well, Ulta CEOs also referenced recently this kind of disruption going on in the beauty space. So, yeah.
Absolutely. Okay, we're going to go to a short break and we'll be right back here at Wi-Fi AM. Welcome back to Wi-Fi AM at Yahoo Finance. All three major indices right now trading higher in the green. And as we track the 2020 presidential campaign, it's time for another Meet the Candidate segment. Today, a reminder that the people running are not all Democrats. Yahoo Finance's Rick Newman recently sat down with the former governor of Massachusetts, Republican Bill Weld, who is running. Rick?
Did you guys know he's running?
I did, because I saw the Republican debate parts of it on. No, I didn't watch it live, but I watched
the Dem debate.
No, the Republican debate that was on Business Insider,
right.
that was on like the Colbert Show or John Oliver, one of those late night comedians.
there are three.
I know because I'm from Massachusetts.
Yeah, well, there are three guys not named Trump who are running for president as Republicans. It's Bill Weld, Mark Sanford, and Joe Walsh, and they kind of call themselves the Three Stooges. Anyway, Bill Weld came by and we talked with him. Here's why he said he's running for president.
There's a lot of things I'd like to do in Washington, and I'd like the chance. And, I had 2 pretty good terms as governor, and I think I could start Monday on the job.
So tell us what you want to do in Washington.
First thing I want to do is no more trillion-dollar deficits, and that's something I did in a heartbeat when I was governor, and I was ranked the most fiscally conservative governor in the United States, despite succeeding Michael S. Dukakis as governor in Massachusetts.
Lower the deficit. What kind of old timer even cares about that kind of stuff anymore? I mean,
responsible spending.
I don't know.
You really don't hear any candidates talking about that. But I mean, at some point, this is going to matter. I mean, we just got the numbers for the last fiscal year.
Crazy.
$984 billion deficit.
Crazy.
It's gone up by like $300 billion over the last couple. I mean, we're in a good economy. The deficit should be going down. But of course, the Trump tax cut from 2017 pushing it the other direction.
Do you think that Bill Weld thinks that he has any shot at winning?
I asked him. Because I know when I come on the show, you're going to ask me, why are all these guys running when only 4 or 5 of them have a chance? You know what he's kind of thinking is, so he is a strong advocate of impeaching Trump and booting Trump from office. Now, obviously, that would benefit him personally. He has a stake in that. But, there is a small chance that could happen. So it's not 100% guaranteed that Trump is going to be the Republican nominee. So if it's not Trump, I mean, if Trump is not there, theoretically, I guess it would be Mike Pence. Mike Pence would become the president, but Pence would be a kind of a weak front runner. So maybe, there is a sort of a shot that somebody could see.
I mean, to extrapolate from this, though, Bill Weld might not win, might not the other of the 2 stooges. But I'm wondering, what does it tell you, though, about the possible base of Republican voters that are maybe disenchanted or disenfranchised by the Trump administration so far?
I mean, I don't think that Bill Weld is going to get a lot of those votes. I mean, that's not really the kind of candidate he is. He's not going for the Trump voter, which is like a Tea Party voter. I mean, he was a centrist Republican. He's a socially liberal Republican, which is why he was able to get elected as governor of Massachusetts, generally a Democratic state. Dan, some state, you can attest to that, right?
Romney, too.
Yeah, Romney. But Romney was also a relatively centrist Republican, fairly liberal on social issues. So that's who Bill Weld is. He's different from Trump in many ways. That's just one of them.
All right. Well, we'll see if Bill Weld has a chance. And viewers, you can watch Rick's full interview with Governor Bill Weld on YahooFinance.com.
He's got some good ideas.
All right. You heard it here first. Rick, stay here. We also have to talk about the GM strike. That standoff is over after 40 days. GM workers are back on the assembly lines at plants across the country. And of course, now the UAW turns its attention to talks with Ford for its next round of negotiations. So, Rick, wrap up the strike here, and then how is what happened with GM likely to affect the talks between UAW and Ford?
Yeah, GM workers are going back to work this week. Workers got pay increases that they wanted. They got a faster path to permanent status for part-time workers. So they got what they wanted on health care, which is keep their portion, the worker portion, very, very low. What they didn't get was reopening the 3 factories GM closed last year, and I think there was no way GM was going to do that. So normally, this is called pattern bargaining. Normally, the deal they make with the UAW makes with the first automaker basically just goes to the other ones, and they basically rubber stamp it. I'm not sure that's going to happen in this case. So Ford is less profitable than GM, but it has more unionized workers here in the United States. So it would be costlier for Ford to agree to the same deal that GM just agreed to. You know, GM is actually benefiting these days from having gone through bankruptcy in 2009. They were able to get rid of all the divisions that they didn't need, really reduce their footprint, get rid of a lot of unneeded capacity. And Ford has had a harder, Ford did not declare bankruptcy. They've been having to do that in a systematic way, restructuring. They've been restructuring for like a decade. So harder for Ford. We'll see how it plays out.
But it makes me wonder, because the UAW, just the things that they were able to get out of GM, wouldn't that just embolden them to go ahead and take a chance with Ford to see what they can get?
Yes, I think it will embolden them. But I'm not sure that Ford is going to be able to agree. I mean, they have to, Ford is a publicly owned company. They have to get the best deal for their shareholders. And Ford, like GM, knows that big changes are coming in the way they make cars and even in the types of cars they produce. I mean, one of the things we've been talking about with the GM strike is when we get to higher volumes of electric cars, you make those very differently. They have fewer moving parts, require fewer workers. So Ford has to get to the same place GM does. And they may have a little less wiggle room in terms of how they get there.
And then quickly, FCA is after
Fiat Chrysler would be the third. Okay. Yep.
Thinking that GM was going to actually keep open 3 factories that it had already decided to close, in hindsight, always seemed like kind of the biggest reach of the demands, because once you decide to close a factory, well, so we're not going to operate that. Why would you just be able to?
I think you're right. The way they wanted that to happen was move production from Mexico back to the United States to some of those factories they're closing. In GM, I think that was a line in the sand GM was not going to cross, and they got their way on that.
Yep. All right, Rick, thanks so much.
Thanks, guys.
Good updates. Well, esports, or competitive video gaming, has exploded in the last couple of years, with big investments being made by big brand name sponsors and tons of new companies launching to put on tournaments. One of many new companies in the industry is All-Star Esports League, and joining us now from Boca Raton is the CEO and founder, Jordan Zeitz. He is 17 years old. Jordan, thanks for coming on.
Yeah, thank you so much for having me.
So what separates you guys from competitors? We've interviewed a lot of these young, new esports companies. We had Super League Gaming on here. They put on tournaments. They were actually one of the esports companies that went public early on. Tell us about you guys.
I think we're different in that we have a fundamental understanding of what the students want, better than any other esports league, because I am a student. I am an esports player at heart. That's kind of my background and how I got started and why I got started. And so we changed a few facets of how to operate a league to make it beneficial for the students and incentivize them to actually want to play. So we are the only free high school esports league in existence. And on top of that, we have several $1 million in scholarship prizing, peripheral upgrades, grants, and more for our students. So we're really upping the game.
Hey, Jordan, it's Julia LaRoche. Congratulations to you. And I know your sister is an entrepreneur as well. I do want to talk about being a student and an entrepreneur. What has been the biggest lesson that you've learned, and how do you encourage your peers to also go after and build their own businesses?
I think the number one lesson, definitely, that I've learned through being a young entrepreneur is to not be afraid to take a chance and to take risks. Because as a teenager, especially, a lot of the time people are afraid that I can't do this. I'm not old enough. I don't have the experience. Well, nothing's stopping you from getting that experience, especially with all these tools online to learn and to kind of provide yourself with these opportunities. A lot of times what we find stops ourselves is ourselves. And teenagers are kind of afraid to take that leap and jump into the adult world. I jumped head first.
Hey, Jordan, Brian Chung here. That's awesome to hear. I want to ask you a little bit more about specifically the esports business. You guys sound like you have a lot of money that you can use to disperse those types of scholarships. I mean, how did you raise that money? Is it from sponsorships? And on that point, esports is getting huge. I mean, there were multi-million-dollar winnings for the Fortnite championship here in New York City. So do you see that growing? Do you see the ability to maybe build up more sponsorship money in the future?
Yeah, esports for sure is booming. I mean, it's taking off, especially with all this relevance in STEM as well. A lot of high schools find that link between STEM interest and esports, so that's why they're getting interest, at least in the high school scene. In terms of capital and kind of on the financial side of things, it's very interesting in that we are adamant on maintaining our 100% free status. So we do have organization sponsors that help make this possible. And we're always looking for more sponsors, especially that share our mission. But actually, our initial round of funding I received through a partner that I met at an event that I was speaking at Harvard Business School, where I met a Seattle-based investor, Eric Ben-Susan, the president of PowerA, a gaming peripheral and controller company. And we just kind of kicked things off and decided that we would be best working together on this project.
Jordan, you just mentioned STEM, which I find so interesting, is getting young people prepared for, I guess, jobs eventually in technology by just getting them exposed to it at a young age. How do you see esports playing into that? And how do you bring on someone like, say, if I'm a high school student, I wasn't the most tech savvy, I didn't play video games. Like, how do you encourage those folks to also participate?
I think what makes esports so great is that everybody knows how to play. I mean, anybody can pick up a football and toss it to somebody else, and you're tossing a football. Just like that, anybody can log onto a computer, figure out the basic rules of there's a game for everybody. So everybody has an option. They log in, they play, they've got that team environment. It kind of builds those values. And that's kind of what makes esports so fantastic. Particularly in STEM, I think what's super interesting about the advance there is that not only are people kind of preparing for jobs, but STEM jobs are more entrepreneurial in nature, which I myself love because I am an entrepreneur. But it's less trying to fit into a role when you're kind of pursuing a STEM job, and more you're trying to change the world. So computer scientists create things versus just trying to apply to be in a position. And that's why I think the link between esports and kind of STEM is incredibly relevant, because esports teams and players are very resourceful, innovative, and they constantly have to think on their feet.
Jordan, let's end on this. We're talking about high school students and esports. What do you think teachers at school and also parents think about these kids who are putting so much of their time into competitive video gaming? Has the thinking changed recently because the industry has gotten so much bigger and more serious?
The thinking's definitely changed. Throughout history, I mean, people have been very apprehensive about supporting video games, but once research came out that it's strictly beneficial for student education and intellectual development in children and teenagers, then people jumped on board, and now everybody's supporting esports. I mean, we see people flocking to us. We see schools, teachers, administrators, even parents coming to us saying, how can I get my kid involved? Not so much just for the esports scholarships, but I want my student to, or my kid to build these values and learn and build their character, learn these things.
All right, Jordan Zeitz, good stuff. Smooth interview. Thanks so much for coming on. Good luck.
Yeah, thank you so much.
And coming up here on Wi-Fi AM, Microsoft beats out Amazon for a highly coveted contract. We will explain when we come back.
I'm Ines Ferre here with Tim Anderson from TJM Investments. Tim, the S&P at record highs. Is this because of China earnings?
I think a combination of a little bit of everything. We're getting off already to a great start this week with earnings. AT&T reported this morning. The stock is up over 3%. That's a combination of both their earnings, their guidance going forward, and a settlement they have with their activist investor. And it's just setting the table for a blockbuster week of high-profile earnings reports.
What are we looking at this week?
Well, Google's going to report after the close, so that will be big for the technology space. Tomorrow will be a big day for Big Pharma with both Merck and Pfizer reporting. And then Wednesday we'll have Facebook after the close. We've got a tremendous amount of earnings in the energy sector this week that are going to be tapped off by both ExxonMobil and Chevron reporting Friday morning.
What are you expecting with the Fed?
Well, the Fed meets on Wednesday, and it's a very big week for economic data. Wednesday morning, we're going to get the first look at third quarter GDP.
What are you expecting there?
Well, the consensus is running between 1.5% to 2%. Some people have been talked down to the 1.5% range. I would expect it's maybe going to be a mild beat because productivity still remains strong, and that's kind of an underestimated influence on productivity that was very good in both the first quarter and the second quarter this year. Now, in terms of what the Fed's going to do, it's very close to being a jump ball, but I think the tiebreaker on them cutting rates at this meeting is going to be that the Fed funds rate is still above the short-term end of the curve. And for them to continue to normalize the yield curve and the interest rate structure, they want to get that Fed funds rate down below where the short end of the curve is.
Thanks so much, Tim Anderson. And make sure to stay with us. Wi-Fi AM continues after the break.
Welcome back to Wi-Fi AM at Yahoo Finance. Let's see what markets are doing right now. All three major averages higher. The Dow is up almost 190 points, or 0.7%. NASDAQ and S&P in the green as well. Time now to talk about the largest company by market cap. It's Microsoft, and it has won a $10 billion Department of Defense contract, beating out Amazon, the 10-year-long JEDI contract, or Joint Enterprise Defense Infrastructure, is for the Pentagon's cloud services, and it's a big win for Azure, which of course is a competitor to AWS, Amazon Web Services. So this continues to fuel the Microsoft story. And last week we were talking, it was after Microsoft's earnings beat, and we were talking about how kind of the collective reaction to Microsoft's big beat was not really as not as much juice as you would have expected. And I think that it just matches the Microsoft story of the last couple of years, which is this like quiet, almost under the radar, if you could call anything that big under the radar, stock growth. People don't talk about it, but it's
and look, it's being driven by the cloud business, and we're in the cloud wars. And I think this announcement, just what I've been reading, is some felt that it was a bit of a surprise, that they were expecting Amazon to win the deal here. Yes, this is great for Microsoft, not so great for Amazon, and the others who were also competing. I think it was Oracle, maybe IBM in there, a bunch of companies were vying for this contract from the Pentagon.
Yep.
So,
and reportedly something Jeff Bezos really wanted.
When you talk about Microsoft, I think maybe one reason why it's flown under the radar is because the cloud business is not as sexy as maybe hardware was back in the 90s and 2000s, right? I mean, yeah, we call it cloud, and that's as exciting as we could possibly make it, but I mean, it's just kind of pie in the sky data, right? I mean, so, but I think what we need to understand here is that this is the new age. I mean, the Department of Defense and, the government signing this contract with Microsoft is a huge deal, arguably as big as when, defense contractors used to sign a deal with Northrop Grumman or with ATK or what have you. So I think that as we get into future contract negotiations, whether or not it's with the United States or with maybe another government that's trying to get these cloud services, we got to pay attention to where they're going to. Is it IBM? Is it Microsoft? Is it AWS? And I think that competition can only heat up among those big competitors from this point on.
Yeah, and I agree with you also that, I'm not sure the average layperson really even understands cloud.
No.
And so we use this buzzword. Just recently, I was discussing how cloud is now already evolving to the next kind of stage, which is edge computing, and basically moving servers closer to the place where you're gathering the data from. Another thing, though, that it's really hard to make exciting to people, but a huge business. You're right, it's the cloud wars.
Cloud wars.
It's hard to make it enticing, though, to people.
Well, speaking of going into the clouds, it's time for our Musk Minute. SpaceX is ramping up its plans for flying people to the moon, and that is today's Musk Minute. SpaceX president and COO Gwynne Shotwell has outlined a timeline for when SpaceX will start flying people on its next generation rocket to the moon and Mars. The company raised more than $1.3 billion this year to build the Starship rocket and its high-speed satellite internet network, Starlink. She said, "We want Starship in orbit next year. We want to land it on the moon before 2022 with cargo and with people shortly thereafter," Shotwell told investors at a conference. Guys, just
ambitious.
Seem like, I was going to say, a very ambitious timeline. What do you make?
Yes, it's not going to happen, but SpaceX and Elon Musk and his people say things all the time that
they have a record.
It doesn't matter. Yeah, they just say things.
I just love that her name is Gwynne Shotwell. Like, that is like so.
A moonshot.
Right.
It's
I'm head of our moonshot division.
It's a great, it's an aptonym. I like names that go with your business. Vocabulary word, study that for the SATs, kids.
I mean, another point, though, to kind of bring this back into the business angle is that it's amazing to see what SpaceX is doing in contrast to what Virgin Galactic is doing today. Which is right. They're
listing.
IPOing, they're listing, and I think that represents these kind of two diverging ways to raise capital. Obviously, SpaceX doesn't feel the need to go public or be listed on a public exchange because they have so much capital right now. These comments were made at an investor conference, so obviously they feel like they have enough money to send someone to the moon. I mean, that just shows how much money is really flowing in the valley to be able to do this type of capital raising.
Yeah, I don't know. It makes me really nervous to even think about getting on one of those. And then nobody's talking about Blue Origin, which
I was
is
just
Jeff
about to say,
Bezos
let's
is.
remember Bezos is in this business.
Yeah.
Brian, when you say SpaceX doesn't feel the need to be public, I would say not just doesn't feel the need, but Elon Musk would like to not be. We know how much he hates, reporting earnings, having shorts and bears talking about the stock, wanting to take Tesla private. I think would much prefer to not be in charge of any public control.
I don't want to conflate this with, bringing in WeWork again. God help me if I have to say that word again. But the thing is, we understand now just how much money is flowing in private markets, right? And when you are raising that money in private markets, it's a lot easier to go to an investor and sell a literal moonshot and raise money still than putting that in the public market and letting investors publicly decide that.
And going to space is so expensive, but it's really cool to see big entrepreneurs take on this endeavor. I think people do get really excited about it, but I mean, going back to Branson, though, Virgin Galactic, they actually have people who've already purchased the $250,000 tickets. Now they're going to like the edge of space orbit. I don't know the exact terms. They're not like going to the moon right now or anything, but I mean,
if you can't go to the moon, why go?
At one point, they were selling the tickets using Bitcoin, so man, maybe you got a good deal back in the day.
We understand and recall the lessons of we. So thank you for mentioning that. Yeah, it is funny. I appreciate, and all cynicism aside, I always have my sort of cynic's hat on when we talk about these companies and these CEOs. But I do appreciate those few CEOs who are focused on things like this because it is something that's not going to come to fruition really until probably after they're gone.
Yeah.
When we talk about Jeff Bezos, it's sort of widely understood that space is actually the most important thing to him. Colonizing Mars, I mean, that's like that's the thing he most wants to help happen.
Could be the story of the next generation.
Won't happen in his lifetime, exactly. All right, let's talk now about Facebook. Facebook's stance on political ads is under the microscope again after Facebook announced on Saturday that it removed an ad that falsely said that Senator Lindsey Graham supports the Green New Deal. The ad was posted by the Really Online Lefty League, which is a left-leaning political action committee. And that PAC made the ad after Alexandria Ocasio-Cortez asked Mark Zuckerberg last week in his hearing what would happen if she posted ads saying that Republicans backed the Green New Deal. And of course, Mark Zuckerberg had some trouble consistently answering the question of what Facebook would take down and what it wouldn't. We remember that Facebook refused to take down an ad that someone posted as kind of a test, a prank, that said stuff about Mark Zuckerberg. It was a deep fake about Mark Zuckerberg, but it did take this one down. So is this inconsistent? Consistent?
I think it's illustrating a broader point that Alexandria Ocasio-Cortez brought up during the hearing was like, this is not going to go away. I doubt this will be the first one. More will come, and will they be taken down? I mean, you're going to point and say, well, you took the one with Lindsey Graham down, so why don't you take this one down? This issue's here to stay.
Well, Elizabeth Warren posted
I was just going to mention that one. It said that Zuckerberg supported Donald Trump or something, and that just wasn't true. But they did not take that advertisement down. I think that you bring up an interesting question, which is that Zuckerberg was on Capitol Hill last week being asked, what are the standards? And when you ask the question about consistency and inconsistency, not to defend Mark, but it's hard for him to say something in that hearing that would define the line, because then that sets a kind of de facto precedent for Facebook to have to follow down the line, when in reality, these types of content things are, I mean, it's very gray area. And you have to understand that I'm sure there's some sort of standards floating around at Facebook about what should or should not be taken down or what does qualify as false or not. But as we understand, it's not so binary. It's not so black and white in many cases about what is true and what's not true. In this case, it seems like it was very clearly not true, much like the Elizabeth Warren ad, but Facebook decided to take one down, keep the other one up. So it does seem kind of inconsistent.
I see Elizabeth Warren illustrating a point, though. That's what I'm thinking. The Elizabeth Warren one was really bringing up a bigger point. And if they did take it down, people would be like, oh my gosh, you took down the thing that she was trying to illustrate a point about what you guys are doing. So unless they go through and take every single one down.
Well, I mean, I'm with you in the sense of not to defend Facebook, but this ain't easy. This stuff ain't easy.
And even in this case, I mean, you can make the argument that, they both have false information, but maybe the Elizabeth Warren ad, because at the bottom of the ad, it did say that this is a lie, so that maybe like it's perceived irony. Well, how do you bake in perceived irony into standards for your moderators to decide what to keep up and what to take down? That is extremely difficult. So it's not.
You got to put humans on the case, and they don't want to. They have hired some humans to do news now in the newly launching news tab. But do they want to hire a big team of humans, and it would have to be a lot of people to moderate the factual veracity?
I sure do miss those simpler days of just what's your status, what you're doing.
Everyone should be on Pinterest, right?
Long dead. Right, Pinterest. No trolls. Okay, coming up here on Wi-Fi AM, one of your favorite American jewelers could be sold to the French. We'll discuss after a quick break. Welcome back to Wi-Fi AM at Yahoo Finance. Tiffany, the iconic American jeweler, could be selling itself to French apparel company LVMH. LVMH confirmed today that it did make an offer of $120 a share, or $14.5 billion. Yahoo Finance's Heidi Chung is here to talk more. So Tiffany, up for sale.
Yeah, well, not necessarily. So LVMH confirmed that it is in preliminary talks with Tiffany. Now, the exact numbers are not exactly confirmed yet, but allegedly, according to some reports, $14.5 billion, about $120 per share. But the stock is soaring more than 30% this morning for its best day ever.
Now it'll have to pay more.
Great for day trader.
As often happens. Isn't that always ironic when a potential takeover report causes the stock of the target to go much higher, and then it has to end up being a bigger price?
Right. So the Financial Times reported that Tiffany said that they think this is undervaluing them, and thus plans to reject the offer. So they probably will revisit the actual figures in this proposed deal. But I mean, this makes a lot of sense, right? Tiffany's has been struggling over the past several quarters, not just several quarters, several years. It had a new CEO that took over in 2017, and he actually previously was at LVMH and worked at Bulgari, which is the luxury jewelry company under the LVMH umbrella. So LVMH actually doesn't have that much exposure to the luxury jewelry market. So this would be a good way for them to not only capitalize on the luxury jewelry space, but also the US market. So yeah, it makes a lot of sense, but there's also more rumors out there that other companies are also looking to potentially buy Tiffany, but Tiffany just has that iconic brand name, right? Even though it's so overpriced.
It's iconic, the blue box.
Wearing the color.
I mean, I want to know, like, my dress is Tiffany blue, but my ring is not Tiffany. I want to know, like, what is the play here to turn things around for Tiffany?
Yeah.
Because, I mean, these are sluggish sales. I mean, when I think of Tiffany, I think of Elle Woods' necklace from Legally Blonde.
Right, so that was so in.
I don't know what the bean
Yes,
is, but
yes. But that's the thing with Tiffany. So a lot of the stuff that sells well for them, it's usually priced between $300 and $800. So it's usually the sterling silver that's been overpriced. Okay. A lot of people back in the day bought stuff like that, the Tiffany heart necklace that Elle Woods wore in Legally Blonde. But these days, they don't really have a clear strategy in terms of who they're really marketing to. If you look at all the new stuff that they've done, the collaboration with Elle Fanning.
No, I don't.
Yeah,
know.
You don't know anything. Dakota Fanning's sister.
I'm so lost
exactly.
right now.
I know that they were big for the Chinese consumer, but I mean,
tourists
how
visiting
long does
the
the
US.
Chinese consumer stay strong? So.
But maybe LVMH is saying, well, the consumer still looks strong, and specifically within the luxury space, LVMH has been crushing it.
Yeah,
Wow.
yeah,
All right.
they have been.
Heidi, stay right here because we also had Restaurant Brands earnings this morning. That is ticker QSR, and a lot of known chains within that portfolio. Heidi covers that space closely. How did those earnings go?
Burger King Impossible Whopper, Popeye's chicken sandwich is literally all you need to know.
Sandwiches.
And Tim Hortons continues to stink for the company. That one did not meet expectations in terms of same-store sales growth. It actually declined 1.4%, which was way worse than anyone was expecting. But the Popeye's chicken sandwich did extremely well for the company. Here in the
Even though
US,
they ran out?
same-store sales growth was up 10%. Just in those,
And you
because of
can
those
put
2
that
weeks.
on the sandwich.
Right.
So similarly, do we know yet from the earnings, did the Burger King Impossible Whopper have a direct effect on foot
Management
traffic?
exactly said that. It definitely boosted sales for Burger King. So here in the US, they saw comp sales up 5%.
But the stock is down 3.5%. So
Tim Hortons drag.
So it didn't make up for the gains from the.
I think investors are increasingly worried that Tim Hortons literally cannot turn this corner. It has continued to underperform expectations for a really, really long time. And even with that launch of the Beyond Meat breakfast sandwiches, remember they pulled it from most Canadian stores except for Ontario and British Columbia. So, I mean, we need to figure out what's going to happen with Tim Hortons before everyone can get excited
I really
about them.
liked Tim Hortons. I had it when I was in Canada. I've never had it in the U.S. They don't have much of a U.S. presence. They might have a little store in Times Square, maybe.
But they're competing with Dunkin' and Starbucks.
Coffee and donuts,
Yeah, it's coffee and donuts, but it's pretty delicious. I mean, who doesn't like coffee
But
and
if you
donuts?
had the option to go to Dunkin' or Starbucks,
Starbucks,
are you going to
sorry.
choose Tim Hortons? Exactly. So I think that's the concern going forward. But
I
Popeye's
like that
crushing
Impossible
it.
Whopper.
Oh.
I'm embarrassed.
I haven't had it yet.
I really liked it.
It's
I
good.
thought it was great.
And Popeye's chicken sandwich coming back on Sunday, guys. So
I
I'll
wanna
be all
try
over
it.
that.
Wow,
Yeah.
epic.
Okay, do we know what their supply is going to be like? Like, how do we know?
On a
How do we know
Sunday.
that it's not going to sell out instantly again?
So management saying, well, because it took so long for us to come back, it took them 2 months to figure out the supply chain issues. They're saying it's going to be back, and it's going to be back for every day thereafter. So that's their promise going forward.
Get rid of
more
it.
chicken.
I love that they're doing it on a Sunday.
Yeah, did you see
Chick-fil-A?
Did you see
tell us
that
about the
tweet?
ad, yeah.
So the ad was actually a man walking up to a freeway sign like that, and then they put on the Popeyes, open Sunday, and that's when they're launching it this Sunday. So it was also a strategy. Obviously, Chick-fil-A is the one who actually sold.
Rude.
This is capitalizing on the new
Shots
Kanye
fired.
West song from last week.
which,
closed
yes,
on
yes.
Sunday.
I just want to eat that chicken sandwich. I've never had it. It looks so good.
All right, come back on when you can bring
I
the
will,
sandwich,
I
please.
will.
Okay, thanks, Heidi.
Yeah, thanks,
And we'll
guys.
be right back here at Wi-Fi AM after a quick break. I was on the grill, baby. Welcome back to Wi-Fi AM at Yahoo Finance. Alibaba's Singles Day is coming up, and Taylor Swift is heading to China to headline the event. She will perform at Singles Day next month in Shanghai, and that is, of course, just 1 month after she also performed at Amazon's Prime Day celebration. You might see some irony there. Taylor Swift will be featured in the televised and live-streamed concert ahead of that 24-hour shopping extravaganza. And of course, some people have seen Prime Day as a little bit of a response to Singles Day. Singles Day, I believe, has actually been going on longer, or is it vice versa?
This will be the 11th Singles Day. It started by the current CEO of Alibaba, Daniel Zhang. And it goes, actually, the genesis of Singles Day goes back to the early 90s. Those college student men who were single in Nanjing who were, I don't know if it was actually on 11/11 per se, but 11/11 is like a bunch of single people feeling for digits. But Taylor Swift will be headlining the Countdown Gala, which, guys, it's unlike anything you've ever seen. Like, people tune into this variety show to watch. And it's like, okay, who gets that excited about shopping? Well, the Chinese consumer does, and brands are still excited for Singles Day. They're expecting Singles Day to surpass $30.8 billion in gross merchandise value. That's what they did last year. 500 million shoppers in China, 200,000 brands, lots of U.S. brands who want to get access to this market. And it's also great for when you're the entertainment or the headliner here. Pharrell did it 1 year. Nicole Kidman was there when I went just 2 years ago. She wasn't singing, but she was there presenting. I mean, you're also exposing yourself to that audience as well.
Right. Of course, she's already probably big in China, but
I was going to say, and she's also done other corporate events too, right?
Yeah,
Hasn't she done the
so I was about to ask, like,
I'm sure she's not doing it for free.
Well, are we past the time? Oh, not at all. Are we past the time when people would say, "Oh, sell out, corporate shill"? No one cares. Like our colleague Miles Other, one of his favorite phrases is like, "You know what's cool these days? Selling out." People applaud that.
She
like,
already sold out musically.
Get that money.
She already sold out musically, so it's whatever. Yeah.
Ooh.
Sorry, I'm not a fan. I'm not a fan.
Ooh.
I'm not a fan.
I'm a fan.
I
and
still
will
listen
be
to
seeing her
T-Swift.
at Gillette in the summer.
Look, Love Story is one of my
For the
favorite
third
songs. I
time.
just don't like her new stuff. 1989 was decent. It was okay.
Oh my
It was
goodness.
okay. It was all right.
Golly gee.
I'll never be on the show again.
And Julia, Singles Day bigger than Prime Day.
Much bigger.
Can you stream Singles Day here in the U.S.?
I actually have no idea. I would assume Alibaba on their site, Alizilla, might let you stream or. I actually don't know the answer to that.
Okay, if they're smart,
I've never watched their variety show here in the U.S.
Right. All right. Well, if we can tune in, we will, but Brian Chung will not be tuning in.
Nope. Don't care.
All right, Baba scores with Taylor Swift. Thanks, guys. That is Wi-Fi AM for today. Thanks for watching. We'll be right back here tomorrow at 10 a.m. But don't miss On the Move. That show starts next. And today, as we mentioned on the show, they will have a live interview with Sir Richard Branson. You don't want to miss that. On the Move starts in 2 minutes.
11 a.m. here in New York City, about 90 minutes into the trading day. Stocks are rallying, and guess what? That means the S&P 500 has hit a new intraday record. The Dow and the S&P also up pretty handily today. Buying the little blue box, Tiffany shares surge as LVMH makes a nearly $15 billion bid for the high-end jeweler. Brexit extension, where things stand as the EU gives Boris Johnson even more time to finalize the UK's exit. And a new frontier for investing. We'll speak to Virgin Galactic founder Sir Richard Branson as his company becomes the first in space tourism to hit Wall Street. Welcome to On the Move. I'm Julie Hyman. Adam Shapiro's at the New York Stock Exchange. He'll be speaking to Branson and Company in just a moment. But let's get to our top story today, and that is the rally that we're seeing, putting the S&P 500 at a new record high, breaking above that all-time high that was set over the summer as strong earnings and progress on a U.S.-China trade deal lifted the index. President Trump celebrating the record on Twitter, saying the S&P just hit an all-time high. This is a big win for jobs, 401ks, and frankly, everyone. Our country is doing great. I want to introduce this hour's panel to discuss Yahoo Finance's editor-in-chief, Andy Serwer, and Sabeel Marcellus. So we've been waiting for this record to happen, right? And it's so interesting when these records occur, because if you look at the sentiment indicators out there, they're sort of like, meh, not that enthusiastic. And yet, somebody's buying.
But that's perfect because it's a little bit of the wall of worry theory, right? In other words, you don't want everyone to be all bullish because, of course, that's when you get one of these blow-offs and irrational exuberance. And, you know, I think it's more that there's a paucity of bad news out there today. I mean, there's some good news. There's, you know, the killing, if you will. I mean, killing's not usually a good thing, but in this case, one of our enemies, the leader of ISIS, and then the China trade deal, the Brexit extension, the earnings are pretty good. And so if you look at that picture, it may not be wildly, incredibly amazing, but there's an absence of bad news and the trend is up.
Well, and the drumbeat has been that there's going to be bad news. A recession is coming.
Exactly.
Tariffs are going to weigh on earnings. And that a lot of those things haven't materialized, or at least not yet.
Yeah, absolutely. When we look at the earnings, we see that these companies are holding up. We've got the CEO saying the right thing, saying that the U.S. consumer continues to be strong. That's what we like to hear. And when it comes to the trade war, President Trump is making progress. The mini trade deal, it's supposed to be signed in a couple weeks. Last week, the White House giving some optimistic news about progress there. And the market loves to hear that. So it's not surprising that we're seeing the S&P 500 hit record highs now.
Of course, we'll see if it actually happens, as always. Something else
Bring them along.
Yeah, something else that could be helping things. Some M&A activity, or at least potential activity. French luxury goods giant LVMH eyeing a takeover of iconic New York jeweler Tiffany. The company reportedly approached the jeweler with an all-cash proposal earlier this month that would value Tiffany at about $14.5 billion. So a lot of analysts are saying this makes sense for LVMH, right? They own Bulgari. They own a lot of other luxury brands, but this Tiffany not quite as high-end as Bulgari, right? So this would expand their repertoire.
Yeah, I mean, I think that some people have indicated that they believe Tiffany's kind of topped out. You know, it's had a tough time really kind of growing beyond where it's been, say, for the past several decades. It's an iconic brand, but growth is slow. The watch stuff apparently never really worked for them. China is a difficult proposition. And on the other hand, LVMH has been sitting pretty and doing very, very well, executing in a way that Tiffany hasn't.
Yeah, and one of the reasons why LVMH, which is Paris-based, really wants Tiffany's is really because of the little blue box. I mean, it's iconic, and they value it at $14.5 billion. And for Tiffany's, it's absolutely the right move. Like you said, Andy, they've struggled to really grow their sales. They've tried to advertise more to same-sex couples, advertise more to minorities, but they've struggled to really achieve more growth, even though they do have $4 billion annually in sales.
The last couple of years, they've come back a little bit, though. They have a new CEO, and he's managed to change the marketing, to your point, a little bit and improve it a little bit. So things have been a little bit better. Also, I've been seeing a lot of analyst chatter that $14.5 billion is actually not high enough, that Tiffany might be able to get an even richer valuation from LVMH.
Well, from a news standpoint, Julie, we haven't heard the response, right? I mean, this is a story that there was an offer and the stock is way up. But to your point, I mean, maybe there's stuff going on in those boardrooms at Morgan Stanley or Goldman Sachs or JPM where the two sides are sitting down together and talking it out and trying to see if they can, you know, get a deal. And to your point, if Tiffany can get more cash out of them.
And let's remember, Tiffany's has also been dragged in with the Hong Kong protests. They had to apologize because the Chinese model had put her in an advertising. She had her right hand on her right eye, which is like iconic of the Hong Kong protesters.
Oh, I didn't see
the
that
eye
one.
patch. So they've also been dragged into that. So that's also weighing on their luxury sales, the whole
Well,
situation
and
there with China.
yeah, it's like the Chinese will come back and just, put you in a penalty box, and there's $1 billion of sales or something, right?
All right, let's get to Brexit, guys, because we have yet another development. The European Union has agreed to extend the Brexit deadline again, this time until January 31st. This gives the UK more time to hold an election. Let's go to London. Yahoo Finance's Tom Belger has the details. Now, the EU gave this extension, but they also said you can't change the deal, right? That's sort of the condition for it.
Exactly. This week was supposed to be the historic moment Britain left the EU, with Prime Minister Boris Johnson promising just a few months ago that Britain would leave this Thursday, come what may, do or die. So it's quite a humiliation, today's confirmation of EU leaders agreeing Britain can stay in the club until the 31st of January. Although Britain could leave earlier if Parliament approves the deal, as you say, agreed with Brussels before that date. The delay's really been on the cards for ever since Parliament effectively forced Boris Johnson to request it against his will. So the pound's reaction has been fairly muted, as this was fairly priced in, though businesses have certainly welcomed it. More importantly, though, it now paves the way for a general election, with MPs set to vote tonight on holding a public vote in early December. His hope really is on getting enough MPs to get his deal through, enough to take him through the next round of trade negotiations after Brexit and really end the political paralysis in Britain. But his predecessor, Theresa May, though, made exactly the same gamble 2 years ago by calling an election in 2017 in pretty similar circumstances. And it didn't end too well for her, with that election seeing her actually lose MPs, lose control of the Brexit process, and ultimately lose her job.
So when you look at how the situation might unfold for Johnson, obviously he came up after Theresa May. Besides Jeremy Corbyn, are there any other leaders that are chomping at the bit to sort of take over this mess?
Well, British politics has been very much a two-horse race for a long, long time. But certainly it's interesting. Labour, the leader Jeremy Corbyn, has really been slightly marginalised in proceedings at the moment, with the rival parties, Liberal Democrats and Scottish National Party, coming in behind Johnson to back an election, whereas Jeremy Corbyn risks looking potentially out of touch politically by failing to back that election. He says he fears Britain could be dragged out still without a deal, but with an extension until the 31st of January, those other rival parties are looking set to back the government and how to have an election to shape the future of the country. Corbyn is very much going to be painted as a coward.
Interesting. All right, Tom, thank you so much. I know both more and less about UK politics than I ever thought I would, because there's still so much about this that I don't entirely understand, admittedly. But, we've been talking in recent weeks about the whole Brexit situation, and it seems like people are pretty well prepared. We talked to an official from an Irish economic agency last week who said Ireland's ready. They've already made all the moves that they need to make. So I wonder economically what shoes are left to drop.
Well, I think there's still a lot of uncertainty out there, especially when you think about hiring. Businesses hate this kind of thing. It's like, how can I plan for the future when I don't know what's going to be happening with Brexit? So when it comes to the European ambassadors, this is the third delay they've offered Prime Minister Boris Johnson. And the question is, does it even help at this point? I mean, they can grant him another delay, but the dynamics on the ground domestically have not really changed. And also it brings up the question of how long is Prime Minister Boris Johnson going to be in power to continue to negotiate this? And when is pressure going to mount for him to then step down? And who would replace him?
Right, and what's interesting, Sabeel, is that French President Emmanuel Macron has been playing the bad cop here and, trying to say, I'm not going to give you guys, being the British, another extension, but he was convinced, apparently, to give another extension to the Brits as part of the EU because Johnson agreed to have this election in December. Now, the Brits don't like to have elections in December. They call them Christmas elections. They haven't had a Christmas election since 1923. And this election could possibly happen on December 22nd.
Ooh.
And, that's, okay.
Possibly being the key word there, right?
Yeah, I mean, right. Possibly being the key word with everything.
What kind of participation do you have
all kind of crazy
when everyone's on holiday?
And
right?
you know, I mean, I hate to say this, but Vladimir Putin just loves this and watches the whole thing just spiral down. And, you know, it's not good for anybody except maybe some lawyers somewhere. I mean, it's just crazy. And there's no end in sight.
No, even with that January 31st deadline, because
Right.
do any of us really believe it?
Well, Macron's hoping.
Yeah, I guess so.
Right?
All right. Okay, coming up, we are going to go to infinity and beyond, or at least down to the New York Stock Exchange floor, where we will hear from Sir Richard Branson. His company, Virgin Galactic, it has begun trading today. Their shares are up by 7%. Virgin Galactic launches on the stock market. Sir Richard Branson's company became the first public space tourism company ever this morning. Those shares have been rising in their trading debut. Let's go straight now to the floor of the New York Stock Exchange. My co-host Adam Shapiro is there to take off. Adam?
Julie, thank you. And of course, we have Sir Richard Branson with us, but also some very important people who are part of this big day. We've got Chamath Palihapitiya, who is one of the men who made this possible, bringing this company to the public, as well as the CEO from Virgin Galactic, George Whitesides. Mr. Branson, let me start with you. When is that first flight? You're going to be on board, and who's going with you?
It will be next year. We've got something quite exciting happening, which we will be announcing soon as to who's coming with me. So watch this space.
Watch this space. But when we talk about space tourism, we're talking about the one vehicle that is flying now, and in February actually went up into the mesosphere, the edge of space, and that is the Virgin spaceship Unity. It's being fitted right now for the passenger cabin. Capable of taking 6 people. You'll be one of them, but is it Leonardo DiCaprio? Is it Ashton Kutcher? Who else?
No, I would love to see you again, so we're going to have another announcement. But okay. Yeah, as you know, we like to do things with a little bit of a splash, and we're going to have something quite exciting.
So this is a splash, and we're talking about a business, Chamath, that obviously you see a growth potential. Where is it? Because in previous interviews, despite having the 600 reservations, the $80 million in deposits, and the $120 million in potential revenue, how do you grow beyond that if there's only 2 million customer base out there?
Well, I think that we don't really know what the total customer base is, except to say that I think if you survey people in general, most people would raise their hands and say if they could go to space, they would. So really what we're doing is what many other businesses before us has done, which is you start with a beachhead, right? This is an incredibly technically complicated business that's taken Richard and George 15 years and $1 billion+ of capital to build. So today those tickets are reasonably expensive. That being said, over the next 5 to 10 years, we'll be able to sort of work to make it more efficient, make it more cost effective, and as the price goes down, the total addressable market should go up. The best corollary to this that we've seen before, if you think about Tesla, they start with the Roadster, they start with the Model S, and now where is their commercial success? How do you build a $60 billion company? It's by servicing the mass market. And similarly, I think we'll be on that path over the next decade.
When you talk about Tesla, by the way, they've got a Roadster already on its way past Mars. But when you talk about bringing the cost down, how do you make this accessible? Because a ticket right now is $250,000. But a geek like me who wants to do this, how do you bring it down so that I can afford it?
Well, I think George is probably the best capable of answering it. But let me tell you from my perspective what I saw. The greatest thing, if you're thinking about trying to bring costs down, is to actually know that you have an incredibly profitable business as it is. And the reason is because those profits help you figure out how to innovate such that you can actually bring costs down faster than you thought. And this is a business that has almost 70% operating margins, which means that it is as good of a business as a Google or an Apple or a Facebook.
How do you bring those margins, though? How do you protect them, but then bring on more aircraft or spacecraft, rather? Only one flying now. What does being at scale? Because I think Chamath actually was quoted in a previous article that mid-next decade, you'll be at scale. What does that look like? How do you get there and protect those margins?
When our run out, we project out 5 spaceships operating by 2023, and that'll offer a fair amount of capacity into the market. Not a huge amount, but like a fair amount, so that we'd be flying about 1,500 people a year. Which is exciting. And the way that we bring the cost down is the way that any other aerospace business brings their costs down, right? They learn how to build things faster, cheaper, better, and so we've already instituted certain manufacturing efficiencies in our rocket motor production process and in our spaceship production process. And what's really nice about our business is that actually adding another spaceship only requires that we add another 10 to 15% more people down at the spaceport. And so you can tell that basically the business really starts to sing after 2 or 3 or 4 spaceships, because your labor, your incremental labor is not actually that much more. So those are all the things that we'll be using that enables us to drive down that cost.
In a perfect world, when you're at scale, how much is a ticket going to cost me? I'm not a billionaire yet.
Well, yeah, I don't know.
The danger of us saying nobody will buy and they'll wait 20 years for that. But I think if we have 20 or 30 spaceships, which I think we will, in 20 years' time, the price will come down dramatically. That's all I think I can say. I think what we'll do is we'll exhaust the amount of people who can pay the 250,000. Then we'll. But by then we'll have a number of spaceships. We'll be able to bring it down to 200, then we'll be able to bring it down to 150, then 100, and so on.
So let me ask you this, though. Is this really a space tourism company, or is there something else here? For instance, Boeing created United Airlines to create demand for the product it made. Are you creating a product, the spaceship, that would be used for hypersonic travel, cutting the route from New York to Tokyo from 14 hours to 90 minutes? Is that really what's at play here?
To a large extent, it's part of what's at play. So Boeing have just invested in this company
$20 million.
Because they want to work with us in turning that into a reality. So in the future, we're the only spaceship company that are actually building spaceships that are shaped like airplanes, and therefore it's much easier for us to make them bigger and bigger and go point to point than it would be, for instance, for Elon or Jeff, because they're building big, more conventional rockets.
When you bring up Bezos, Blue Origin's actually making plans, perhaps, as is SpaceX, maybe take people to the moon, whereas it seems your play is keep it up to space, but maybe point to point. Chamath, I want to ask you something. This is very cool. You were part of something very cool years ago, which we call Facebook. What advice do you have for Zuckerberg? I mean, you had to watch those hearings last week, and you've been critical of Facebook in the past. Do you still let your kids not use social media? And what advice do you have them? No social media?
I do not.
Why not? And what would you say to Zuckerberg?
I mean, from my perspective, I just think that there's a pretty positive correlation with too much device use and social media at too young of an age, and frankly, a lack of really good mental health. And so I would like my children to just grow up in a really natural environment with the world outside, playing, running, winning, losing, failing, all the typical things that a child needs to do to build a robust sense of self. And then eventually, when they can afford it, they can buy a phone and then they can get on these social media sites. I have not used them myself for 6 or 7 years, and I find myself to just be in a much better mental state as a result.
So let's bring it back to space. Now, each of you, I'm going to start with George. What's the coolest part about this? I mean, we can talk numbers, we can talk investors, but this is just really neat. For you, what's the cool aspect?
For me, really, what it is enabling people to accomplish their dream, right? Like we have 600 plus customers who've already signed up. We have 3,000 plus people who want to buy tickets. These are people who have, in many cases, dreamed about flying to space for decades since their childhoods, and we're going to actually make that happen. And to me, that's just really inspiring.
Shamath?
Well, in my perspective, like I've been lucky to be around entrepreneurs who just find incredible ways of inventing things that haven't been seen before. And the reality is, as Richard said, yes, it's a plane, but yes, it's also a rocket ship. Yes, it may eventually be able to go hypersonic. The totality of that, to me, I find deeply inspiring. And the exploration of, life outside of just the Earth in which we live, I think is really important for humankind. So for me, it's just an opportunity to be around great people and help usher that along in my own way.
And for you, you launched this in 2004. You defied the critics. What's the coolest part for you?
Only 500 people have ever been to space, and that's including the Chinese, the Americans, the Russians. And we have the capability of putting hundreds of thousands of people into space in the years to come. And that's ridiculously exciting. And so, here we are on the floor of the New York Stock Exchange, launching the first spaceship company, and it's going to, the resources we get from this are going to enable us to do wondrous things.
Gentlemen, thank you so much for being here. It is exciting to be on the floor of the New York Stock Exchange. I'm going to put in a shameless plug for myself. It would be far more exciting to join you on that first flight in 2020, and they're promising that flight with Mr. Branson on board. The first flight will launch from Spaceport in the next 12 months or sooner. Back to you, Julie.
I know that space geek Adam Shapiro is very excited to be there talking about this today. Thanks, Adam. We'll see you back here in a little while. Let's get back to markets more broadly now. The S&P 500 is hitting another record. Tech is leading the way higher. Yahoo Finance's Jared Blickry's at the Wi-Fi Interactive touchscreen. Jared.
Yes, well, we have the S&P 500 at a record high, as you just said. Dow Industrials up over 100 points here. NASDAQ is up the most, 0.8%, and the Russell 2000, that is up nearly 0.9%. Here is the intraday price action as it has unfolded, actually gapped up to a record high right on the open and maintaining right near highs most of the day here. Let's take a look at the 10-year T-note yield, because that is up 5 basis points, and with that we have financials surging as well. And let's take a look down here. We got WTI crude futures. They're down 1%, and that's after reaching about 56, 57 earlier. That is a resistance area that we've been watching. And now let's go to the Dow Jones Industrial Heat Map, and we're going to see Apple at a record high, up 0.75%. Let's just bring up the chart. This should be a year-to-date, up 57.5% for the year. Not bad. Microsoft also at a record high. It's up 2%, 41.5% year-to-date. It is now gapped above this resistance area. This bodes well for tech software, which has been under a bit of pressure lately. Nike is down 0.5%. McDonald's down 1.25%. But again, financials doing well. JP Morgan, guess what? Another record high, up 0.5%. Goldman Sachs, for its part, up 1.4%. Julie?
Thanks, Jared. And we're watching shares of Microsoft as well. They're on the rise today. This after the company beat out Amazon for a massive cloud computing contract with the Pentagon. It's called JEDI. It's worth $10 billion. With us now to discuss that and tech more broadly is Michael Sheldon, Executive Director and CIO at RDM Financial Group at Hightower. Michael, thank you for being here. I wanted to ask you about Microsoft because when we see tech right now, the sort of FANG trade has lost some luster. but Microsoft maybe single-handedly has taken its place momentum-wise. Are you a Microsoft holder? I know you watch it. And how big of a deal is this contract?
It's a pretty big deal because it verifies the fact that that's a big part of their business, and they're also a large competitor with a strategic focus on that. In terms of individual stocks, we're not really, unfortunately, supposed to mention individual stocks, but we own a lot of the cloud-related companies, and we try and incorporate technology into our portfolios in a number of ways. There are some very exciting areas if you look ahead in things like cybersecurity, artificial intelligence, 5G, and the cloud, for example. If you look at some of the top cloud providers, for example, they're growing their revenues at about a 50% rate on a trailing 12-month basis. And according to some recent research from Goldman Sachs, the sector is only about 8% penetrated right now. So there's a pretty good runway as you look ahead to the next several years in terms of cloud and its contribution to technology.
Hey, Michael, I want to ask you about another cloud company. I know you're not allowed to talk about specific companies maybe, but it's Amazon, right? And so my question is, what's going to stop this company besides the Department of Justice? And, are you concerned about that? Because to me, it looks like the growth going forward is just inexorable in so many different areas, AWS being one of them. But aren't they just going to run into Washington at some point?
Well, that's an issue for many of the large tech companies, the potential for legislative problems and restrictions. Depending on, obviously, who gets into the White House next, that could become more of an issue for some of these large technology companies. But I think that's going to be something that investors are just going to have to deal with over the next few quarters, in the next few years. There's been some talk that if some of the large tech companies were to be split up, the pieces might actually be worth more than the whole. So it's not really clear whether that's true or not, but I think legislation and issues like that are something we'll have to deal with. Ultimately, if companies like the one you mentioned get into too many fields, that could bring more ire from Washington. But for now, many of these companies are doing pretty well.
So Amazon clearly facing antitrust scrutiny, but how does Amazon fare seeing that Microsoft got this $10 billion contract with the Pentagon? Where does that leave Amazon?
Well, I think there were certainly some political overtones to this happening. Jeffrey Bezos, owns the Washington Post, and Trump wasn't too happy about that. So behind the scenes, there were some rumblings that Trump may have played a role in actually who ended up with this contract. So regardless, both players, both large technology companies have, we think, a pretty good runway ahead of them over the next few years.
And Michael, when you think about tech in your portfolio, how are you sort of right-sizing it right now? I know you, like many investors, are sort of trying to get the growth value equation correct, and tech would be on the growth side of that equation. So how are you thinking about that at present?
Right. Well, at RDM Financial, it all starts with financial planning. We figure out the rates of return that clients need in order to meet their long-term objectives. And then we figure out which investment model they should be in. So in terms of our asset allocation, we include both large cap growth and large cap value. Over the past few years, we have been more tilted towards growth versus value, which has certainly been a tailwind for our portfolios. As we look at the current environment right now, it's unclear whether value is about to really take off, but there are some signs. The yield curve, for example, is widening, which is a positive sign. There's some positive talk now between China and the U.S., which we haven't had in a while. Earnings estimates next year are forecast to grow about 10% versus about just under 1% this year. So there are some positive signs that animal spirits and growth may start to, or the global economy may pick up next year, and that would create a better playing field between growth and value. So to answer your question, we're moving more to the middle in some of our models between growth and value because we think both of those have an opportunity to perform better going forward.
Michael, thank you. Michael Sheldon of RDM Financial Group at Hightower. Love the strategically placed pumpkin there in the background. Very seasonal. Thank you so much.
Thank you very much.
Well, coming up, investors are watching as Fed officials meet for their two-day policy meeting tomorrow. Is another rate cut in the cards? The market certainly thinks so. Plus, riding the wave, how Popeye's chicken sandwich gave its parent company a major boost in the third quarter. past 11:30 a.m. here in New York City, 2 hours into the trading day. Stocks are rising. The S&P 500 is at a record. Also, let's take a look at oil prices here. They've been bouncing around a little bit today. Right now, around the lows of the session, in fact, down about 1.25%, 55.95 the barrel. PG&E shares plunge yet again as Citigroup warns the stock could become worthless amid ongoing wildfires in California. Here comes Alphabet. What to watch for as the tech giant prepares to report third quarter earnings after the bell. And from meatless burgers to the chicken sandwich craze, new food trends help drive strong sales for restaurant brands. Welcome to On the Move. I'm Julie Hyman. Well, Google's parent company Alphabet's in the spotlight today as the tech giant set to report third quarter results after the close of trading. Analysts expecting a strong showing from the company with revenue estimates of $32.7 billion. That's according to Bloomberg compiled estimates. With us to discuss is James Chakmak. He is Techonomy Media contributing editor, watches Alphabet numbers pretty closely. And indeed, it looks like that there's some optimism growing around the numbers, right? Based on advertising trends, search trends, and how Alphabet's been doing. What do you think?
Yeah, I mean, I think Google or Alphabet can really do no wrong when it comes to advertising, because right now, when you look at the way advertisers are spending money, the return thresholds on those dollars continue to go up. And there's only two platforms in the world that can offer those rising return thresholds. That's Alphabet, Google being one, and Facebook being the other. So the lack of alternatives should continue to propel the top line higher. But investor scrutiny will always be on the bottom line, be on the margins, because unfortunately, we never get any transparency on that front.
James, you mentioned that duopoly, and of course there's risk there because of the nature of that in terms of it possibly being anti-competitive. How concerned are you about that kind of sentiment?
Yeah, I mean, look, antitrust scrutiny will always be, with these big tech players, but ultimately you have to look at what are the antitrust laws today, and do they actually apply to the companies that we're talking about? And unfortunately, they don't. The antitrust rules have to change in order to make a justification that these companies are actually impeding consumer welfare. Benefits, so which they're not.
Because they focus on prices right now, and of course these companies drive prices down, but there are other risks in terms of size that those antitrust laws don't address.
I mean, if we were in Europe, it would be a different competition conversation, because that's all about protecting competition. Here it's about protecting the consumer. Getting a better search result on Google and finding my information more quickly doesn't really hurt anybody.
Well, in talking about lack of transparency, let's talk about YouTube, because Google acts like, oh, you know what, they're not a part of us, they're doing their own thing, but clearly YouTube is like about, let's say, 15% of their overall value. So what is it in terms of Google's strategy of playing down the problems at YouTube? Meanwhile, we see Facebook and Mark Zuckerberg, his feet to the fire dealing with, misinformation, which clearly YouTube has too.
Yeah, I mean, look, YouTube, we need to break out YouTube. I mean, you look at the last quarter's press release, you can't even do a Control F YouTube, you won't find it. And, it's only talked about on the earnings call in terms of color commentary. But I think, when you talk about antitrust, how do you actually drive change? The problem with these companies is the dual class share structures where there's absolutely no accountability. The management's supposed to report to the board reports to the shareholders, but nobody's reporting to anybody. So, until you have regulation to do away with those dual class shareholders where they can do unilaterally anything that they want at any time, then you're never going to have the accountability that you wish for.
Well, and shareholders aren't demanding the accountability, right? Whether you're looking at Google or you're looking at Facebook or some of these other companies, the stock prices seemingly have not been hurt by either concerns about governance from within or from without, talking about federal governance, right? So it doesn't seem like it's actually hurting the business, some of these elements you're discussing, or is it?
Well, the party will stop at some point. Everyone's a fair weather friend until something goes wrong. I mean, you look at what happened with WeWork. You look at the stuff at Uber prior. There was dual class share structures there at the time before Travis Kalanick was ousted. So problems can happen, and we do see evidence of those problems happening. And yes, the train is moving in the right direction, and everyone's happy and making money, which is fine. But it's not forever.
Interesting. All right, James Chakmak, with some warnings perhaps or things to watch about Alphabet and some of the others. Techonomy Media contributing editor. Thank you. Appreciate it. Well, turning now to Restaurant Brands. That's a company that already reported its third quarter results. They were in line with Wall Street estimates. Sales, though, were bolstered by nearly 10% growth at Popeyes amid the chicken sandwich wars. Here with us now, Yahoo Finance's Heidi Chung.
Right now.
Yes.
Right now.
Wow.
She just hopped right in
right in
here.
there.
Chicken sandwiches and fake meat seem to be the two things, because the Impossible Whopper also, they said, did well for them.
Yeah, so Burger King's Impossible Whopper and Popeye's Chicken Sandwich really drove the growth in those two different brands. But as we know, Tim Hortons also partnered with Beyond Meat in the quarter, and they had launched those breakfast sandwiches all over Canada.
Didn't do so great.
Exactly, and I was going to bring up that point. And we just saw Tim Hortons same-store sales growth also did not meet estimates. If anything, we saw a decline of 1.4%. Very concerning to investors, which is why I think we are seeing the shares react the way that they are right now. But also looking at just the entire brand, I think the main question going forward when I talk to analysts is how sustainable is this chicken sandwich wars going to be on Popeye's same-store sales growth? Because they sold it for 2 weeks, it blew up, it did amazing. Our very own Brian Sozzi just got off the phone with Restaurant Brands International CEO Jose Seal, and he told him, hey, no more supply issues going forward. We do not expect that anymore. But of course, we have people who also were thinking, well, was this a marketing ploy to keep them off of, out of the stores for 2 months?
Right.
But 2 months was a long time, and I think that if they had any other issues and it was even longer than that, the hype would have died down. People wouldn't have been as excited. But launching again on Sunday, I'll be at the stores to see what people are thinking. Of course, I'm curious. I want to see if the lines are extremely long, if people are going to be as excited as they once were. But Impossible Whopper also driving really good same-store sales growth for Burger King. They notched the best U.S. same-store sales growth since 2015.
Did they say how many of them they sold?
No, we didn't get a count.
So we don't know exactly how much it boosted the sales.
But getting back to this Popeyes thing, I mean, imagine first of all if they'd sold it the whole quarter, and I agree that they're either stupid or there's like a fake Hollywood feud, as we were talking about, Julie, going on with like, oh, we ran out, so what? They're either like geniuses or not. But we've talked about this, Heidi, just this relentless pressure on companies to come up with a new thing, and you're conflating all these weird foods. I know I sound like an old dude, but with all of, putting Cheetos crumbled on top, and this is welcome to Heidi's world, because that's where she lives, and it's fun and it's exciting,
I love it.
but it's just, you just gotta wonder about the toll that it takes on businesses to keep coming up with these things. And then there's cost to it as well. I mean, I guess these guys are really making money on it because it's just driving so many people in terms of the top line. But what about the bottom line?
Right, and we've seen over recent quarters that foot traffic has just been declining. So anything to get customers through the doors, mostly menu innovation, as we've seen McDonald's also come up with new things like the chicken sandwich as well that they recently launched. But if they're not innovating and if they don't focus on their digital strategy and their delivery, it's hard to stay relevant in this really competitive space.
This is what I've been waiting for. When does the fake meat craze kind of die down? And we're seeing with Tim Hortons results there, Beyond Meat wasn't that big of a boom for them. It was a limited edition, but their sales didn't really benefit from that. So are we getting to that point? Are we getting to that point where people are like over the fake meat?
I think you're rightfully skeptical, but I don't see it dying down anytime soon, and I don't think it's a bubble.
Yeah, I don't think it's a fad.
Well, it is true. McDonald's is getting in it, but they're probably looking at the numbers from Tim Hortons and going,
Yeah, so they're testing it out. But we have Beyond Meat earnings after the bell today, which I'll also be all over. That's going to be a good one.
Yes, it will. And my fellow veggie burger taster from that taste test. We'll have to rerun that. All right, coming up, we got him. New details on the raid that killed ISIS leader Abu Bakr al-Baghdadi. Plus, President Trump gets a mixed reception at last night's World Series game. Details continue to emerge about the death of Islamic State leader Abu Bakr al-Baghdadi in Syria during a nighttime raid by U.S. troops. It's the most significant killing of a terrorist leader since Osama bin Laden in 2011. Military and intelligence officials told the New York Times they sped up planning for the operation after President Trump ordered a withdrawal of U.S. forces from Syria. House Speaker Nancy Pelosi criticized the president for not notifying top congressional leadership in advance of the raid, but she did say the president told Russia. California Representative Katie Hill is resigning amidst a congressional investigation into her alleged relationship with her legislative director, which she has denied. Hill, a Democrat, did acknowledge a separate sexual relationship with a campaign staffer. Hill has accused her husband, who she is divorcing, of releasing nude photos of her and conducting a smear campaign alongside Republican operatives. The Kincade Fire, raging across Sonoma County, California, now covers more than 54,000 acres, and it's only 5% contained, according to CAL FIRE, which is the state firefighting agency. The fire has grown rapidly in the last 24 hours, roughly doubling in size, triggering at least 180,000 evacuations and threatening 80,000 buildings. Meanwhile, more than 2 million people are without power after Pacific Gas and Electric acted to prevent the risk of downed active power lines, sparking more blazes. And President Trump's appearance at last night's World Series was not exactly the warmest welcome. His appearance there got a big Bronx cheer from some fans. The president was booed after being announced at Nats Park, with some fans chanting "Lock him up" and others unfurling various impeachment banners. The Houston Astros lead the Washington Nationals in the World Series 3-2. The Federal Reserve kicks off its two-day policy meeting tomorrow, with the central bank widely expected to cut short-term interest rates by 25 basis points. Joining us now with more is Greg McBride, chief financial analyst at Bankrate.com, to preview that meeting. What are we thinking here? I think the last time I checked, the CME Fed Futures tool was showing something like a 93.5% chance being priced into the markets that we're going to get a cut. Is it a near certainty at this point?
Well, yeah, it's up to 94% now. But look, I think it's going to be a lot tighter than that within the Fed itself. Nonetheless, I do expect that the Fed will cut interest rates. This will be the third time. But I do think we're going to continue to see that kind of descent that we've seen the past couple of meetings. There's going to be at least a couple, that are going to vote to hold steady and not cut interest rates. So it's not going to be a unanimous vote, that's for sure.
Greg, I know we're focusing so much attention on this rate cut, and we're all, on pins and needles waiting for this to happen, and then it's going to happen, and boy, it's going to be so great for the economy. As you can tell by my question, which is really a statement, I guess, a little bit, I'm a little skeptical. Aren't we pushing on a string here, to use that old saw?
Yeah, absolutely. And the thing about interest rate cuts, it's not the effect of one single quarter point rate move, up or down, that's really significant. Over time, you have to look at the cumulative effect. Well, this is going to be the third rate cut, but let's not forget they raised rates 9 times in a 3-year period, finishing up last year. So if my math is correct, 9 minus 3 is 6. We're still net interest rates much higher than they had been. Again, that pushing on a string, I think that's very accurate, particularly when we see that so much of this concern about the economy revolves around the trade situation, and the Fed can't fix that.
And you were just talking about earnings calls and a lot of CEOs saying how the consumer remains strong. But Greg, you and I have talked about how consumers are now thinking about recession and thinking, actually, you know what? I'm not that prepared. 4 in 10 saying that they're underprepared. So what steps are Americans taking right now to try to protect themselves?
Yeah, there's a big recognition among consumers that they're not prepared for a recession. And so what we're seeing them do, and the vast majority of Americans are taking some step or another, nearly 70% say they're doing something. Most commonly, they're cutting back spending, and what they're doing with that money, they're boosting their savings and they're paying down credit card debt. Now, make no mistake, those are very prudent steps to take in any financial environment. But the fact that people are so focused on that right now, I think, is indicative of the level of concern and the recognition that so many people are unprepared.
So, Greg, what happens after this meeting? You talked about the level of dissent that we have been seeing and could continue to see within the Fed. What does that tell us about the Fed's decision-making going forward?
I expect that they're going to indicate that they're hitting the pause button after this. They'll cut rates. This will be the third cut. Then they say they're going to sit back and just let the data come to them in terms of what effect are we seeing on the economy, and is there any sort of movement on the trade front that kind of gives them a clearer signal as we move into 2020. Markets aren't going to like that in the short term, but here's the big picture. If the economy's strong enough to stand on its own and it doesn't need further help from the Fed, ultimately that's good news, and that's something that eventually will be reflected in the market, but it's going to be a bumpy road between here and there.
And when you're talking about good news for the economy, do you think that possible progress on the trade war with China, this possible mini deal could possibly get signed in a couple weeks? Do you think that might prevent the Fed from having to cut more interest rates later this year?
It's definitely the biggest cloud overhanging the economy right now. If you get some resolution on that front, then yes, the Fed can move back to the sidelines. The biggest source of uncertainty has been this trade situation. Now that they will have put 3 rate cuts into the pipeline, if we get some type of resolution, the Fed can be on the sidelines and we won't be talking about rate cuts anymore.
Greg McBride, Chief Financial Analyst at Bankrate.com. Thank you.
Thank you.
In our ongoing series, Meet the Candidate, Yahoo Finance's Rick Newman sits down with presidential contenders, and Rick is here now. Rick, you talked to a Republican for a change.
I know, there are some other than Trump,
and
yeah.
I was going to say, and his name's not Donald J. Trump.
Yeah, there actually are 3 Republicans running against Donald Trump in the Republican primaries. It's Bill Weld, who I interviewed. He's the former governor of Massachusetts, and also Mark Sandberg and Joe Walsh. They call themselves the 3 Stooges. So Bill Weld actually favors impeaching President Trump and kicking him out of office. Now, he would benefit from that, obviously. But, it's one Republican who wants that to happen. Here's how he described it.
What Mr. Trump has done is miles beyond anything Dick Nixon
Worse.
ever thought of. Worse. Nixon one time said, hey, tell them it's the CIA. They should, forget about this Watergate investigation. Trump told people to lie. He said phony documents. They said, we can't do that. That would be a lie. He said, well, what's your point? Meaning, you're here to lie to protect me, the president. The ultimate loyalty test, the same one he gave to Jim Comey. He wanted loyalty in law enforcement. I spent 7 years of my life in the Justice Department trying to keep politics out of law enforcement.
So if you were a Republican senator, and it got that far, you would vote to convict the president?
Oh, I think he absolutely needs to be removed. I also think that may be the only way we get rid of him. And he's got the country in a turmoil, and he has promised a civil war if he doesn't get what he wants. That's his words, not mine. Capital C, capital W. We've already had one civil war, 600,000 Americans dead.
So he says Trump is worse than Nixon, and he also compares Trump with Nero, the Roman dictator.
Hey, Rick, why do you think someone like Bill Weld, who's otherwise smart, nice, normal person, accomplished, is doing this? I mean, why is he?
I asked him. I mean, I asked,
so
for some of these more obscure candidates, I do ask them, and I say, why are you doing this? And they always give you the sincere answer, well, I think I have a chance. I want to make a difference in Washington. I suppose you get a little more name recognition. He's a practicing lawyer, so it doesn't hurt that, his clients or potential clients, I guess, see him on the TV networks and on Yahoo Finance every now and then. And who knows, maybe he just really believes he's the guy for the job.
Does he poll? Does he have any?
Well, I don't know, but if he does, it's in the low single digits. I know that for a fact. But it's also not 100% clear that Trump is going to be the Republican nominee. So imagine if he's not, then I guess Mike Pence, who would become president if Trump leaves, he would, I guess, become the front runner. He'd be a weak front runner, and suddenly this Republican race would get more interesting. So possibly a guy like Bill Weld is running on the off chance that this whole race gets thrown into turmoil.
Of course, the senator from Utah could always jump in, too.
He could,
Yeah.
Yep.
All right, thanks. Got to leave it there, sorry. Thanks, Rick, appreciate it. Coming up, why Andy says Facebook's political advertising policy will have to change. Plus, stop the bleeding. Investors push for change at AT&T as the company struggles to retain TV customers. All right, let's take a look at stocks on the move in midday trading right now. We've got a number of companies, of course, out with earnings that we've been talking about. We've also been watching Roku. Those shares are up by 8% in today's trading. That's after Bank of America Merrill Lynch initiated coverage on the stock with a buy rating. I believe the price target they put on there is $154. They said traditionally the company's been known for selling its hardware, but increasingly it's reliant on other sources of revenue, including video ads. This stock, by the way, has done incredibly well this year, 373%. So to say the least, I guess it's done. Dang. Says Andy Serwer behind me. Sanderson Farms is another we are watching. Now this is an egg and poultry processor, and there was a report by Reuters late Friday that China is going to lift its poultry ban coming from the U.S. And so these shares are up more than 15%, and we're seeing some of the other poultry processors also getting a lift in today's session. If you look at stocks overall, as we've been talking about, we're seeing a record for the S&P 500 in today's session, and the other major averages are also on the rise.
I like that Sanderson Farms.
Sanderson Farms, yeah.
That's
it's an interesting one. All right, it's time for Word on the Street. Let's check in with our panelists and find out what stories they are watching. Andy, I'm going to start with you in that Facebook thing. And it's interesting because James Chakmak, who we had on just a little while ago, talked about that the regulatory framework is just not built for today's tech firms. And you talk about that very issue.
Yes, and I actually was just exploring specifically Facebook's policy when it comes to political ads. And last week, Mark Zuckerberg was on Capitol Hill doing a charm tour, and part of it was appearing before Congress and being
Sorry,
grilled
I'm just laughing at Zuckerberg and charm tour in the same sentence.
By Maxine Waters and AOC and others, and defending the policy that Facebook has of the company running ads, political ads that they know to be false and untrue. And I find that to be not only illogical, but also untenable, because it just ultimately doesn't make sense in our society. And it has to do with the regulatory oversight. Back to your point, though, Julie, it has to do with the 1996 Communications Act, specifically Section 230, which sounds like jargon, but basically it allows companies like Facebook, Twitter, and YouTube to designate themselves as pass-throughs, platforms where, hey, we can't really, we can't be held responsible for what's on our platform because we're just putting it there, man.
Well, hey, and what's so sort of disingenuous about all of that is you remember in that exchange with AOC, right, where she asked Zuckerberg, what if I put the wrong election day date in my ad? And he said, no, we wouldn't allow that. Right. So where do you draw the line?
Are you fact checking or not?
Right, yeah, exactly. And in fact, over the weekend, they took down a fake ad about Lindsey Graham that specifically spoke to this, saying that he voted for would support the new Green Deal. But oh no, in this case, because the ad came from a PAC, that was a false ad they would take down as opposed to a false ad by a political candidate. Do you follow? I'm glad you do, because I don't.
Just get rid
That's
of all
the whole point. It's right. Either ban the ads, or what they could do is be subjected more to court precedents, like the New York Times versus Sullivan, that famous case in the 1960s, which basically says, you can have whatever you want, but if you have something that is intentionally false or with actual malice, then you could get sued, which basically essentially governs the company.
All right, Sabeel, you're looking at AT&T and its battle with an activist that has now settled down a little bit.
Yeah, I've been paying close attention to this, just seeing how Randall Stephenson, CEO of AT&T, was going to deal with activist investor Elliott Management that wanted them to basically AT&T focus on their core telephone business, old school business, and not so much on their media business. But of course, that's impossible because part of what Randall Stephenson has created recently is basically acquiring Time Warner, DirecTV, and basically transforming the company into a major media player. So it was interesting to see this peace deal be reached between AT&T and Elliott Management. And part of that deal is that Randall Stephenson is going to stay on at least through 2020, so no management changes there. Also, AT&T is going to do more share buybacks, and also they are going to sell off $10 billion of their businesses that are non-core. So a lot of changes going on at AT&T, but at least they're working with Elliott Management, hopefully not ruffling too many feathers there.
Yeah, we'll see. All
We're
right.
not selling direct or Warner Communications yet, though.
Yeah, right.
At least not
They're
that.
hanging on to that for now.
Yeah. All right. Sabeel, Andy, thank you very much. Got to bring you some more breaking news here. There's a report from Reuters that Google owner Alphabet has made an offer to buy Fitbit. They're citing people familiar with the matter. You see there the shares moving sharply higher on these headlines here. So again, this is an offer, an outreach that's been made. It's not clear that a deal will actually get done as a result of this. But again, this is an exclusive from Reuters, and the exact price that Google has offered for Fitbit could not be learned. Fitbit's been struggling as of late, so it will be interesting to see if that ends up happening. All right, coming up, reaching for the stars. Virgin Galactic founder Sir Richard Branson celebrates as his company begins trading on the New York Stock Exchange. Plus, before we go to break, let's take a look at some of the biggest winners in the Dow today. We've got Microsoft winning that big Jedi contract. It is leading the pack. Just after noon here in New York City, 2.5 hours into the trading day, and stocks are rallying with the S&P 500 trading at a record. Let's take a look at the 10-year Treasury yield as well today. As we have buying of stocks, we got a little bit of selling of Treasuries. That's pushing the yield up by 6 basis points today, 1.86%. Particularly interesting, given that the Fed is widely expected to cut rates this week. Reaching a truce, AT&T shares climb as the company comes to an agreement with activist investor Elliott Management. Buying luxury, Tiffany shares surge as LVMH makes a nearly $15 billion bid for the high-end jeweler. And a new frontier for investing. We'll speak to Virgin Galactic founder Sir Richard Branson as his company becomes the first in space tourism to hit Wall Street. Welcome to On the Move. I'm Julie Hyman, and look who's back.
I'm Adam Shapiro, back from the New York Stock Exchange. We were talking about Virgin Galactic, but it's the S&P, which is at record levels. A record high today, coming amid a slew of big earnings, and we want to bring the panel in to talk about this. Kevin Mon, Hennian and Walsh Asset Management President and Chief Investment Officer, as well as Yahoo Finance's Brian Sawsey, who's going to talk to us about Spotify. But let me start with you, Kevin.
Yep.
Why? We broke through, and will we sustain it?
I think what we're seeing thus far this earnings season, about 83% of companies have beat earnings, about 64% have beat on revenues. And what that reminds us all is that we have a relatively strong U.S. consumer. And that U.S. consumer could lead us to the finish line of 2019 and give us what I believe is going to be another record holiday shopping season led most likely by online commerce. And I think that creates opportunities. Plus, Adam, if we get that additional rate cut this week, which I don't think we need or should get, but if we do and we're in the 1.5 to 1.75% range, that creates a pretty optimistic environment for stocks, at least through the end of this year.
Is that supported by what we're hearing from companies?
No, but it's interesting because a lot of people I talked to are going back to that Caterpillar report. That was not a good quarter, but you saw the stock rally and continue to hold up pretty well despite that quarter. And a lot of people on Wall Street are starting to think that the economic data globally has bottomed. And I think that's part of the reason why you're seeing this market rally into the big Fed event.
Although Caterpillar doesn't really have anything to do with the consumer, to Kevin's point, right? Or at least not as directly. Whereas some of the companies out with earnings today, Spotify that we were just showing.
Well, Spotify finally gets some love, and they should, because they turned profitable, 8 straight quarters of free cash flow growth. Subscribers are growing on the ad business and the premium. They did everything on this quarter, and they put in a new CFO, which I think a lot of people wanted to see. They should be up rallying.
But is this a consumer play or is this a tech play? Because Spotify is $9.99 for the premium Spotify. It's $9.99
I think it's a company that just finally got it all right in one quarter.
Yeah, and I think there's other consumer discretionary names that are showing signs of strength. You have PepsiCo, you have Domino's. Yep. And I think as we get into this holiday shopping season, other companies stand to benefit from online commerce as well, whether it's the REITs, the industrials, the warehouses, the distribution centers, the delivery companies, the credit card processors. I think the fourth quarter should be relatively strong, certainly in that 2 to 2.5% range, and then we'll see if that carries through into 2020.
And just playing off that real quickly, too, look what we saw from Popeyes today, almost a 10% same-store sales increase. McDonald's 4.8 same-store sales increase last week. These companies aren't reinventing the wheel. They're just selling chicken sandwiches. So the consumer appears to be pretty strong right now.
Okay, speaking of chicken, someone might have cried chicken at AT&T. They struck a truce with the activist investor that's been pressuring the company to revamp their strategy. Brian, let's start with you on this one. The whole point of Elliott Management becoming very aggressive with AT&T is they have huge debt and they've bought into old media. What's changed? Now they're all happy?
Well, I don't think Elliott's going anywhere anytime soon. They will remain very engaged with this process, and you'll learn that from the statement that Elliott put out today. But I come back to your point on debt. This company still has over $153 billion in debt. To me, that's not a company you want to necessarily bet on.
The one thing you have to look at with AT&T, yes, they did beat today. But if you look at some of their comments coming out of that beat, specifically around their dividend, right now their yield's around 5.5%. You compare that to the 10-year, which is yielding around 1.8, let's call it today. That looks pretty attractive to investors who are starving for income. But I agree with Brian's points around the amount of debt in their balance sheet and how they're going to continue to grow, and then also the content that they need as they continue to diversify.
All right, let's get back to actual chicken for a moment, because Brian, you actually talked to the restaurant brand CEO. I love the ticker symbol on this one, by the way, QSR, Quick Service Restaurant.
Quick Service Restaurant.
They did beat in part because of that Popeye sandwich, in part because of the Impossible Whopper. What was his take on all of this?
Yeah, so I just talked to Jose Sil about 25 minutes ago. I asked him about the Popeyes chicken sandwich. He says they do not plan to round up supplies when it comes back November 3rd. And I believe him. They've had a couple months to get supplies in order. And it's not just that smaller chicken breast. It's the brioche bun. It's even the special pickles they use on this. So I think if everything goes right, this company could be teed up for a potential 10% same-store sales increase in the fourth quarter.
You're going to sing Love That Chicken from Popeyes?
Maybe.
Keep your day job.
Maybe.
All right, let's take a look at what's happening with markets. We are enjoying a record on the S&P 500. Inez Ferre is on the floor of the New York Stock Exchange with more for us. Inez?
Yeah, Adam, record highs on the S&P 500, as you just mentioned, on the heels of some strong earnings. Also some trade optimism. You've got communication services and technology stocks, which are seeing gains. I want to show you what's happening with Fitbit. Fitbit is surging after a Reuters report says that Alphabet is in talks to acquire Fitbit. Now, you'll recall that last month also Reuters had reported that Fitbit was considering a sale, was talking to an investment bank considering a sale of the company. Meanwhile, we're also watching Prologis. Prologis is a little bit under pressure after the company announced that they will be buying Liberty Property Trust in a deal that's valued at $9.7 billion, and this will expand their portfolio of warehouses and logistics in Chicago, Houston, and Southern California. And then if we take a look at the Dow, the best performer on the Dow today is Microsoft. And Microsoft up more than 2% on the heels of that Pentagon Cloud deal that's valued at $10 billion, beating out Amazon. Adam, Julie?
Inez, thank you very much. Let's talk about space and the great beyond. Virgin Galactic launches on the stock market, Sir Richard Branson's company, becoming the first public space tourism company ever to trade publicly this morning. Shares are higher right now in its not necessarily, well, yes, public debut. I got to speak to Virgin Galactic founder Sir Richard Branson today, and it's safe to say, understatement, he's kind of charged and excited about this.
Only 500 people have ever been to space, and that's including the Chinese, the Americans, the Russians, and we have the capability of putting hundreds of thousands of people into space in the years to come, and that's ridiculously exciting. And so, here we are on the floor of the New York Stock Exchange, launching the first spaceship company, and it's going to, the resources we get from this are going to enable us to do wondrous things.
No, I shamelessly tried to get a free ticket on that first launch because he's going to go. He's saying next year he will be on board. It's the Virgin Spaceship Unity will launch. He will be the first among, he won't say who it is. We asked which celebrities. But here's the deal. 2 million people, that's what they say is the market of the luxury space tourist. They've got $80 million in deposits with a potential $120 million in revenue. That alone is not a profitable business. So we talked about, well, where do you take it? And his response was, it's the hypersonic travel from, say, New York to Tokyo. So I asked, and I'm curious what you think. It was Boeing launched United Airlines.
Yes.
With the understanding in the 20s, let's build demand for our product. Do you think that's what they're up to here?
I don't know. Some might suggest that the potential returns are out of this world, but I'll keep my day job. But I think this is a wait-and-see type of investment. That type of demographics doesn't really speak to incremental revenue growth that I see if they take it the next step and actually expand beyond just tourism. Maybe that's a business, but right now I think it's a wait-and-see type approach. But on the flip side of this, we have gotten a lot of inquiries from investors about investing in space and space travel. So this is an area that investors are looking at, and this could be one of the first names they start dipping.
Yeah, I mean, the timeline that you talked about, the arc from some initial innovation to then it becoming more mainstream and becoming a robust business, it seems like a long timeline.
They put it, well, okay, so let's look at timelines. 2004 to now, they're already licensed to do these space tourism flights, but that's to the edge of space. The horizon for the hypersonic travel, if you're going, this hypothetical, New York to Tokyo, they're saying 5 years, and they're going to have 5 of these ships flying by 2023. Do you think they can meet that timeline?
I would say no, but actually, I think what you're seeing here today, Adam, is a little bit of a Richard Branson premium. To your point, this company's not making money, and it's not going to make money tomorrow, a month after, or 5 months down the line. I think you're seeing a lot of people just bid on Richard Branson because he is the ultimate hype machine, and he could probably make something happen.
It's a lot of fun to talk to him, but here's the other side of the business. $250,000 for a ticket. A geek like me wants to go. And there is a price point, I won't say, that I would waste money on doing. So I asked, George Whitesides, he's the CEO, explain to us how you might get the price down in the future so that someone like me can get on board.
We project out 5 spaceships operating by 2023, and that'll offer a fair amount of capacity into the market. Not a huge amount, but like a fair amount, so that we'd be flying about 1,500 people a year, which is exciting. And the way that we bring the cost down is the way that any other aerospace business brings their costs down, right? They learn how to build things faster, cheaper, better, and so we've already instituted certain manufacturing efficiencies in our rocket motor production process and in our spaceship production process.
But here's the problem for them. Would you buy a ticket to go to the edge of space, or would you wait till Blue Origin, Jeff Bezos, goes to the moon? Because that's what they're aiming for.
Yeah, I don't go to a new restaurant until there's at least 6 months in, so I'm certainly not going to be one of the first people on that ship. But I think I'll take a wait-and-see approach on travel, as I will with the stock as well.
Count me out, man.
I'm not doing it. No. What if they said free? Because they're going to take some reporter.
I like being alive. It's just me.
They've already done it. February, that ship, the Unity already did the flight. It's done it twice.
I can't get there, Adam. Can't do it.
Adam is anxious to go.
Yeah.
Absolutely would go.
Yeah, no.
No.
I'm risk averse by nature.
I don't think it's that risky. I think driving in Manhattan, that's risky.
Okay, fair.
All right. President Trump is touting the U.S. raid in Syria that resulted in the death of the leader of Islamic State, Abu Bakr al-Baghdadi. We want to talk about how that could affect the political dynamics in Washington and by extension, the 2020 race. Greg Valliere, AGF U.S. policy strategist, joins us now. And this is a victory not only for the United States, but it's one the Trump administration gets to claim on the campaign trail. Or is it going to be so far out people will say, yeah, been there, done that?
Oh, I think they'll claim it over and over again as a victory, even though Trump ironically scoffed at Barack Obama's capture or killing of Osama bin Laden and said it was a bunch of crap to have any kind of congratulations for Obama. But things have changed, and I do think that Trump will make a big deal of it. And I think there's a major point here, and that is Republicans who a week or two or three ago were starting to waver in their support of Trump, I think have no choice. I think that they're going to have to stick with him now.
Well, and Greg, what I think is interesting, too, that you point out in your note is it's still the economy, stupid. In other words, especially now that you think the Republican support for the president has been shored up by this event, the focus turns back to the economy. And there, do you think it supports him or not?
Well, it's going to be an odd week this week, Julie. I think we're going to see a mediocre GDP report for the third quarter. That comes out on Wednesday, probably under 2%. We're going to get a very weak, I think, unemployment report on Friday with non-farm payrolls under 100,000, in part, to be fair, because of the GM strike. But the economy is decelerating. I think you have to say that. The plus, of course, is that earnings have been okay, not great, but okay. And the big plus is another Fed rate cut, which I think will be likely on Wednesday afternoon.
Hey, it's Kevin Mon here. With unemployment now at a 50-year low at 3.5% and participation rate near 63%, how much more can we expect out of employment data? In other words, if we don't get as much upside potential coming out of new job creation, should that really surprise us or concern us about the state of the U.S. economy at this point?
That's a really good point. I travel all around the country and I talk to business leaders who consistently tell me they've run out of skilled labor. When they do hire people, these people are poached by the company's rivals. So there is a very, very tight labor market now, which to me seems to put a ceiling on how high you can grow with GDP unless you have dramatic new immigration. And this president does not seem to be inclined to do that.
Greg, if you just look at the stock market here, obviously the stock market is hovering around records and touching records. It would indicate an economic reacceleration next year. Do you sign up to that?
Well, I think that's the consensus, that we're going to get a little bit better in the fourth and first quarters. But I still think 2.25% would be the most that you could hope for. It's nothing to write home about. But if there's one big debate that I think has been settled for now, it's that a recession is not imminent. I don't see anything in the data, unemployment, GDP, earnings. I don't see anything that would support an argument that a recession is just right around the corner.
And Greg, you know, today the president has already said, he was speaking earlier, does anyone in this room have a 401k that's down? Does anyone in this room have a 401k that's up? I mean, that's really, for most of us who might be short-sighted, that's really going to be one of the factors when it comes time to pull the lever or to electronically vote, depending where you are.
Well, yes, I think that investors probably would, for that reason, would prefer Trump as opposed to Elizabeth Warren, but maybe they'd prefer Mike Pence to Donald Trump. I mean, you can play that game all day long as to who would be best for investors. The fact is that the fundamentals right now are still sound. They've been pretty good for the last 4, 5, 6 years before Trump was inaugurated. I think they're going to stay pretty good for two reasons. Number one, monetary policy. Number two, fiscal policy. No one talks about fiscal policy, but that is extraordinarily stimulus with both parties spending like crazy, and that's not going to subside.
Greg, you mentioned you travel around the country talking to a lot of business leaders. Who do they think right now is the person best positioned for the U.S. economy?
Well, most of them aren't crazy about Trump as a person, but they like his policies, except for trade. My sense is that the markets and business could easily live with Joe Biden. I think his policies would be moderate liberal, not radical liberal. I think he would be more inclined to get a trade deal. So I think they would be a little bit more inclined to accept him. I think that the uncertainty that now still persists on trade is a big factor. As I travel around talking to businesses, it's a big factor in the Midwest with farmers. And they keep saying we're going to get phase one done. Well, when? They talk about an agreement in principle, but we never seem to get an agreement in fact.
You know, Greg, as we say thank you, they're setting a target of APEC in November, but we'll bring you back on to see if they actually deliver on that. Thank you once again, AGF strategist Greg Valliere.
You bet.
Coming up, taking on D.C. Big tech firms reportedly ramp up lobbying efforts amid an antitrust crackdown from lawmakers. Plus, take a look at some of today's trending tickers on Yahoo Finance. Got a lot of movers today related to earnings news, for example. And we're going to talk much more about those coming up.
Tech giants Facebook, Amazon, and Apple are ramping up lobbying efforts amid antitrust investigations. This is according to a Wall Street Journal report that found dramatic increases in lobbying expenditures this year. Joining us from Sunnyvale, California is David Williams, founder and CEO of Williams Capital Advisors. And David, you know, these efforts that they make, right, a lot of businesses lobby. Are they effective?
Well, they're effective, but I think in the case of these tech companies, they're a little bit behind the curve. They, the negative sentiment has grown so fast in Congress that they're ramping up their spending, but it's a little bit too late in some respects.
And so, from an investment perspective, are you sort of factoring that in? In other words, which companies are going to be the most, strategic in terms of their lobbying efforts?
Well, no, I think it's less a function of how much they spend. It's more a function of how unpopular they are in Congress. So Facebook is most in the sights of the various congressmen and congresswomen on both sides of the aisle. Google has just as much of a monopoly, but they're less unpopular, if you will.
Hey, David, we have a pretty big election coming up in November of next year. Is this money well spent now on lobbyists not knowing who's going to be the senator, the House of Representatives, the president next November? Would they be better off waiting to spend that money and investing that money back in their own businesses?
The amounts they're spending are a drop in the bucket. I mean, we're talking about 12 or 13 million so far this year for most of these companies. They need to spend a lot more, and they need to spread it around because this election is really up for grabs, right? We don't know who's going to be the Democratic candidate, and until we know that, we don't know if Trump is in the pole position or whether he's a laggard. We just don't know.
David, if you're an investor and you're looking at, say, a Facebook, don't you, I want to use the word risk, despite their performance so far, because they're not going to win whether it's a Democrat or a conservative in the White House, because the conservatives are very angry at Facebook for all kinds of reasons as well. Isn't the risk that the government's going to take a move against this company?
I think there is a risk that happens. Under current antitrust regulation, they're not necessarily in violation, but the devil's in the interpretation. And so I think that Facebook has a great business, and like we saw with the privacy issues, people just don't care that much. As long as the earnings keep growing, investors are going to keep buying the stock. So it's a great business, particularly if it stays together. Even if it gets broken up, though, I think the pieces of their empire are quite valuable. They get sold for premium prices. So either way, it's a buy.
Okay, hold on right there. I want you to listen to this along with everyone else. Tech companies are facing backlash that's getting harder and harder to manage. Now, earlier on the program, we spoke with Chamath Palihapitiya, founder of Social Capital Holdings, and this is what he said.
I would like my children to just grow up in a really natural environment with the world outside, playing, running, winning, losing, failing, all the typical things that a child needs to do to build a robust sense of self. And then eventually, when they can afford it, they can buy a phone and then they can get on these social media sites. I have not used them myself for 6 or 7 years, and I find myself to just be in a much better mental state as a result.
And this is a man who was the early part of Facebook, joined them a year into the company, and left in 2011, who's saying, don't use social media. How does Facebook and the rest of them respond to that?
Well, he's in a position where he can choose not to. He can choose to have his kids not use it, in the short term. But for the most part, these things are addictive unless you actually ban them, which our government's not going to do. What can you do? People are going to use them. We'd like the world to be different, but it isn't.
David Williams is founder and CEO of Williams Capital Advisors. Thank you for joining us on The Move.
Thanks.
During the recent Yahoo Finance All Market Summit, Sarah O'Carroll, our editor-in-chief for Australia and New Zealand, caught up backstage with Robert Falzon, vice chairman at Prudential Financial. She asked him what advice he'd give to his younger self.
I actually have children that are a little older than that. So more fresh in my memory would be, what advice did I give my own 3 children as they were entering into their professional careers? And, I've had lots of conversations with them, Sarah. But the thing that really stands out is, this younger generation is known for doing more sort of job hopping, right, in order to build their careers. And I actually, my advice to them has always been, 70% of your learning is going to occur from experience as opposed to any kind of academic training you're going to do.
Absolutely.
And so get lots of different experiences. And so move around. Now, be sure as you're moving around, though, be planful about your career. I always encourage them, don't make that next move because it's a higher compensation package or it's a prestigious title. Make that next move because it's going to build your skills resume in a way that you see it's going to position you for that 2 and 3 moves out you're actually trying to make to. So where is it you really want to be longer term? And make sure that each step that you're making in your career is building a set of skills that's directed toward that ultimate path. That's probably the thing that stuck with them the most, and I think that they valued of the advice that I've given them.
No, that's great.
The rest of the advice, they say, Dad, thanks, I've had it, I get it. Yeah, no, right, yeah.
And what are you reading at the moment?
Well, I happen to be reading 2 books. One, Chernoff's book on Grant, and I'm chucking my way through that, pretty much through it, which I've really enjoyed because I read well before the Broadway play became popular about Hamilton. I read Chernoff's book on Hamilton and really thought it was quite good.
Yeah.
I actually had the opportunity for him to autograph it at one point in time.
Nice.
So I was thrilled with that. The other book I'm reading is one by a woman named Jennifer Eberhardt, and it's called Unconscious Bias.
Interesting,
And it's a shorter book, so I'm taking a break from Grant, getting through that, and then I'll return to Grant. But it's actually very interesting about how and as we're thinking about managing organizations today where we're, in our particular case especially, we're looking to get to a very broad customer base, and that's a very diverse customer base.
For sure, yeah.
So we need that sort of diversity reflected with our employees as well if we're going to figure out how to solve problems for those customers. And so as you think about that very diverse employee base, you need to then be much more aware of the things that are below your conscious and how you deal with those
and
people.
You actually don't even realize.
And you don't even realize it. Yeah,
right.
so it's a very interesting read.
Brilliant. And one last thing, what are you really excited about at the moment? Is there anything, it can be in your personal life, it can be in your professional life, anything that you wake up in the morning and you say, yes?
Yeah, well, I'm going to keep it professional because otherwise I'll get hung when I get home. There's the concept that we talked about on the panel, this concept of future of work. To me, it's also missionary. It's almost missionary. I really feel that, as a society and as, a corporate participants in that society, we have a unique opportunity to make a difference in individuals' lives, to help them. We don't want an experience like the Luddites had, right, where there was a dislocation and a societal upheaval associated with that. There's a massive change going on, but we have the ability to make that change a positive experience for individuals by engaging with them, investing in their skills development, and helping them to make the transition from sort of the old economy to the new economy. And I'm actually quite energized by what we're doing and the way in which I think will have a very positive outcome for the company and also for the people who work with the company.
No, it's great because people think it's a scary thing, but it can be an exciting thing.
Yeah, very exciting.
Brilliant. That's great. Listen, thank you very much, Rob Falzon, for joining us here today. Yahoo Finance All Market Summit.
All right, coming up, pedal to the metal. The UAW sets its sights on other automakers after reaching that deal with GM. Plus, take a look at some of today's winners on Wall Street, and there you see them. Tiffany. Someone wants to buy some luxury. We're going to talk more about that coming up. It is 12:32 here in New York City, 4 days until Friday. We're 3 hours into the trading day. Stocks are trading much higher. We're going to be talking about that. Gold, however, let's take a look at what's happening with gold. It's trading down right now, and it is below $1,500 an ounce. To Wall Street and beyond, Virgin Galactic becomes the first publicly traded space tourism company. Who's next? The UAW shifts its sights to Ford as workers return to work following the deal with GM. And think before you order why delivery apps like Grubhub may actually hurt the restaurant industry. Welcome back to On the Move. I'm Adam Shapiro.
And I'm Julie Hyman. Thanks for sticking with us. Well, the online food delivery industry now more than $100 billion, but as it continues to quickly ramp up, many questions have popped up about how big companies like Grubhub, DoorDash, Uber Eats are treating partnering restaurants and drivers. Here with us to weigh in is the editor-in-chief of Eater, Amanda Kluth. Amanda, thank you for being here.
Thank you for having me.
You know, there's been some talk about this over the years. There have even, I believe, some investigations by different municipalities into this and lawsuits. What to you is the sort of crux of the issue here when you look at these delivery services?
I think there are a few different issues. The big main one is the marketing tactics and the commissions that these companies will take, especially Grubhub and Seamless. When they partner with restaurants, they can take anywhere from 12.5 to 30%, depending on the arrangement. And then also there's the treatment of the couriers, there's the safety of the food. There are some systems like Deliveroo or Uber Eats where they've been caught letting people set up restaurants without health regulations. So there's a lot of things going on as these companies try to become bigger and bigger in the marketplace and get a piece of that multi-million-dollar valuation.
So when we talk about the gig economy that all of this is related to, we as consumers enjoy cheaper prices, but at some point, hearing what you say, there's going to be a breaking point.
Yes.
When and how, what does it look like?
I don't know. I think DoorDash is looking to go public next year. Uber Eats is trying to get to the point where they're going to be profitable. So I think as these companies need to get profitable, that's where we're going to see the change. But they're trying to get to a system where we're all so used to this free and cheap delivery that it becomes part of our daily lives and we don't want to give it up.
You know, there's a lot of nickel and diming apparent that looks like it's being used here. For example, Grubhub sets up a new phone number for a restaurant, and if you use the number to call the restaurant and place an order, they take a cut.
That's
I
right.
guess even if they're not directly involved in the order.
Yeah, well, their stance is if you find the phone number via their app, then they were marketing. And so this is one of their marketing platforms. The problem is sometimes restaurants get charged erroneously if someone's just calling to ask about if there's meat in the pasta or if there's gluten, and getting the money back can be onerous for them. It takes hours on the phone with customer service. And so there are lawsuits now against Grubhub and Seamless to try to fight that.
What needs to happen for these companies to be profitable? I look at a McDonald's, I look at a Burger King. They're already working with a lot of these big name companies. You think they would be earning profits already?
I think consumers have to get used to paying a little more before they can really make it. I think you're going to see these companies cutting into the bottom lines of restaurants even more and more. A lot of the big partnerships between Uber Eats and companies like McDonald's is favorable to the big chain like McDonald's because they want that business. But I think eventually Uber Eats isn't going to be able to float that money anymore. So I think you're going to see shifts in that area.
We should mention, by the way, we reached out to Grubhub to comment on this report, and they gave us a statement which said, in part, Grubhub generates a unique phone number for each restaurant that provides its own delivery to make it as easy as possible for Grubhub diners to place orders, ultimately meeting more orders for restaurants. Obviously, they have their take on it. As a consumer, if you are drawing your own conclusions, looking at some of your reporting and other reporting and some of the investigations, what can you do? I mean, like, if you live in Manhattan, for example, and you order in a lot, you're using one of these services. What do you call the restaurant directly? Google the number instead of getting it from, like, how does that even work?
Well, sometimes even if you Google a restaurant, they'll come up with an order now button that just goes to Grubhub. So even that way, you're not totally safe. What I try to do is find the restaurants I like, go to their websites, see what their online platform is, because sometimes they have their own platform. Sometimes they choose a platform like Chow Now that only takes a standard commission every month instead of having it based on the orders. And just call them, see if you can find their real phone number, cross-reference. It takes more time, but you're being a better, more ethical consumer.
Isn't there like a trademark protection for a restaurant? I mean, if you're registering a phone number...
They agree to it.
Okay,
so
when they sign up...
It's part of the deal. The problem is the restaurants think they're abusing it by charging them when they shouldn't be.
It almost sounds like, you know, those movies about the mafia. I've got to deal you an offer you can't refuse.
Exactly.
All right, Amanda Kluth, Eater editor-in-chief. Good to have you here.
Thank you so much.
United Auto Workers reached a deal with General Motors for a new 4-year contract, prompting the end of that 40-day strike against GM. But it may not be over for everybody. The UAW now has its eyes on rivals, Ford and, of course, Fiat Chrysler. They're going to use the new contract at GM as the foundation for a similar deal at those automakers. I want to turn now to the panel to talk about this. And do you think the UAW could reach a similar deal quickly with Ford, faster than they did with GM?
Quickly, likely not. And my only concern as an investor and a portfolio manager is the potential distraction to Ford, similar to the same type of distraction it created with GM. It'll be during that 40-day strike period. So I don't think anything happens quickly with respect to these negotiations, but we'll see.
Does the auto space excite you? I look at the GM deal and I see the cost of business going up at a time when there are fundamental shifts in the auto industry.
It doesn't excite me, although it does have a hint of that optimism around consumer discretionary and consumer spending and the strength of the U.S. consumer, especially as you get into the year end and all the year end specials that they run to move excess inventory off their lots. But the auto industry in particular doesn't jump to the top of my list in terms of attractive areas.
I mean, the thing is, even if it's going to increase the cost of goods, right? At a time when, as we were just talking about, you have full employment and you have a tight labor market, one would think it would help with worker retention, right?
Also, the fact that their sales are good, their product lineup is relatively innovative, and as they make that crossover into the hybrid category, that should create more job opportunities and more growth.
But Ford would be vulnerable right now because they're in the middle of an $11 billion transformation, and they can't really afford, or can they, a hiccup that slows that down?
I don't think so, and I think that's what the UAW sees as well, and that's why negotiations are henceforth starting.
All right, well, in the auto adjacent business, I guess, we have some Uber news. It's making a push into financial services. The company has now announced Uber Money, which includes a digital wallet and upgraded debit and credit cards. The emphasis will be to expand Uber's efforts to give its drivers access to a mobile bank account so they can get paid after each ride.
Whoa. I know very quickly. I have a friend who drives Lyft. The minute you get paid at Lyft, you can then, if you have a Lyft driver app, you can then hit something, you get the cash into your bank account. So what's going on with Uber that they can't do that?
Can Uber just focus on trying to make money from core ride hailing and Uber Eats? They're not getting the job done. They've been laying people off. I don't want to see them expanding into this.
Focus is
just
what you're
link up a
saying?
PayPal. Yeah, just focus. Just focus. Do not go after the super app opportunity. It's just not there for you right now.
You want the last word on this
It
one?
doesn't seem like an area that they need to get involved in right now. I agree with Brian.
Okay. Coming up, shares of PG&E are tanking this morning after Citigroup warned the stock could soon be worthless. The latest as wildfires rage in California and heat things up for PG&E. Plus, take a look at some of today's most actively traded stock by volume. Nokia, Chesapeake, AT&T, we were talking about them earlier, and of course AMD and Bank of America. All right, let's take a look at the top trending stories on Yahoo Finance right now. The pound is climbing after EU President Donald Tusk said that EU leaders agreed to grant the UK a 3-month Brexit extension. Now, under the plan, the EU will have until January 31st to leave, unless a deal is ratified by the UK Parliament earlier. Popeye's chicken sandwich is making a comeback on National Sandwich Day. The sandwich almost immediately sold out, sparking the chicken sandwich wars back in August. It also gave a boost to its parent company in the third quarter. National Sandwich Day falls on Sunday, November 3rd, taking a hit at one of its biggest rivals, Chick-fil-A, which is closed on Sundays. And NASA gets in on the Halloween spirit, sharing the photo of the sun resembling a jack-o'-lantern's face. Do you see it? The photo was taken back in October of 2014. The face is from the active regions of the sun appearing brighter because those regions emit more light and energy. Everybody knows that, right?
Basic.
All right, we've also been watching the fires that have been going on in California. Pacific Gas and Electric has begun restoring electricity to more than 3 million Californians who lost power this weekend as powerful winds sweep through that state, though that relief may be short-lived as the company is planning yet another wave of shutoffs. With us now to discuss is Diana Hernandez, Assistant Professor for Socio and Medical Sciences at Columbia University. Professor, thank you for joining us. I know you focus on energy insecurity and housing issues as well. And so obviously, between the fires and the electricity shutoffs, it speaks squarely to those issues. How concerned are you about not just the immediate effects here, but sort of the more long-lasting aftermath of these fires?
So I absolutely am concerned about this issue, in part because I have been kind of thinking about this issue of energy insecurity as the inability to adequately meet household energy needs. And for some households, that's a constant challenge that's mostly due to affordability. But in the case of the fires and the power outages, the planned power outages in the context of California, it's a much more widespread issue. All of a sudden, people, regardless of their socioeconomic status, are impacted by these outages. And it's still the case that the most vulnerable populations are disparately impacted. And by that, it's not just the ones that are facing economic challenges that might preclude them, for instance, from affording to acquire and then also maintaining generators, which tend to be more expensive to operate on a daily basis.
Right.
But also from a public health perspective, the medically vulnerable, so people that are essentially relying on electricity for life.
Professor Hernandez? There was
Yes.
actually a man who died in the first round of proactive power cutoffs. But let me ask you this question. What's different now than, California had really bad droughts. I think it was in the late 70s or early 80s. What's different now with these wildfires and the electrical grid infrastructure? Climate change is playing a role in this, but didn't power lines blow down in the 70s and 80s when California was parched? Why are we now watching this?
Well, the utility companies now are much more responsible, essentially, they are being held accountable. And in that kind of accountability structure, the utility companies are taking a preemptive approach. And this is all about risk mitigation, which I think is really important. And obviously the property damage and other circumstances around reducing the intensity of the fires is important. And the power lines play a really important role. But the utility companies also have been mandated and financially obligated to be responsible for whatever damages are caused by their power lines. And so by that measure, they're also taking these more protective stances that help, in some ways, their own cause, even if it, means an inconvenience and potentially a kind of a threat to life and well-being for the customers.
Professor, away from PGE and the energy sector as a whole, looking at it from a larger standpoint, from an investor standpoint, the largest asset in most consumers' portfolios is real estate, their home. At what point in time does this start to impact real estate values in California when they have to experience these ongoing rolling power outages, whether they're planned or not, and the threat of wildfires? At some point in time, you would think that would impact real estate, and the more of an impact that it has on real estate, the more it has an impact on the psyche of the consumer, the investors, and perhaps the economy.
Yeah, that's a vantage point that I don't pay attention to as much in my work, because a lot of the people that I interview, for instance, and incorporate in the context of my research studies are low-income folks, and they're the kind of investment opportunities and how the valuation of property, for instance, is negotiated and understood isn't necessarily a first order issue. But of course, this is something that, climate change in general is kind of throwing a curveball in what we understand to be the regular market. And real estate, of course, is a part of that. And so I imagine, although it's not my area of expertise to be able to say like what that looks like kind of projecting forward, but what I can say is that for the most vulnerable, these kinds of circumstances make their housing more tenuous to begin with, right? If they were housing insecure, at the outset, something like a wildfire and the kind of unpredictability of it will certainly kind of further aggravate those circumstances.
All right, Diana Hernandez, Assistant Professor for Socio and Medical Sciences at Columbia University. Thank you for being here on The Move.
Thank you so much. I appreciate it.
Coming back, we're going to talk about some of today's 10 trending tickers, but in the meantime, take a look at some of today's losers on Wall Street. We were just talking about PG&E. Those shares down sharply. Got some trending tickers for you from YahooFinance.com. I want to start with Tiffany, and I'm showing a bit of a longer-term chart here because Tiffany has had some ups and downs, as you can see, over the past couple of years. But today it's straight up, and that's after there was confirmation that LVMH has made an approach to Tiffany for $14.5 billion. There were reports on this over the weekend, and then LVMH confirmed this. We don't know yet whether Tiffany is going to accept the deal, but the shares are certainly popping on this. Some analysts are saying that the valuation needs to go up. in order for the deal to get done. And speaking of potential deals, let's take a look at Fitbit. Here's another one that's had a rocky couple of years. Fitbit shares, though, are popping 23% today, and that's after a report by Reuters that Alphabet, Google, had been in talks to buy Fitbit. We don't know if a deal will get done. We don't know the price that's associated with the deal, but the shares are up 23% on enthusiasm over it. And then where are we? Here we go. Lockheed Martin, taking a look at that one as well today. And not much changed even after we got a report from Bloomberg that Lockheed Martin and the Pentagon will be announcing imminently the long-awaited completion of an order for F-35s that could be worth $34 billion for 478 fighters, perhaps because this has been long in the works and long awaited, not seeing much stock reaction. And if you're following today's trending tickers, make sure you're watching the ticker. It's right here at 2 p.m. on Yahoo Finance.
But right now, we're going to go into the buzzer beater round. 3 stories, 1 minute each, and we're going to start with this. Instagram will expand its ban on content referencing self-harm to now include things such as cartoons and memes, or as we like to say, memes. Is this a good move for Instagram?
I mean, I could argue against censorship, but I could also argue, why did they even have these types of cartoons and memes or memes available to begin with? So I don't necessarily have an issue with them taking them away.
I mean,
Finally, Facebook gets something right.
Right. Well, that's what's so interesting to me about this story, right? Is that Facebook has been so hands-off in so many things, political ads, etc., and yet has been more aggressive on something like suicide prevention, to their credit. But, like, why can't they do that with everything?
Very good question.
Well, you saw Zuckerberg get pinned down by AOC last week. I mean, this isn't on suicide prevention, but on that very issue.
Ads, yeah.
You know, I mean, it's like, wait a second, if I lie, he couldn't answer it right or left. And then we saw what happened with a false ad that they did pull down.
Yes, exactly. So I don't know where the line is drawn. Here's a line of quite a different kind. Very interesting story here. Should obese children turn to surgery for help? New guidance from the American Academy of Pediatrics says it should be considered a safe option, surgery that is, for obese children. Something that wasn't necessarily considered by pediatricians in the past. Brian Sozzi looks very uncomfortable with this whole discussion.
I need to think a little bit more on this, to be perfectly fair, because I ate a lot of food as a kid. I was overweight. It took me many years to burn that off. So maybe I wish my younger self had a little more help and a little more guidance.
Well, there's overweight and then there's obese,
I was
right?
pretty heavy.
There is a line, yeah?
Yeah, I was pretty heavy.
Well, but there's also, I mean, it's coming from doctors, but it's not stomach stapling or tightening. There are reversible procedures, right?
Mm-hmm.
So, I think as a parent, you'd want to be careful not to deprive your child of the right nutrients that they need to grow into adulthood.
Hopefully the article actually says surgery as the last option, not as a first option. And I'm certainly not the expert here. I would assume that would be after proper nutrition and exercise, but I'm happy to read the article and hear what they have to say.
All right, well, Apple released new AirPods, and everybody is talking about them. They cost $250, although officially $249.99. They include noise cancellation, sweat resistance, and they have electrolytes. Features, they will be in stores October 30th. Who's going to buy them when you can buy the old pair for $99 and then go get silicone, covers for them?
I want 5 pairs of these right now. I think
they're great.
I'm a huge AirPods fan. I think they're great.
But you could get for $99 and then 10 for the silicone, overlay. You just saved yourself 100 and some.
We want the new stuff. It's Apple.
I'm in your camp. And as long as they stay in my ear, that's the most important things. I still prefer the earphones that stay over.
Without the adapter, the silicone adapter, they're not. You like yours.
I got no problem with mine, but I guess it depends on your ears, and it's
on yours.
Personalized. I mean, I run with mine, and
they're great.
They stay in there.
I feel like a better person when I have them on.
Well, I guess you're going to be $249 poorer than all the rest of us.
Right. There's your inflation.
Feel very good.
There's your inflation.
None of your team's getting Christmas gifts, are they?
All right, Brian Sozzi, thank you very much. Kevin Munn, good to see you as always. Let's take a last look at the markets. Here we have a record on the S&P 500, up still about 0.5%. The Dow has pared some of its earlier gains, up just 0.25%, but the Nasdaq up nearly 1% in today's session.
And we appreciate your being here. We're going to keep an eye on what's happening with these markets, obviously, because Y5 PM is going to take you through the next hour of trading.
It is 1 p.m. in New York City, and the major indices are firmly in the green to start the week, with the S&P 500 now trading well above its record high. On tap for today, a classic case of Merger Monday, with luxury conglomerate LVMH making a bid for jewelry giant Tiffany & Co., and Google reportedly pursuing wearable player Fitbit. We'll have which move is making the bigger wave today. Plus, Sir Richard Branson's space tourism company officially opened for trading, why he says the sky is the limit for Virgin Galactic shares as well. And backup generator company Generac hitting an all-time high as wildfires swarm California. The company's CEO will join us to explain why the state's energy problems are just one piece to the surging demand his company is now bracing for. All that and more. This is Wi-Fi PM. Good afternoon and happy Monday. I'm Zach Guzman, and joining me on Wi-Fi PM today is Yahoo Finance's Brian Chung, along with former GE Vice Chair and Imagine It Forward author Beth Comstock. Beth, good to see you again. Look, we got your book there.
Oh, thank you. Great to be here.
All right, well, let's kick off the show by checking the market action off the top. And right now, as I said, green across the board. The S&P 500, as you can see there, above its all-time high. The NASDAQ, though, on the day right now, leading the way higher, up by about 1%. We'll see where things go throughout our hour. But first, AT&T is climbing today after striking a truce with activist investor Elliott Management, which has been pressuring the company to change its strategy. The developments are outweighing mixed quarterly results for the company. AT&T posting adjusted earnings per share of 94 cents on $44.59 billion. And CEO Randall Stephenson will also remain in charge at least through next year. Brian, of course, when we talked about that battle that AT&T had on its hands, it's kind of a nice thing and reassuring today for investors to see that kind of that both sides here have agreed on where the company goes moving forward.
Yeah, I mean, you bring up a good point, which is that Elliott Management had a lot of demands for AT&T, a lot of kind of business model related issues. One being that they prefer that AT&T not do any more acquisitions. It's already heavily indebted right now with all the acquisitions that it's made in the past, Time Warner being the largest one to memory. Then there's also just the concerns about its kind of capital position. I mean, it's kind of weird. Elliott Management has been demanding that they actually up their dividends and try to return more to shareholders, but at the same time saying that they need to be a little bit more disciplined on paying down their debt. Those two things are kind of at odds with each other, but regardless, it seems like it's a good thing that AT&T has been able to come to some truce with Elliott Management. I think their stake was about 1%, but as is always the case with an activist investor, you always worry that they might gain traction in proxy votes with other investors to try to get changes actually done at the company. So the stock reacting positively shows that it seems like investors are pretty happy with AT&T's concessions right now, so that seems to be a good thing.
I mean, the company itself is dealing with things as well when we talk about subscription fall off, right? When we talk about people cutting cords here and what AT&T is dealing with. And some of their acquisitions that they made in the past, too, it's interesting to see kind of the pivot, right? Kind of committing to the idea that Singer's been pushing for and kind of holding off on any major acquisitions moving forward. It's a big break from what had gotten this company to where it is now. Beth, I mean, you've been on boards of multiple different companies here. I mean, how do you kind of weigh this in terms of changing the vision that's been there in the past to kind of pivoting and making sure everyone's happy?
Well, I mean, one, it's always good that you can agree with when activist investors come in. You can find some ground. But look, they did two really big acquisitions. And so I think that's a lot to digest and work your way through. So that seems like they need to focus on that. I thought it was interesting that they also, I think, as part of that, the dividends and agreed to more stock buybacks. Mm-hmm. As somebody who's always an advocate for the future, I always worry a bit when the playbook ends up being about stock buybacks as opposed to investing in the future. There are many ways to invest without doing big acquisitions. So I'll be curious to see how that unfolds.
Yeah, it's definitely one of those questions as they continue. As I noted, the shedding of the TV subscriptions, 1.4 million, the shedding there on that front, but adding more than 100,000 wireless customers as well. So there's kind of the pro-con there. But also on this Merger Monday, we're watching LVMH, the parent company of Louis Vuitton, eyeing a takeover of Tiffany & Company. Shares, as you can see there, in Tiffany & Co. Up by about 30%. It's a big Monday for that company. The deal would value the jeweler at about $14.5 billion, according to Bloomberg. Guys, though, some analysts think that Tiffany will hold out for a sweeter deal here. But clearly, I mean, Wall Street expecting something to come of all of this as we see a spike of about 30% for Tiffany.
I mean, this is kind of a weird situation where the stock has gone up so crazy on this news that maybe it actually even changes the, mathematics for LVMH to actually try to close this deal if it wanted to. I believe that the reports were that it was considering an all-cash deal, so not necessarily too tied to where the stock is going right now. But I mean, when you see the stock rising 31% on a potential acquisition target, you do kind of wonder if there are maybe higher bids in the market too. I don't know what other companies beyond LVMH might be interested in a Tiffany-like business model, but it does seem kind of interesting that the market reaction is that positive on this type of news. Now, of course, Tiffany has had issues in the past few years, declining trends with that type of luxury consumption, but I think it's worth watching to see whether or not the valuation is really proper for LVMH at this point.
They've had a good track record, LVMH, for acquiring a lot of brands and continuing to increase the value. So that seemingly people recognize the value.
And they've also been looking, I mean, they always look to expand in the U.S. as well. More recently, they've been adding warehouses to some of those brands that they have in their portfolio as well to kind of push the presence in the U.S. Tiffany & Co., no doubt, one of those big brands here in the luxury space in the U.S. as well. But Brian, to your point, whether or not a competitor could swoop in and kind of add on to that buyout pressure could also add to what we're seeing already, 30%, as I said, in Tiffany & Co. If there is a competitor bid out there, we'll continue to monitor how the company responds to that and potentially other bids, of course, as we get it. But that's not the only news we're tracking today, because today the sky is becoming the limit for a lot of different people watching space travel out there. Space company Virgin Galactic began trading on the New York Stock Exchange under the ticker SPCE earlier today. It's now the first publicly traded space tourism company out there, and Yahoo Finance's Adam Shapiro spoke to Virgin Galactic's founder, Sir Richard Branson, about what's to come. Take a listen.
Only 500 people have ever been to space, and that's including the Chinese, the Americans, the Russians, and we have the capability of putting hundreds of thousands of people into space in the years to come, and that's ridiculously exciting. And so, here we are on the floor of the New York Stock Exchange, launching the first spaceship company, and it's going to, the resources we get from this are going to enable us to do wondrous things.
So there you go, Sir Richard Branson rocking the very futuristic spacesuit.
On brand.
Yeah, it's very on brand. But of course, we can't call this an IPO. The company listed directly after finishing a merger with investment firm Social Capital Hedio Sophia last week. So it's not really an IPO, just kind of a special, an SPAC as they're known here to kind of get this off the ground. But it's going to be $250,000 is what tickets are priced at to actually take a ride up into space. Your thoughts on what we're seing?
I personally wouldn't buy that ticket, but I think that this is interesting that they've decided to publicly list, because I think as we've seen through SpaceX and also Blue Origin, which is Jeff Bezos's endeavor, there's plenty of private capital to fund these ventures, in addition to obviously the millions that I'm sure the billionaires themselves are also investing into this. But this is no longer a case where there's no money flowing around if you're not already an established company shopping for contracts with NASA. I mean, you can do a lot of private investment and make a lot of money off of it. And I think that the fact that they pursued Virgin Galactic being a direct listing as opposed to an IPO underscores that they didn't need that capital by going public. So I do think it's interesting, though, why maybe they then went public. It's kind of interesting. Maybe it's a marketing ploy. I'm not really sure.
It does get some attention. I'm with you. I'm not buying one of the first, even if I could, I'm not buying one of the first tickets.
Yeah, no.
How about you, Zach?
Well, part of it's the price tag, right? I think, and the other part is just how dangerous it is, and then kind of being one of the first, it's a final frontier, so you're the last pioneer of the final frontier. It's kind of confusing, but Sir Richard Branson has definitely said that he wants to drop the price tag from that high $250,000 mark to just about $100 or less. Take a listen to what he had to say on that.
We have 20 or 30 spaceships, which I think we will, in 20 years' time. The price will come down dramatically. That's all I think I can say. I think what we'll do is we'll exhaust the amount of people who can pay the $250,000. Then we'll, but by then we'll have a number of spaceships. We'll be able to bring it down to 200. Then we'll be able to bring it down to 150, then 100, and so on.
All right, so maybe not $100 per se, but maybe not $100 per se, $100,000. Even at that price point, I don't think it's very accessible. And that's kind of been the piece of this, right, when we've talked about it, is that for this commercial space idea to kind of reach the mainstream, it would need to drop down considerably before most of the consumers out there would even consider something like this.
I mean, yeah, I guess. I think that there's kind of maybe not so much of a price rigidity to this kind of thing, because I think the people that want to go to space are the ones that are willing to pay the high price of it. I'm not sure how many people would be convinced to change their entire perception of the safety of going to space, or whether or not they're even interested in space just because it's cheaper. I think that those that would be most initially or most inclined to maybe do this are perhaps those that have the money to do so and are willing to pay what would be a relatively high price tag to do that.
And to be early and first, although there's so many places on Earth still to go, and in the oceans. I mean, there's still a lot of places to explore here.
It's true.
That's where I'd be going.
Yeah. Well, nonetheless, on the first day of the stock actually trading, it's up by about 5% right now. We'll see what happens with space. Again, the ticker SPCE. But of course, earnings season is rolling on, and Apple is gearing up to report after the bell on Wednesday. Analysts polled by Bloomberg expect the tech giant to report quarterly earnings of $2.84 a share on revenue of $62.98 billion. Joining us now to discuss is Citi Research Analyst and Managing Director Jim Suva. Jim, when we look at this name, it comes at an interesting time. We've seen a lot of tech names out there. Microsoft today reaching an all-time high. Not so much pressure in the tech space, but in your eyes, is pressure mounting for Apple to deliver this Wednesday?
Well, the answer is absolutely yes. If you take a look at the stock price and the chart that has happened, investors have gone from under-owning or having a lot of concerns around Apple as to now actually liking it. We've seen a lot of changes in the political world also. Trade wars, tariffs, putting in firm deadlines that have been pushed back, and now some exemptions, whether it be on smartphones, whether it be on the Apple Watch and on PCs. A lot of these fears have started to be mitigated and become less worrisome. So yes, we are starting to see expectations increase for the first time in a while for Apple, but we still like the stock here.
Well, I mean, expectations have been there for a while whenever we talk about Apple, but they've been releasing some new features and products out there. Today, we got the latest new addition, the AirPods family, growing by this model, revealing the new Apple AirPods Pro, which features active noise cancellation and immersive sound. Jim, these will be available Wednesday when the company reports earnings, of course. What's your take on this edition? Of course, AirPods have become a little bit more important to the company overall, though still a very small share of revenue. What do you think about the latest edition?
Well, Zach, to be honest, I'm disappointed.
Whoa.
I'm disappointed because I got my pair for Father's Day, and they didn't have all these nice features, which means you're going to see me going out there buying these new ones again. So I do think the product will be a great stocking stuffer. A lot of people use them a lot, whether they're driving in their car, walking down the street, doing conference calls as they're running around with their family or children or friends. These products are very good. They may not be great for the extreme marathon runner, but for the average consumer, they are great products, and these are good enhancements. We think that they'll be pretty good stocking stuffers, and they fall into the category of Apple doing things beyond the iPhone. You think about the watch and how successful it's been. Now you have these AirPods and also other services such as Apple Arcade, Apple TV Plus. Apple is diversifying more and more with its products and services, and we think it's going to be a good, healthy Christmas holiday season for Apple. And this is just another example of Apple innovating and not staying only with the iPhone.
Hey, Brian Chung here. So you talk about the wearables. Google parent company Alphabet is now reportedly trying to buy the smartwatch company Fitbit that just crossed not so long ago. So Fitbit shares are just surging on that news. So Jim, do you think that this is really a good move? Would this be expensive for Apple? And if they do end up following through on this, what would the possible synergies be between those two brands?
Well, what we're seeing is in the space of the healthcare and technology spaces starting to merge, and those lines blur together. We all know when most of us go to the doctor, we don't know if it's going to be fully covered. If you have a $10 copay, $50 copay, $100, and same with your prescription, the healthcare industry has a lot of complexities with it. And technology is a disruption to a lot of complexities to make things smoother. We've seen Apple with the Apple Watch do very well. Heart monitoring, when people fall down, elderly, help me, I've fallen down. When people go mountain biking, we've actually seen people have their lives saved from this device. We think that technology and healthcare is a natural marriage over time to help out with lower costs but also make it so you don't have to be diagnosed by always going into the emergency room. So we think Apple going into healthcare continues to be good. Now, you did mention some speculation that's going on in the space. Speculation in Silicon Valley happens all the time.
Yeah.
And we will note that we don't expect the news and speculation to end, that there'll probably be more coming, whether it be in healthcare or other devices. But Apple is doing quite well in the healthcare segment, and it takes a lot of money, a big pocketbook and paycheck to go into it to get FDA approvals. And Apple's been quite successful in making early inning success of we think will be a long, fruitful endeavor for them.
Yeah, and you mentioned the speculation there. We did reach out to Fitbit. A company spokesperson said that they do not comment on rumors or speculation. So for now, not commenting on the prospective bid from Google.
Hey, Jim, I'm wondering, I mean, one, you could see that the iPods, as they get more sophisticated, they start to be part of that health equipment ecosystem that Apple starts to put out. How do you look at the future of Apple's investments in, say, content versus the healthcare space? Both very expensive. Where would you see that going?
That's a very smart question. The reason why we look at this is, A, it costs a lot of money, but we want to set up some milestones of can they get down this road and deliver on these different milestones. So we look at Apple's service segment as a percent of their total sales. It has recently gone into the high teens as a percent of total sales, and that shows some great success. Now, they don't detail out, and for competitive reasons, it's smart for them not to, how much is in healthcare versus apps versus Apple Music versus Apple TV Plus. But these are big investment areas. And these areas don't pay off in a quarter or two. But when you look at it to begin with, when the first Apple Watch came out and I bought it, a lot of people made fun of how the battery wouldn't last very long. Well, with time and enhancements, they've made a lot more enhancements to it where now the battery lasts longer and you no longer have to carry your cell phone to be able to use it and be tethered to it. And you've also seen now that the medical industry is starting to embrace it, as are people who are prone to fall, such as extreme mountain bikers or some of the elderly, and we've seen some very good positive signs. Great, smart question. A lot of money is needed to invest in this, but the way we monitor it as a percent of sales is it still growing? It's growing mid-teen % year over year, and now represents between 17 and 19% of Apple's total sales, depending upon the quarter.
Yeah.
So good success and gradual payoff.
Well, that's one of the interesting questions I think that'll be answered this Wednesday when we talk about it. You're mentioning short-term success versus long-term success, how much some of those cost incentives to build hardware with the software side might come into play when it comes to Apple's bottom line, and we will find out on Wednesday. But Jim Suva, thank you so much for breaking all that down. Appreciate you taking the time.
Great to see everyone. See you soon.
All righty. Well, speaking of Apple Music, we're also watching a competitor to Apple Music, Spotify, and shares in Spotify are soaring today. You can see they're up about 14%. After that company beat earnings and revenue estimates, the streaming giant posted adjusted earnings per share of 36 euro on revenue of 1.73 billion euros. It also added more than expected paying subscribers for its premium service. And guys, Reuters reports that in a letter to shareholders, Spotify notes it's adding roughly twice as many subscribers per month compared to rival Apple. So that part of the reason why we're seeing Spotify shares up. The company also announced its CFO will be stepping down in January. Of course, he was instrumental in the direct listing that got this company to become a publicly traded entity as well. But I don't know about you guys. Spotify, I've been playing around with Apple Music and Spotify at the same time. Spotify just seems to be crushing it on all metrics.
I mean, I'm an Apple Music guy, full disclosure,
Okay.
but I think Spotify, and for that matter, all the streaming services, I think the bigger question is the same with Netflix. Is at what point will there be an inflection where you would want to feel the pressure or may want to raise prices of the actual subscription itself? But I think based on the top line growth that we saw with Spotify, that doesn't appear to be an issue right now, but you do wonder, since they always have all those promos, I think right now they're doing one where you get a free Google Google Dot or whatever, the little voice activated unit.
To deal with Hulu.
Right, yeah, and they have that with, they offer these little freebies with the subscriptions. You do wonder about how competitive it really is. Appears to be very competitive to keep those subscribers on your service.
Yeah, no, absolutely.
I have both. I have a slight preference for Spotify, but I use both.
You use Apple Music as well?
Yeah,
no, it is
I've
nice.
been playing around with them. I mean, I love I like the curation on Spotify. That's
exactly
really
my
is
point.
It is better.
the winning.
They just know. They know
Yeah.
what they're doing there. When it's like, oh, I like this song. Now you also like this song. They're very smart with
Yeah,
that.
they're very
Apple
good.
Music has some catching up to do, in my opinion, but we'll see what happens with the underlying fundamentals this Wednesday. Coming up, Microsoft hitting a record high after edging out Amazon for a controversial $10 billion defense contract. But did politics play into the decision process? Plus, speaking of politics, we'll look at which Democratic candidates are becoming favorites when it comes to big tech donations, as the Biden campaign's cash position raises a big red flag. More on that when Wi-Fi PM returns. Welcome back to Wi-Fi PM. We're checking the market action right now, and you can see green across the board. The Dow up by about 100 points, and the NASDAQ continuing to lead the way higher, up by about 1%. We'll see where things go throughout the hour. Well, Microsoft is touching an intraday record today. You can see their shares coming down slightly off of that, up by about 2.25% today. The company beat out Amazon for a $10 billion Department of Defense cloud contract, and that certainly is boosting Microsoft shares today. The 10-year Joint Enterprise Defense Infrastructure, or JEDI contract for short, is part of the Pentagon's push to make it more technically agile. And guys, Wedbush analyst Dan Ives refers to this deal as a game changer for Microsoft. Of course, they've been battling Amazon in the cloud space for quite some time, and a $10 billion contract is surely enough to move the needle on that front.
Yeah, I mean, I think that, first of all, JEDI is an awesome name.
Yes.
Really right? Isn't that really good?
Yeah.
But I think that in general, everyone is kind of maybe overlooking the fact that Microsoft is so heavily invested in the cloud technology. And I think that this story would probably go mostly unnoticed because, look, it's not like cloud computing technology is as cool as some of the hardware that some people were used to seeing from Microsoft back in the early 2000s and such. But we have to remember that when it comes to these cloud computing competitors, when you think of IBM, when you think of Amazon AWS, when you think of HP GreenLake, these are all big players that really rely on these huge, large, en masse contracts. So I think that when we pay attention to the cloud space and who's really winning in this horse race, we have to pay attention to those government contracts like the DoD, even though it might not be the coolest thing or something you can expect to see on the front page of the Wall Street Journal.
There were a lot of people internally at both these companies that weren't necessarily fans of the idea of becoming the cloud provider for the Department of Defense or defense contracts because of what that might mean when you're being behind kind of the scenes in some things that employees didn't want to be connected with. We saw that from Microsoft and Amazon. I mean, that's a piece of this as well.
It is. I think also cloud is getting much more sophisticated. The Department of Defense will have much more sophisticated use cases. So for Microsoft, it's a way to show it attractive to new industries. I think the race is really on there, and AWS is trying to get bigger there too. So the fact that it's tipping a little bit to Microsoft's favor is good for them.
Yeah, and we're seeing the company benefit today for sure, hitting an all-time high, just kind of the exclamation point on winning the contract, as well as shareholders celebrate the win and what it might mean moving forward in the race to control the cloud. Well, from Silicon Valley to Washington, D.C. is where we're shifting gears. Yahoo Finance's Kristen Myers joins us now to break down which 2020 candidates are getting the most and least donations.
Yeah.
It's interesting because big tech is so much the focus right now when we talk about Democrats, but where's the money from some of these big tech companies and employees going?
Right. So first, to start off, I'll tell you where it's not going. It's not going to Cory Booker or Joe Biden. They are doing terribly among the employees for the big FAANG names, Facebook, Apple, Amazon, Netflix, Google, and also Microsoft. Now, you would be really surprised, or at least I was very surprised to discover that despite all of the calls, to regulate big tech, all the criticism of companies like Amazon, Bernie Sanders, all the employees of these companies are throwing the most amount of money. In some instances, over a third of the donations going to Bernie Sanders. Elizabeth Warren, pretty much hot on his tail right now. Just a couple of percentage points, at least when it comes to percentage of total donations, are going to Elizabeth Warren. But yeah, Cory Booker, Joe Biden, not doing well at all. Bernie and Elizabeth are killing the game right now when it comes to all of these companies.
So something really interesting is that there is a delineation between the tech companies and those that are working at these companies. So your study kind of looked at those that are working at these companies.
Correct.
So what does that tell you about whether or not people who actually work in big tech believe in the idea of maybe breaking those companies up?
So that's a really great point, because these are obviously the employees, not the CEOs of these companies, right? So Jack Dorsey actually famously has already come out and endorsed Andrew Yang, and Mayor Pete has also done pretty well among Silicon Valley execs. But the employees, of course, think very differently than the CEOs of those companies. And obviously, it seems like, at least when it comes to the people that work at these big tech companies, the rhetoric around regulating and breaking up these big companies is not at all scaring them off from making donations to some of these far more progressive, far more left candidates. And speaking of Andrew Yang, I actually wanted to see how well he did, because I would have thought that Andrew Yang would have done very well amongst big tech employees. And he's not actually doing that much better than Joe or Cory. He's only got less than 3.5% actually of total donations from these employees.
So Bernie still really dominating the tech space.
Bernie is absolutely dominating. And I have to say, because I actually pulled up all the numbers, he's doing a lot better, right? So while you have Mayor Pete and Kamala, they're getting around 15%. Bernie's getting almost 30% each time consistently from all of those companies that I mentioned.
The standout too, I mean, you could make what you want of which candidates are doing well, but I guess the common theme outside of tech and inside tech is that Joe Biden continues to struggle when it comes to raising money. We had highlighted a few weeks ago about how he was spending more money than he was actually bringing in for the last quarter. And of course, it's obviously a problem when we're talking about keeping things going, especially as you're losing momentum in the polls. But the presidential hopeful says he's not too worried about it. Take a look what he told 60 Minutes last night.
You have less than $9 million in the bank. Bernie Sanders has nearly $34 million in the bank. Senator Warren has $26 million. How do you compete against that?
I just flat beat them. We're on course to do extremely well. I'm not worried about being able to fund this campaign. I really am not, truly.
So should he be worried?
Yes.
I guess that's the question.
Yes,
You're just saying,
absolutely. He absolutely should.
Yeah, but he laughed it off.
Well, I mean, what else is he going to do, right? I mean, start crying on air and say he's going to have to give up his campaign. I mean, but the fact of the matter is Joe Biden is not bringing in as much money. So second quarter was actually when he announced his candidacy, did incredibly, incredibly well, raised over $22 million that quarter, actually he brought in around $6 million actually in 24 hours. So there was a lot of excitement when Joe Biden actually entered that race. And we have slowly seen, or rather actually pretty quickly seen, that enthusiasm for him as a candidate drop off. You've seen his poor performances when he hits the debate stage, and now when it comes to fundraising, he pulled in just over $15 million in the last quarter, which again is nothing to sneeze at. I mean, if you or I had $15 million, I think we'd all be incredibly happy, but this is a long race to the presidency, and it's an expensive race at that. You have Donald Trump on the one hand saying he's going to spend and raise $1 billion, and he's got 9 million cash on hand. He's not even close to any of his Democratic rivals, let alone what the Republicans right now are pulling in and what they're putting behind Donald Trump. So he says he's not worried. I would say that he's lying. I mean, I can't understand how he could not be worried that he doesn't have enough money right now to really keep on pace with just the other Democratic candidates. Yeah. And if we see now in Q4 that those numbers continue to drop off even more, it becomes a question of actually, will he actually be able to sustain his race?
And perhaps he knows something we don't. Perhaps he knows that he can turn things around in the coming quarter and really turn things around.
Money's not the end-all, be-all. Like,
Sure.
we do need to be clear on that. However, generally speaking, when it comes to American politics, the person with the biggest purse wins, and the person with the biggest war chest wins. Now, of course, that changes a little bit when you consider the presidency, but we're already seeing the polling numbers not doing very well for Biden, and the money numbers are not doing that well for him either.
Yeah, and only so much time to turn things around. We'll see if Joe can do it. Kristen Myers, thank you so much for bringing us that. Appreciate it. Well, it's not just the focus on the Democrats. We should give note to some on the Republican side as well. And Yahoo Finance's Rick Newman sat down with Republican Bill Weld. The former governor of Massachusetts discussed everything from free trade to his thoughts on President Trump. Let's watch.
I think the party will be dead unless Mr. Trump is either removed from office or defeated in the 2020 election. I don't think the party can survive another 4 years of Donald Trump. And, let's be honest, he cares about himself, period. So he wants all those Republican senators to walk the plank for him. And if they do, they will all be defeated. We won't have a Republican Senate. As a Republican, I kind of worry about not having a Republican Senate, because then if we get, a real lefty in there, they'll be able to get things through Congress. So I think it's well worth saving the Republican Senate. And I think the only way to do that is to have Mr. Trump out of there. And he doesn't care about them. And the evidence of his, removability is overwhelming. So they'd really have to blink not to remove him.
All right, and you can catch the full interview on yahoofinance.com. That is up now. Well, let's check in with Scott Gamm on the floor of the New York Stock Exchange for more market action we're seeing to kick off the week. Scott?
Hey there, Zach. Well, we're kicking off the week with some record highs in stocks thanks to some earnings and trade optimism. Now, the last couple times the market reached record highs over the past 6 months, those were preceded by some pretty notable declines in the market. But that was largely because after those record highs, President Trump tweeted some hawkish commentary on trade, and we don't have that right now, at least not yet. In fact, we have a lot of optimism on trade, so that is, of course, giving a lift to stocks. When it comes to individual names, we're keeping an eye on shares of Walgreens, which are down a little less than 1% on reports that the company has laid off some employees at its corporate headquarters in Illinois. Also reports that Walgreens will close 157 company-run health clinics in stores. So Walgreens shares under pressure right now. It's one of the laggards in the Dow Jones Industrial Average. And then we're also keeping an eye on shares of Uber as the company today launches Uber Money, which is its push into financial services. So think credit and debit cards, and maybe at some point bank accounts for the millions of drivers that it has on its platform. Uber shares are up almost 1% right now, Zach.
All right, Scott Gamm on the floor of the New York Stock Exchange. We'll check back in with you later on. But just ahead on Wi-Fi PM, wildfires continuing to rage in California as tens of thousands remain without power as utility giant PG&E navigates bankruptcy. We'll chat with the CEO of backup generator maker Generac, with the company hitting an all-time high, for more on what is to come out there. Plus, flames also erupting in Hong Kong, but for a very different reason. Why protests there are also sparking a recession. Wi-Fi PM is back in 2. afternoon and welcome to Wi-Fi PM. I'm Zach Guzman, and joining me today is Yahoo Finance's Brian Chung, along with former GE Vice Chair and Imagine It Forward author Beth Comstock with us in studio. Guys, thank you for being here.
Great to be here.
We're also checking the market action right now, and it's a good start to the week. Right now, green across the board, the Dow at more than 100 points, and the NASDAQ continuing to lead the way higher, up by about 1%. We'll see where things go as we approach 2 p.m. Eastern Time. Well, wildfires in California are raging on, forcing nearly 200,000 residents to evacuate their homes. And Governor Gavin Newsom has declared a state of emergency amid unprecedented high winds that are fueling the flames. This comes as PG&E says it has to shut off power to roughly 960,000 customers, and they did so over the weekend to prevent its power lines and equipment from creating more fires. And the company is warning more planned blackouts are looming this week as well. So joining us now to discuss the impact is Generac CEO Aaron Jagdfeld. And Aaron, your company is a leading global supplier of backup power products. Are you seeing a big boost in demand, and how are you keeping up with it if you are?
Yeah, thanks for having me on, Zach. We're seeing, obviously, as you would expect, incredible demand right now, well beyond what we would normally see out west. Normally, California's had a pretty solid grid, as history shows. They don't really get the severity of weather we see in other parts of the country, like hurricanes or ice storms. So, frankly, this fire situation is a brand new dynamic for us, and we're really trying to figure it out. We don't have a tremendous presence out west, and so our business is up a lot. Interest is very high, and right now it's just it's a matter of how much product can we get out there to help as many people as we can.
Yeah, when it comes to that, I mean, last time you were on the show, you were on with us at the end of August when we were talking about hurricane season. Now dealing with the fires and just the general power structure that California is dealing with right now. I mean, what are you seeing when it comes to meeting that demand? How hard is it for you to kind of facilitate your products to getting out to the people that need them, and then also just kind of making sure that you have enough supplies to meet that demand?
Yeah, actually, the actual supply of the product's not the difficult part. It's the actual installation of the product. These are products that need to be installed by a professional electrician. So, bringing those people up the curve in terms of training so that they understand how the product operates, how it needs to be installed properly, all the codes and things that go into doing this kind of a project. It really is a home improvement project, so you have permitting involved. Oftentimes the local utility has to come in to either help run the gas line that's necessary to make the product run, or maybe pull the electric meter to make the final connection. So there's a lot of parties that come together on this, and all of that kind of happening at once, as you can imagine, especially with the backdrop of just this environment right now, is making it pretty difficult to get the products installed, actually.
Hey, Brian Chung here. So obviously, I'm sure that you're used to having your products used in emergency situations like those that we're seeing out in California. For those that might be watching that are wondering what is the proper use for a type of generator like this, and whether or not there are kind of tips or tricks about the way to maximize the use of these types of things in a kind of dire situation like not having electricity at your home for the time being, are there any sort of tips or tricks that you have to offer to those that are using your product?
Absolutely. Well, there's two types of products. One is a product that's more of a temporary type of product where you'd use gasoline, extension cords, you'd run to a local DIY hardware store or retailer. You'd acquire that kind of product if you can find it, which again is a challenge right now. Everybody's trying to search for these types of products. That product is really used in a very temporary situation. You have to be very careful with those products in terms of carbon monoxide, making sure they're properly ventilated away from the home when they're operated. You have to keep fresh gasoline supplies handy so that you can refuel those as well. And then you've got the more permanently installed machines. These sit outside your home. They're a part of your home's infrastructure. They're permanently hardwired into the home. They run off the home's fuel supply, whether that be natural gas or propane. They're fully automatic. So those take a lot less care to really use. I mean, they're permanently installed, so there's not as much for the homeowner to do. But in both cases, whichever product you're using, I mean, if there's an evacuation order that's been sent to your area, regardless if you have a generator or not, we would not encourage anybody to try and ride these types of things out. They really need to evacuate.
What's interesting, though, when you look at your business, right, and I know you guys are going to be reporting earnings soon, but when you look at things, it's kind of evenly split between half and half, as far as I understand it, residential and commercial and industrial applications for your products. But it's not just emergency situations like what we're seeing in California. It's also just expanding infrastructure as well. 5G, you guys highlighted in your Investor Day, being a big piece of this as well as that continues to be built out. So what, in your mind, is going to be the biggest growth driver moving forward? Is it more situations like what we're seeing in California and hurricane disasters, or is it mostly going to be improved need to build out things like 5G and just general infrastructure changes moving forward?
Yeah, I think it's a great question, Zach. I mean, our business, as you pointed out, is about half residential, half commercial and industrial. And on the commercial and industrial side, we're serving hospitals, nursing homes, those telecoms that you mentioned, the wireless carriers, as they move from 4G, fourth generation technology, to fifth generation technology. It's going to enable a whole host of new technologies like automated driving, drone delivery, robotic surgeries, things like this that are going to require a constant connection, which is going to require constant electrical sources. I mean, everything basically in our lives today, if you look around, whether it's in your home or in your business, power is a requirement. Things get very primitive very quickly without a constant source of power. And you look at the grid today, and the grid has become, it's very fragile. As an asset, as a part of the infrastructure, vital infrastructure of the country, it's been holistically underinvested in. And our view on this is pretty simple. We view over the next 10 years that the classic utility model, this model of a centralized power plant delivering power across hundreds of miles or thousands of miles to your meter at your home or your business, we believe that that's ripe for disruption through technology and regulation. We believe that that's going to change. You're going to see a lot more on-site power generation with solar. You're going to see on-site storage. You're going to see generators become a much bigger part of this in either microgrids or other formats where people are going to be controlling more of their own power generation, their own storage, and their own consumption.
So Aaron, how are you looking at renewable technologies? You mentioned it. How is that lining up in Generac's portfolio, and specifically battery technology is something that could be a game changer in the scenario you put out?
Yeah, Beth, we've taken a very strong viewpoint on this recently. We acquired two companies earlier this year, spent over $100 million on these two companies. One is a storage company, a battery storage technology company out in Portland, Maine. And the other one is an energy monitoring and management company out in Vancouver, BC. The combination of these two companies is a brand new platform for us. We're referring to it as clean energy. And again, we see this as an opportunity area relative to helping people consume their power in a more conservative fashion, so you can be part of the solution rather than part of the problem. People are going to, as I said before, they're going to use solar as a generating source quite a bit more in the future, and being able to store that solar power for discharge in a time of day that makes sense for you, or in perhaps a time when the utility company has, is no longer available. But batteries are only a temporary solution. You're still going to need a generator, a standby generator, internal combustion engine driven product to really go the distance for longer term outages. I mean, what you're seeing right now with PG&E, these outages, the most recent outages, are going to go 3 or 4 days long. So a battery is just not going to be able to ride that through. I think it's going to, the technology is going to continue to improve both from a performance standpoint and from a cost standpoint. And we do think that that's going to be a major part of the utility infrastructure in the future. And that's really why we've made the acquisitions we've made. But we think it's really kind of both prongs are going to be important, the standby power generation and the batteries.
All right. Aaron Jagdfeld, Generac CEO, thank you so much for breaking all that down, and thank you again for keeping the power on for so many people that need it right now as well.
Thank you, guys.
All right, well, meanwhile, over in China, Communist Party leaders are sitting down for their first top policy-setting meeting since last year, and top of the agenda will be discussing the party's next 5-year economic plans, according to Chinese officials cited by the Wall Street Journal. Interestingly, while President Xi Jinping might not be up against an election in 2020, the party members will also be discussing how on track they are to meet Xi's goal of showing China's economy doubling between 2010 and 2020. To hit that, growth needs to stay above 6%, the level it fell to in Q3 this year. And since then, leaders in two foreign lobbying groups, the U.S.-China Business Council and the EU Chamber of Commerce in China, told the Journal they've seen an improvement in tone when it comes to attracting foreign investment. Early drafts of new investment rules, they say, emphasize that the government may not force technology transfers and limit trade secret disclosures for companies looking to go through China's review process. Guys, of course, both of those things are key to what President Trump's pushing for in his tariff tit-for-tat trade war that we've been seeing play out. So that would seem to indicate kind of a change in thinking on China's part, at least. Beth, I know through Nike, you're constantly tracking what's going on in China. I mean, it would seem, a very important headway being made here.
Yeah, I mean, I think any resolution to the tariff situation is good. I mean, global companies realize that. They sign up for the complexity of the marketplace. But this uncertainty has been very difficult for every company.
When we look at it, too, I mean, at Nike specifically, obviously changes at the helm there.
Yep.
I assume you would have been very connected to what was going on there.
Yeah, I've been on the board for about a decade.
Yes, I mean, when we saw this play out, Mark Parker going to be gone from his CEO role, but still staying on as chairman.
As chairman, right.
So, I mean, what went into kind of that search there? Because obviously the focus on digital has been so forefront to what Nike's doing right now. Was that kind of the main push in trying to find who was going to replace him?
Well, Mark led this process. I mean, this has been many, many months in the making. I think you got to look at it as a really great succession process. And I think Mark recognizing he's not going anywhere, but he's going to go into a different role. And John, being on the board for 5 years, has gotten to know the company quite well and brings this digital depth. John was very instrumental from a board perspective of working with various digital executives in the company. So he knows the arena and he knows Nike now. So I think it's a really good match.
I mean, John coming from ServiceNow, which I mean, some who maybe are looking at Nike and being, that's not a retail company, although he did have some experience at eBay as well. So I guess, does that mean that the focus for Nike is kind of the digital distribution channel? Not necessarily, people might be like, oh, digital, that means the Adapt BB, like, you know, digital sneakers. Not necessarily so, but is it the distribution that's going to be the name of the game for retail going forward?
Digital is part of every company, and Nike's not exempt, and it's part of every part of it touches everything in the company, from how you do inventory to what the latest app is. And so, you know, I think it's pervasive across the whole company, and having more people who understand digital is only good for the company.
One of the interesting pieces that came out after they made the decision to go with John was a lot of people were talking about opportunities for women today, right? And Nike, you're one of 3 women on Nike's board. Under Armour has 2, both male appointees for both these positions. Was there ever a woman considered?
There were a lot of people considered. I'll leave it up to Nike to tell you who was in the consideration. But look, I'm always for more women being considered and more women on boards, more women in leadership. Nike has a good pipeline. I think you'll continue to see more women step into great roles there. Their chief legal counsel, chief HR, Heidi O'Neill, who was the president over one of the big divisions. I mean, some great women talent and more in the pipeline. But yeah, I think Nike and every company, we want more diversity, more women. So I think you can keep your eye on that.
Right on. All right, very good. Well, coming up, we're going to stick with retail. A simple tweak to wear button-downs untucked. Help launch fashion brand Untuck It into the mainstream. But is it wearing off? The founder of the laid-back clothing line joins us next for more on how it's continuing to innovate in a tough retail environment right after this. Welcome back to Wi-Fi PM. We are checking out the rally to start the week, and you can see there the Dow now up more than 115 points, and the NASDAQ up a full 1%. We've been nibbling at that mark, and now we've hit it 1%. We'll see where things go as we approach 2 p.m. Eastern Time. Well, in a saturated retail market, a men's fashion company is emerging as one of the biggest brands to watch in recent years. The online-first retailer UNTUCKit is quickly expanding and is on track to open 100 retail locations by 2022. The brand also announcing today that it will be crossing the pond with 2 brick-and-mortar locations in London early next week. So joining us now is UNTUCKit founder Chris Riccobono. And Chris, it's good to see you. Thanks for being here.
Thanks for having me.
When we talk about UNTUCKit, it's interesting because it's a simple premise that kind of gave launch to the company, right? The idea that a shirt should be designed to be untucked. Right now, Brian and I are wearing shirts that are tucked in. But I mean, how has the growth been? Because you've expanded beyond just a shirt now. What have you guys been focusing on to lead that growth?
Yeah, we started with our button downs, and then we started to listen to the customer. They would come in the store or buy online and say they need T-shirts that are shorter. They need Henleys that are shorter. Then it moved into sweaters, and before you knew it, we built this great brand, had great customer service, and customers wanted to buy everything from us. It was easier to do, so we came out with pants, shorts, shoes. And then we went into women's because we had 50 stores or so, and women would come in with their boyfriends or husbands, and they'd be standing around saying, we have nothing to look at. So we launched women's, and that's one of our fastest growing categories.
It's very interesting there, too, because you could see the women's shirt tucked in. That would seem like a contentious thing to be doing here at UNTUCKit. But I also want to talk about direct-to-consumer brands, because that's really where you guys got your start. The average ad spend by direct-to-consumer brands is up 50% in 2019, according to a recent report. How has your marketing kind of shifted as you've moved into the brick-and-mortar locations as well? Is there one side that you're focusing on more now?
Yeah, I mean, we were always different than other brands from the start, because instead, when we came in 2011, most brands were just doing digital advertising.
Yep.
We decided to take fashion and advertise on radio and airline magazines and TV and newspapers, magazines, areas that a lot of people thought were in the past. And for us, the response was great. So we continue to advertise across many different platforms. We don't care if you buy in our stores or if you buy online. We just want it to be convenient for the customer, the true omni experience. So we don't focus our marketing pushing you one place or the other. Wherever you want to buy, that's easiest for you on that day, we're happy to make you happy.
On your strategy, I'm fascinated by the fact that you have so many retail, brick and mortar retail locations. For a lot of kind of D2C companies, they find that the overhead is just too expensive to do that. Why did you feel like that was an important part of your brand strategy so far? And is that really kind of weighing on the cost?
You know, we realized early on that a certain percentage of men, potentially up to 70%, always would want to touch and feel the product before buying it. And also, our demographic is massive. It's 25 to 70 years old. And typically, the older you are, you want to experience the brand and try on the clothes and touch the clothes before you buy the clothes. So we launched our first store in Soho in 2015. We opened up 25 or 30 the following year and 25 or 30 the following year after that. And it's been great. It's growing fast. We have nearly 80 stores now. We'll have 86 by the end of the year. We opened 5 in Canada, which are also doing really well. And to us, it's just always going to be part of the company. It's a mix between online and brick and mortar. And like I said earlier, people go back and forth. They'll buy online, then they'll go into a store. They'll go into a store and buy online. And it just makes everyone's life very easy as a customer.
Do you see global growth as part of your strategy? I mean, you have UK, you mentioned Canada, and I mean, is the UNTUCKit theme going to play in other parts of the world?
Yeah, I mean, we've learned they have the same problems we have over here. It's we're leading, you know, obviously US is much more casual so far than overseas, but they are following closely. And today you go into the nicest restaurant in New York City and you wear an untucked shirt, and that's where a lot of customers in London are doing the same thing.
Yeah.
So we think that we'll start in England, and if we experience the success we've had in Canada, then we'll continue to other areas in Europe.
All right, Chris Riccobono with UNTUCKit. Congrats and good luck moving forward. It seems that Relaxed Fit is certainly catching on both here and abroad as well. Beth Comstock, thank you for being around for the full hour. Brian Chung, thanks to you as always. Let's check in with Scott Cam on the floor of the New York Stock Exchange for more market action. Scott?
All right, Zach, thank you so much. I'm here with Peter Tuchman. So, Peter, we're seeing numbers across the broader market that we've never seen before. What does that mean to you?
Correct. So the Dow is a little bit off its record highs. That's probably just stock sensitive in particular.
Boeing.
Right, for sure. And a couple others. That's contributed to 300, 400, 500 points over the last 2 or 3 weeks. But the S&P is at record highs here. I think we may close at a record high, which would be nice. I think the market has momentum. Earnings have not been disappointing at all. Economic data seems to be solid. Plus, we're seeing the Fed apparently going to lower interest rates this week, which is proactive in the event of potential global slowdown in manufacturing. The consumer sentiment is solid. These are all good things. Markets firing on all pistons.
So just to play devil's advocate, if the Fed goes ahead with that third rate cut of the year on Wednesday, what is the case for further easing beyond that? I mean, the fact that we're doing so well in the economy and the stock market, does that lessen the case for further easing beyond what we hear on Wednesday?
I think it's interesting to note, though, that the economy and the market don't always go hand in hand, right? So they're saying to us that while economic data is solid, there are some headwinds, right? Manufacturing, global growth, and still the anxiety potential problem with the China tariff story. So that being said, yes, the market's trading on highs. The economy may not be in step with that, but if we give it the fuel, we will give it by lowering rates one more time this year. It will give it the fuel and the momentum to go further.
All right, Peter, we'll leave it there. Thank you, as always. Really appreciate it. Zach, back to you.
All right, coming up, AT&T is climbing after striking a truce with activist investor Elliott Management. And we're breaking down the details of that arrangement next. The ticker all over it starts in 2.
Good afternoon and welcome to the ticker on Yahoo Finance. I'm Akiko Fujita. We are breaking down the biggest stocks to watch today and take a look at the S&P 500. Now trading well above its record high, but we did see it touch that record earlier in the session. The Dow is up 124, the S&P up 17, and the Nasdaq up 81. Let's start with our big four tickers of the day. Fitbit is soaring on news of a buyout offer from Alphabet. AT&T is leaping on word of a truce with activist hedge fund Elliott Management, and Microsoft cashing in on a huge contract with the Department of Defense. And PG&E is deep in the red yet again as those wildfires tear through communities in California. Let's begin, though, with Alphabet. They are eyeing the smart watch space, and we did get this development just over an hour ago. Reuters now reporting that Google's parent company has made an offer to acquire Fitbit. The deal would make Alphabet a player in the wearable space, competing with the Apple Watch. Dan Halley joins us from the newsroom with the very latest on this. Dan, we're still waiting on the specifics of this detail, but how significant would this be for Alphabet at a time when they're trying to find some kind of in the wearable space?
It could potentially be huge for them. I mean, if you look at what they have right now, it's really just a piddling market share. They primarily work with Fossil Group, and they're using them to kind of get their technology out there. But really, nobody's purchasing Wear OS devices. And Google was originally rumored to be working on a Pixel smartwatch. Now, their Pixel line is what you'll find with the new Pixel smartphone, the Pixel 4, as well as their Pixel Books, their proprietary line of Chromebooks. And what they wanted to do with the Pixel Watch was something similar, but it never panned out. So this could be a move for them to get into the smartwatch space deeper and have some kind of real market share. Fitbit has been gaining as far as smartwatch share goes, but as far as overall wearables share goes, they're nowhere near what Apple is with the Apple Watch. In fact, the Apple Watch global market share is the largest by far, followed by the likes of Samsung and then Huawei. Google was one of the first out of the gate with its Android Wear operating system and then pivoted to the Wear OS, but they're really not a presence anymore.
Yeah, investors certainly seem to be liking this, at least for Fitbit. We are seeing this stock up more than 30% today. You talk about the small market share Fitbit has relative to some of its other competitors. If this type of deal goes through, what does this mean for them on that front?
It really could mean that they would get the backing of Google financially, as well as some of the expertise that they have in the engineering space. Now, it's important to note that Fitbit isn't just a hardware company. They've been making a lot of inroads into the kind of insurance space, as well as with healthcare providers, making sure that they're getting their hardware into their hands and then rolling out software initiatives. They recently launched their Fitbit Premium initiative, and that's a kind of pay for monthly operation where you would basically get ideally kind of customized fitness routines as well as coaching to help you improve your health over time. So they're really not just focusing on hardware anymore. In fact, CEO James Park has specifically said that they're moving away from being known primarily as a hardware company, and they want to be known as a software company. So it'll be interesting to see where Google fits in there. But as far as Google's own fitness experience goes, it's lacking, and it could really learn a lot from Fitbit there.
Okay, thanks so much for that, Dan, tracking the very latest developments on Google's bid for Fitbit. Let's move on to our next ticker, and that is AT&T. Shares there are popping after the company agreed to a truce with activist investor Elliott Management. But the developments are outweighing mixed quarterly results for the company. Emily McCormick is with me. And Emily, let's start with the latest on Elliott. It was just, 7 weeks ago that Elliott put out this 23-page letter saying that there needs to be a shakeup. It's a relatively quick resolution. What specifically are the terms here?
Right. So we just got news at the beginning of September that Elliott Management had taken that $3.2 billion stake in AT&T, said they saw the stock price potentially hitting $60 a share, but that they needed to make some huge changes to the way this company was being run. So here are a couple of the changes that AT&T disclosed today. They plan to appoint 2 directors to the board. They're not going to be making any more major acquisitions in the near term and are actually going to be selling off assets. Current CEO Randall Stephenson actually said during an earnings call today that AT&T plans to generate $14 billion through asset sales and other initiatives by the end of the year. So really a very aggressive turnaround plan here to try and reduce that debt pile that was at $153.5 billion at the end of the third quarter. And we think about it, Stephenson has really come under a lot of scrutiny for some of these acquisitions he's made over the course of his tenure. A couple of these were Time Warner, that closed back in 2018 for $85 billion, and then DirecTV for $67 billion back in 2015. So really coming under the microscope for what this actually means for AT&T's profitability, because it's still getting a lot of those core profits from its cellular plan business. So Elliott Management really coming in here and saying that they need to streamline the strategy.
So we are seeing the stock higher today on this truce, but they did report earnings, another disappointing quarter where they lost, 1 million customers for DirecTV. There's a lot riding on this streaming service, HBO Max. What are we expecting on that front? Because they've got a preview out this week.
That's right. So tomorrow, their investor day is supposed to be centered on the unveiling of HBO Max, getting a little bit more transparency in it. This is coming just as we're going to have Apple TV Plus, Disney Plus launched in the next couple of weeks. So HBO Max isn't isn't expected to come out until next spring. So a little bit of a delay there. The one benefit, though, is they'll be able to kind of see how these new streaming services do in the interim. They get to see the pricing, of course, priced very competitively compared to Netflix. So it's giving them some time to really evaluate the space, see what they need to do to be competitive. They do have some big ticket content. I mean, they inked a deal with J.J. Abrams, of course, the producer behind the new Star Wars films, Westworld, and they also will be the exclusive host of The Big Bang Theory. So they do have some competitive content coming to the platform.
Okay, and that preview coming out tomorrow. We'll be watching that. Thanks for that, Emily. Well, Microsoft is touching an intraday record after it beat out Amazon's web services for a Department of Defense contract. The Pentagon says the contract could be worth $10 billion over a decade. Jared Blickery is at the Wi-Fi Interactive board. And Jared, this is a big win for the company.
Yeah, and an upset for Amazon. A lot of people didn't see this coming. Microsoft is a distant second to Amazon, and it's a very competitive space. So a lot of analysts are saying, this is a $10 billion deal, but it is over 10 years. Not going to add that much incrementally to their bottom line, or their top line for that matter, but it is a big deal with respect to the message it's sending, and that is Microsoft is a contender. They have the security within their system to be able to compete at this level. And again, just a major win for Microsoft. And if we take a look at what the stock is doing today, it is at a record high. It opened at a record high. And I will go back to Microsoft here. For the year, let's take a look at this chart because we can see it's up 41, 42% for the year. Had been locked in this trading range for several months going all the way back to July. And within tech software itself, there was quite a few stocks that declined. Instead of just going sideways, they actually declined, took out a lot of stops, and there's been a lot of speculation that there's just not the impetus for traders in this particular industry, that is tech software, that there used to be. But this kind of sends a message that if Microsoft can do it, maybe some of the others can do it too.
Okay, thanks so much for that, Jared. Our fourth ticker of the day is PG&E. The utility company is looking to restore power even as wildfires devastate parts of northern and southern California. You see the stock there down more than 20% today. Thousands of people have been ordered to evacuate with power shutoffs affecting nearly 3 million customers in all. And this all comes after California's Governor Gavin Newsom declared a state of emergency last week. Inez Ferre is with me following the very latest developments. And Inez, let's start with what's developing over in Northern California, Sonoma County getting the hardest hit on that front. What is the latest response from PG&E?
Right. With respect to that fire in Kincade, the CEO of PG&E, Bill Johnson, has said that it's really too soon to know if it was their equipment which started that fire. However, you saw really the stock plunging on Friday when a news report came out that the broken wire with one of their transmissions had been reported just 5 or 6 minutes before that fire had started, very nearby to the fire. So that's when you saw the stock plunging. You also had a very bearish note from a Citi analyst who said that there was a 75% chance that the stock could go to zero, even with the prospects of this, because what it would do is it would basically jeopardize their control of their bankruptcy efforts. Now, there also has been a headline today that PG&E is saying that a power line may have started a fire in Lafayette. This is a suburb of San Francisco. It is west of Kincade. So we're talking about a different fire here. So you can see that the stock has really been under pressure today. It's been under pressure for the last week. I mean, in early October, around October 8th or 9th, the stock was trading at around $10 a share.
And meanwhile, and as we're keeping a close watch on another fire that has been spreading very quickly in Southern California, we are watching Edison International, given that's where Southern California Edison operates. What's the very latest on that front?
Yeah, what we know is that Edison had ordered a blackout for more than 300,000 customers and also businesses. But if you really look at Edison International, they have really been able to, the effects for them have not been as dire, of course, as for PG&E. They've faced a much better scenario. They have been under scrutiny for potentially causing a fire in San Fernando Valley. That would be an 8,000 acre fire, so their equipment is under scrutiny, certainly. But it's not, but so far as the utility company is concerned, they are in much better shape than PG&E.
Yeah, certainly a lot of residents forced to evacuate, including LeBron James there, so we'll be watching that very closely. All right, the S&P 500 today touching a record high as investors cheering on strong earnings and trade optimism over a deal between China and the U.S. The index is trading above 3029. The all-time record high set on July 26th of this year. Joining us now is Samir Samana. He is a senior global market strategist at Wells Fargo Investment Institute. Samir, it's great to have you on in studio today. Let me just get your thoughts on the moves that we're seeing today. No real deal in place just yet, but it seems like the optimism is pushing it higher, along with some surprise earnings results.
Yeah, absolutely, Kiko. I mean, a lot of it has to do with, it looks like we've taken hard Brexit out of the equation now in Europe. There is a delay until the end of January. We've also now, started to take some of the trade tensions out of the equation, where again, we don't have a grand deal by any means, but it is nice that both sides are de-escalating the situation. And in earnings, haven't been as bad as expected, and same with guidance. So you've got, enough things going on with low interest rates in the background to push stocks higher.
What stood out to you in the earnings reports that we've gotten so far? On the one hand, you could argue the expectations were pretty low going in, that a lot of these companies have been able to beat that. And yet we've also gotten some warnings from some of these trade bellwethers that have essentially suggested that investment is pulling back because of the uncertainty.
Yeah, I mean, for those reasons, we aren't terribly surprised. I mean, expectations were very low. A lot of the revisions going into the earnings season were very negative. So it's not a surprise to see companies beating, upwards of 80%. I think where maybe there has been a little bit of surprise is people expected probably more of a guide down going forward, and it is nice to know that businesses are hanging in there with a lot of the trade issues causing uncertainty.
Let's take a broader view here, because you've put out the study looking at where we are in this cycle, and you highlight the fact that the past 7 bear markets were accompanied, or 6 times were accompanied by a recession. Is there anything that you're seeing this time around that suggests that things could be different?
The growth this time around was so much slower. If you go back to the late 90s, which was probably the longest bull market previous to the one this time around, growth during that time frame was almost 2x, right? This go around GDP has only been growing a little over 2%. That one was well into the 4s. So the fact that this one's been a slower recovery does mean it could go a little bit longer. As far as what are those signposts that we're watching, there are things like M&A and IPOs. Both of those are kind of check boxes for us from the standpoint of this year's been pretty good. But there's other elements missing, like exuberance and equity inflows. So right now we would say it's kind of balanced. We don't see a bear market and or a recession in the next 12 months, but our antennas are raised.
One of the risk factors you point out is the Fed. We've, of course, have the meeting coming up this week. On the one hand, you say there's a risk that the Fed doesn't move quickly enough in cutting rates, but there's also the risk that the Fed doesn't have enough levers when the recession actually comes around. Does that kind of counter each other?
It does. I mean, that's the problem with being as close to zero as we are, and the Fed and other central bankers will be the first to admit it, right? Is that, close to the zero bound, we have to act aggressively, but we also don't have that much left, which is why you heard Mario Draghi today talk about, look, we need some help from the fiscal side, and I think that's where the Fed will also go, if they find themselves back at zero, is that, look, we only have so many tools in our toolbox, and we do need some help from the fiscal side.
But what are the levers on the fiscal side at a time when we're looking at record debt?
Sure. So, I mean, it will have to be carefully crafted. It probably will have to be somewhat funded. But I think both sides of the aisle would probably agree that the infrastructure in the U.S. could, use a much-needed upgrade. So once you get past the elections, once, maybe some of the, competition kind of cools down between the two parties, maybe they can go back and really think about infrastructure and maybe fund it in a responsible way.
We've got this study out from the NABE today that suggests 35% of companies cited tariffs having a negative impact in October. That's up from 28% in July. How do you factor that all in, and what specifically are you seeing on that front as it relates to trade and as we look to a potential truce at the APEC summit in Chile?
Sure. So the truce will be helpful, but the tricky part is, one of the things we talk about in the report is that corporate debt levels are one of those areas of debt that continue to grow. This go around, it's not so much consumers, but it's been governments and then, corporates with, again, borrowing at low rates, buying back stock, et cetera. Now, the bulls will argue, well, look, the servicing ratios are still fairly healthy from the standpoint of rates are low, and so businesses can continue to kind of, pay down their debt. What we worry about is as you get later in the cycle and credit spreads maybe widen out a little bit, some of those debt levels in aggregate being as high as they are could be problematic. And so you never quite know what starts the next downturn, but trade tensions would probably be one of the primary suspects this go around. And so it is nice that both sides, at least at this point, are ratcheting things down.
And from a strategy standpoint, how do you think investors should be managing their portfolio? Is the idea to be much more active given the moving parts, or do you just kind of hold back in a passive fund?
So what we would say is not so much active, because again, market timing can be, tough to get right, often. So what we want people to do is be proactive, right? Think about the fact that the bull market just celebrated its 10th birthday. We have now quadrupled on the S&P, and today we're sitting at all-time highs. So, again, just mathematically, this is a pretty good time to pull back on stocks, right? There's never been a better time to pull back on stocks in this cycle. And so for a lot of investors, it's probably a good time to pull a little bit off the table from an equity standpoint, especially in smaller companies, and maybe think about, look, are our cash balances where they should be? Is our allocation where it should be? Maybe we should have a little bit more fixed income given that we're all 10 years older. So those are the things we want investors to be looking at.
Okay, and very quickly, as we look to year end, what do you think is the one risk that the market is maybe overlooking right now?
Probably the biggest thing is complacency. So it's not so much that there are a lot of events on the horizon, but you could have something like the Fed maybe skip a rate cut. We don't think so, but now you've got kind of the expectations so high that if you saw anything slightly unexpected, the market's probably going to take a little bit of a tumble.
Okay, Samir Samana, great to have you in studio today. Coming up, new signs of progress for a U.S.-China trade deal. The CEO of one of the biggest players in U.S. shipping joins us with his reaction next. And later, will Tiffany put a ring on it after a takeover bid from LVMH? New details coming up. Welcome back to the ticker. Let's check the markets very quickly here. The S&P 500 coming off of that record high, but it is still up 18 points roughly there. Let's get out to Scott Gamm on the floor of the New York Stock Exchange. Scott.
Hey there, Akiko. Yes, the broader market is at record highs right now. And remember, the last 2 times we hit record highs in early May and late July, those levels did not hold, largely because of some negative trade developments that happened right after those records. So we'll see if these levels hold, but right now we're holding above 3040 in the S&P 500. When it comes to individual stocks, we want to point out the gain we're seeing today in Apple shares, another record high for Apple as well. The stock is now over $248 a share. We know the company reports earnings on Wednesday after the close, but today Apple unveiling AirPods Pro with a noise canceling ability. Those will cost $249. Apple is one of the gainers in the Dow today. And then we're also keeping an eye on shares of Walgreens. The stock was down earlier, but it's now roughly flat. Reports of layoffs in Walgreens corporate headquarters in Illinois. Also reports that the company will close 157 company-run health clinics in its stores. Walgreens is one of the underperformers in the Dow today as well. And then finally, Uber shares are in the green right now. The company unveiling Uber Money, which is its push into financial services. So think debit cards, credit cards, and also maybe at some point bank accounts for the millions of drivers on Uber's platform. Akiko.
Okay, thanks so much for that, Scott. Trade remains top of mind for investors as President Trump hints that phase 1 trade deal with China could be signed off earlier than expected.
We are looking probably to be ahead of schedule to sign a very big portion of the China deal. And we'll call it phase 1. I would say a little bit ahead of schedule, maybe a lot ahead of schedule. Probably we'll sign it. I imagine the meeting is scheduled for Chile.
This comes as many businesses struggle with uncertainty while waiting for the world's 2 biggest economies to finalize an agreement. Joining us is John Wobensmith. He is the CEO of Genco Shipping, and he is with me here in studio. Welcome.
Thank you.
You are right in the thick of things, given that you're in the shipping space. So you've got a lot more clarity on what has really shifted up since this trade war began. You've talked about some trade channels that have opened up as others have closed. Give us a snapshot of where things stand right now.
Well, things are actually pretty good in dry bulk shipping. I think you have to take a step back and understand that 90% of global trade travels on ships. Half of that is related to dry bulk shipping. So iron ore, coal, grain, soybeans have been obviously a big part of the tariff story. The reality is that only 1% of dry bulk trade is U.S. soybeans. However, soybeans coming out of Argentina and Brazil are also a very important factor. And what has happened is, because of the tariff situation, you've seen more of a shift to China importing from Brazil and Argentina.
So when you look at the increase that we've seen between Brazil and China trade, and you add Argentina into the mix, let's say there is this phase 1 trade deal that is signed. China agrees to buy much more soybeans now. How quickly can that shift up?
Well, I think it can shift pretty quickly. I think the U.S. harvest is probably about halfway done from what I understand, and there's about 100 million tons this year of soybean. In a normal year, a tariff-free year, if you will, you would typically have about 33 million tons, or about 35% of the U.S. soybean trade being imported by China.
We're focused a lot on U.S. and China, but obviously you ship globally here. Yeah. When you look at the trade activity that you have seen over the last several months, what does that suggest in terms of the health of the economy?
Well, I think from a Chinese perspective, so one of the biggest factors is the Chinese steel industry, because China is importing a lot of iron ore, which we ship from both Brazil and Australia. Those are the major trade routes. And what we've seen is steel production in China up 8-9% this year off the back of 6 to 7% growth last year. However, there has been somewhat of a slowdown in Europe and Brazil on the steel side. But from a dry bulk shipping standpoint, because we're shipping a lot of iron ore into China, it's been very beneficial for us.
So what does that suggest in terms of the activity within China?
I think China is continuing to stimulate their economy. Our view is that there are more stimulus packages internally in China to come. And they've been focusing a lot on infrastructure spending. The One Belt One Road project is a corollary of that. And so again, we're seeing that money go into steel-related industries.
From a business standpoint, what has all this uncertainty meant for you in terms of where you put your investments moving forward? Whether it's looking at new ships or looking at new routes, Has that put things on hold maybe because you're not sure where the trade deal is going to be signed or what the impact is going to be on that front?
Well, so I think, companies that are not well capitalized have put plans on hold. Genco has a very strong balance sheet. We have a lot of cash, low debt levels. So we've been able to continuously look at new projects, different types of projects. The good news is that because of the lack of capital, the uncertainty, people are not building ships, they're not ordering ships. And that is one of the key factors in what causes shipping rates to go down when you have a lot of ships deliver. So we've been 3 years into a recovery on the dry bulk side. We haven't seen the typical ordering of new ships that you would see when rates rise. So that's why we think this recovery will actually be extended for another couple years at least.
So how does that change up your operations?
From our operations, our freight rates move up. I mean, that's the big benefit, right? So if you look at our largest ships, which are Capesize ships, we're shipping predominantly iron ore and coal. But then in our medium to smaller size ships, we're shipping minor bulk products like soybean, like corn, like wheat, salt, gypsum, cement, fertilizer.
And very quickly, you've talked about the impact on the business side of things, but you've also talked about the impact on the equity side of things.
Yes.
Given the sentiment, let's say come November there is a phase one trade deal that's signed. What does that mean for obviously the stock, but also the sentiment as a whole around the shipping sector?
This is one of the big dislocations. So the dry bulk shipping industry is healthy. As I said, it's in the middle of a recovery. However, the equities, Genco and all the other dry bulk stocks are all trading below their net asset value, which I think is a psychological reaction to these trade wars. So I'm cautiously optimistic that if we get at least a phase one deal done, that equities in the dry bulk shipping space will start to match what is actually their cash flows and their earnings stream.
Okay, John Wobensmith, good to have you in studio.
Yeah, thank you.
Well, the 2020 race is heating up. Yahoo Finance's Rick Newman sat down with Republican Bill Weld in the latest Meet the Candidates installation. The former governor from Massachusetts weighed in on everything from Senator Elizabeth Warren to free trade.
Free trade always benefits us. That's not to say it doesn't benefit other countries as well. Free trade benefits both sides. And Mr. Trump massively does not understand this. He thinks everything is a zero-sum game, so you have to start out with a very unreasonable position and just get pushed off it a little bit, and that way you always get to, take advantage of the other guy and get a better deal. Read The Art of the Deal. It's all about taking advantage of the counterparty. That's not the mindset I would bring to international discussions.
So the most obvious part of Trump's trade policy is the tariffs. Would you remove those tariffs right away?
Yeah, Mr. Trump's first instinct in foreign policy is tariffs and sanctions. It's all negative.
And you can catch the full interview on yahoofinance.com. Well, coming up, LVMH making an eye-popping proposal to take over Tiffany, but Tiffany may want a bigger ring. We'll explain next. Plus, Virgin Galactic aims for the stars in its trading debut today, but it's got a long way to go to prove success to investors. Those details coming up. Welcome back to The Ticker. I'm Akiko Fujita. Let's give you a quick recap of the tickers we've covered in the show today. Our first ticker was Fitbit, Alphabet making an offer to acquire the wearable device maker. That's according to Reuters. The exact price hasn't been revealed yet, and Reuters sources caution that the negotiations may not lead to a final deal. Second ticker was AT&T. It's made a peace deal with the activist hedge fund Elliott Management. Among the terms, AT&T says it will consider spinning off its $10 billion worth of non-core businesses next year, along with adding 2 new members to its board. We also looked at PG&E. Its stock nosediving yet again, down more than 20% as 2 major wildfires burn in northern and southern California. More than 3 million customers forced to lose power over the weekend because of those strong winds. Another round of gusty conditions are forecast to hit the state tomorrow. And we are checking the closing price of oil. Oil coming under a bit of pressure today, down nearly 2%. We're looking at $55.68 a barrel. This comes as President Trump predicts he will sign a, quote, very big portion of a trade agreement with China ahead of schedule. He didn't give more details on the timing. Many analysts note a deal would provide a big boost to global oil demand. Let's get to our next group of tickers. Tiffany shines after a big takeover offer from LVMH, but will Tiffany demand more? Virgin Galactic is making history as a first public space tourism stock, but it may have turbulence ahead. And Spotify is soaring after delivering an unexpected surprise to investors. LVMH, though, the parent company of Louis Vuitton, eyeing a takeover of Tiffany and Company, and we are seeing that stock soar up more than 30% right now. The deal would value the jeweler at roughly $14.5 billion, according to Bloomberg. And Jared Blickery is back with me. Jared, this is far from a done deal, but certainly a big offer on the table for Tiffany to take.
It's a big offer, and some people are saying it's not enough. Now, this values Tiffany at about 14 times EBITDA, and transactions that are similar in the past, including LVMH's purchase of Bulgari back in 2011. That was done at 23 times EBITDA. So one analyst is saying that, well, a $120 share price really should be $160. That's probably why we're seeing a little bit of a premium embedded in the price right now. This is what happened today. We can see, of course, there's a big jump up and basically holding its ground throughout the day. And if we look at a year-to-date chart, we can see it's up now with today's movement, 60% year-to-date.
And what would be the play for LVMH? This is, of course, a company with some big luxury names in their portfolio. What does Tiffany bring to the table on that front?
Well, as I said, they already have Bulgari, so Tiffany would be kind of a step down, but also a more affordable option available to millennials. This would increase their market share to 25%, and not only in the U.S., but also in Asia, so that's key. There's really not a lot of overlap in this deal, and so there's speculation that there might be counteroffers by other companies, such as Richemont here, but that's a smaller company, and they would have a lot more overlap. So again, looking at LVMH stock now, we can see it's up about 48% year to date, holding around the highs that it reached in July. But luxury retailers or luxury brands have had a pretty good year so far. Spending from China is down, especially in the U.S., but with that presence over in China, it could boost their portfolio.
Yeah, we've seen Tiffany talk about their struggles in the region as well, especially in Hong Kong. All right, thanks for that, Jared. Well, to infinity, Wall Street, and beyond, space company Virgin Galactic began trading on the New York Stock Exchange under the ticker SPCE earlier today. It is now the first publicly traded space tourism company, and that stock is up more than 3%. Yahoo Finance spoke with Richard Branson earlier about the company's growth possibilities.
We have the capability of putting hundreds of thousands of people into space in the years to come, and that's ridiculously exciting. And so, here we are on the floor of the New York Stock Exchange, launching the first spaceship company, and it's going to, the resources we get from this are going to enable us to do wondrous things.
Inez Ferre is back with me. And Inez, you were on the floor of the exchange earlier with Sir Richard Branson in that spacesuit there. Let's talk about how this is structured, though, because it's not exactly an IPO.
Right, that's right. This is made possible because they merged with a company, which is a special acquisition company. It's called Social Capital Hedosophia. So that company had already been trading at the stock exchange under the ticker symbol IPOA. Well, as of today, those IPOA shares turned into SPCE shares. That's because they invested in the company. They bought about 49% of the company. And so once that merger took place, then it allowed Virgin Galactic to list under the ticker symbol SPCE. So yeah, there was a lot of excitement there on the floor, just because it's, I mean, think of it what you want, space travel, but it is a cool, in my humble opinion, it does seem to be a very cool thing. And so it's a first. It is a first as commercial space tourism company.
Yeah, I know this is a space that you follow very closely, something you're very passionate about, but I know you've been also speaking to NASA astronauts about the potential of space tourism. What have they been saying about this?
Yeah, so I spoke to two former NASA astronauts who say that, of course, the whole space community has been watching this closely, and they think that it's very exciting. The question is what kind of addressable market you have here, because at that price point of $250,000 per flight, per passenger, then it's questionable of how many people will really be able to pay for a ticket like that. Now, Virgin Galactic says that they have more than 600 reservations from over 60 countries, that they also they will be able to have more spaceships operating in the future. So they're planning to have 5 by the year 2023, and they plan to make it more cost effective in 5 to 10 years, just be able to build in a less expensive way and be able to make it more cost effective. You do have, and these astronauts had said to me, because you have several of these companies, you've got Jeff Bezos' Blue Origin, you also have Elon Musk's SpaceX, although those companies are focusing a lot on moon travel and then to Mars. You do have competition that's sort of heating up, and that in the long term should bring costs down. But right now, it really remains to be seen how many people will really be able to pay for a $250,000 ticket. Now, Richard Branson did say today to Adam Shapiro that once they exhaust those customers that can pay $250K, then they would bring the price down to $200,000 and $150, et cetera, as they make spaceships that are or spacecrafts that are more economical.
Yeah, it could be years away before you and I could pay for a ticket to space.
I hope it's in my lifetime.
Thanks for that, Inez.
Thanks.
Let's move on to our sixth ticker of the day, and that is Spotify. Shares there are surging after the music streaming service posted quarterly earnings that beat on the top and bottom line. Total monthly active users also jumped roughly 30% to 248 million, and we are seeing that stock up more than 14% right now. Emily McCormick is back with me at the desk. So how is Spotify growing its user base?
Well, a lot of this third quarter growth really came from discounts and certain promotions that it had. So that's why we saw that really big 30% jump in monthly active users, and about the same for those premium subscribers. So we saw the launch of a 90-day free trial offering for the standard and student plans back in August. They said that had helped boost results. Also announced a U.S. partnership with AT&T, which offers Spotify Premium as an add-on to some of its wireless plans and a 6-month free trial to some of its bundle subscribers. Then if we look on the international front, that's where Spotify is really shining. So the company said Southeast Asia actually remains the fastest growing region, and then said India outperformed internal forecasts by 30%. They just launched in that region back in February of this year.
And when you look to the future of Spotify, one of the things we heard today from the CFO is that podcasts will be as important as streaming is to Netflix for Spotify. What specifically are they looking at right now?
Yeah, and that was really an extraordinary comment, I think. I mean, if we just look at, Barry McCarthy, the CFO, who will be retiring in January 2020, he was an executive at Netflix, helped bring that public, so really sees the workings of some of these streaming platforms. So to really make that conflation, I think really speaks broadly to how the growth opportunities here in podcasts. So they broke out that podcast hours were up 39% quarter over quarter, said podcasts now reach 14% 30% of total monthly active users. That means 35 million people listen to a Spotify podcast at least once a month. Spotify has really been investing heavily in this space. They spent more than $400 million since the start of this year on 3 acquisitions. So that was Gimlet Media, Anchor, and Parcast. So, I think this really is just a crux of their strategy is really trying to get listeners' ears really focused more on the podcasting side as opposed to just the music streaming side, particularly because if you think about just licensing as well, there's a little fewer loopholes and fewer hurdles for them to have to cross for some of those licensing agreements on the podcast side, especially now that they have these companies in-house. So that's really the direction that Spotify's moving in.
Yeah, it is fascinating to see he sees that much growth, given how crowded it seems like the podcast space already is.
Well, but it's just been a land grab especially on the part of Spotify. I mean, really going in this year and making these 3 acquisitions for these 3 huge companies. They're really trying, I think, to get ahead of that competition.
Okay, Emily, thank you. Well, investors are gearing up for a busy week ahead. In addition to the slew of earnings reports, the Fed, the Bank of Canada, and the Bank of Japan will announce its respective policy decisions. The October jobs report and ISM manufacturing data are also out on Friday. Joining us is Dan Deming. He is the managing director at KKM Financial. Dan, what are you watching? All of the above.
I think you covered it, Akiko. I mean, certainly the Fed's going to be in focus on Wednesday, but the earnings have been the driver so far, and there's been a very positive tone to the earnings announcements. And when you look at the underlying forces within this market, I think you got to point back to the financials kicking this off a week and a half ago. So, we're continuing to see the momentum here shifting back towards the upside as we see now the S&P in record territory and the NASDAQ flirting with a record closing high as well.
What's been the most surprising part or surprising element that you've seen so far in these earnings reports that we've gotten? Obviously, they've performed much better than expected, but is there a nugget that stood out to you that was a bit surprising?
Yeah, I mean, I think just the general tones that, the narrative moving forward that I think many market participants and the messages that are being delivered in a lot of these earnings announcements, that they're hopeful that if this trade situation gets resolved, that ultimately it will not drag too much on further expectations from an earnings standpoint. So I think, that's a positive underneath this market. And now the market's getting that theme reinforced by the narrative coming out of D.C. as well. So I think, that's really another big driving force here is the hopefulness that there's trade optimism. We got a little more clarity on the Brexit situation, but ultimately that earnings aren't, they're beating lowered expectations, but they're not being ratcheted down as far as guidance moving forward.
You talk about those 2 key issues, the trade issue as well as Brexit. Let's just take trade, though, because we saw the S&P 500 hit a record today. How much of an actual deal has already been priced in, you think?
Well, a fair amount, but I don't think the market's going to completely fall apart if for some reason there's a few hiccups here in the next month. When you look at the way the bond markets are acting as well, the repricing of interest rates, the expectations now are the Fed's just going to cut one more time and then be on hold for several meetings, and you're seeing it being priced out globally as well as you're seeing global bond markets adjusting as well. So, I think that the underlying theme here is very hopeful, and again, that trade situation trending in the right direction. I don't think the market needs a done deal, but they just need to know that it's progressing in the right direction.
And looking ahead to Wednesday and the Fed decision, what do you think the market is looking to hear from Jay Powell in terms of the outlook, moving forward? What we have seen, at least in the previous decisions, is one, an expectation of a rate cut, but also a big move in the market on the back of his press conference and the commentary moving forward.
Exactly. Yeah. So, I think the market's going to be very focused on how they project the parts moving forward. Basically, they indicated in the last meeting that they're going meeting to meeting now because of the uncertainty surrounding the trade situation. So I think that the market's going to be very focused on, are they going back to some type of path-directed or dot plot type of, initiative after this meeting, going back to where they want it to be as opposed to a mid-cycle adjustment. So I think the market's going to be very focused on that. And I also think, Akiko, the market's going to be focused on, I think he's going to get some questions about the overnight repo markets as well. And again, we've seen that continue to swell underneath the markets. Hasn't disrupted the markets too much to this point, but there's something there, and that's a form of liquidity, and I think he's going to have to answer to that as far as how it's incorporated into projections.
Okay, Dan Deming, always good to talk to you.
All right, thanks, Akiko.
Coming up, why more U.S. cities are seeing signs of a recession on the horizon. Details on a new report next. Plus, how the skyrocketing demand for package delivery is fueling chaos and gridlock in places like New York City. Stay with us. U.S. cities are seeing cracks in the economy as 2 in 3 large city finance officers predict a recession as soon as next year. According to a new report from the National League of Cities, municipal budgets are facing pressure since for the first time in 7 years, city revenue collections are declining. Joining us is Christiana McFarland. She is a research director at the National League of Cities. Christina, let's start with the significant declining revenue collection. Why are we seeing the downturn on that front?
Sure. Thank you for having me. Well, what we're seeing is, as you mentioned, the first time in nearly 7 years, finance officers are anticipating in FY19 that they will start seeing revenue declines. This comes after many years of recovery, slow recovery since 2010 or so for cities across the country. Notably, what we're starting to see in particular is that revenue declines are most significant in the Midwest.
And why are we seeing those declines in revenue in the Midwest?
Particularly for cities in the Midwest, we're seeing this in large cities in particular. Notably, the economies in the Midwest have not recovered as strongly as the rest of the country, even following the Great Recession. So coming into any economic downturn, they're just less well positioned to weather even small changes. With that, we're also seeing changes in the economy in general when it comes to manufacturing and technology and the way that the economy is shifting for places in the Midwest. We're also seeing the effect of trade and just the uncertainty around trade and other global economic factors affecting places like the Midwest most severely.
I looked at this report and I thought, well, there's a huge divide here between sort of the headline numbers that we look at and what we hear from the White House saying this is a great economy right now. How big is that divide? And is it really about sort of the coasts in the middle? I mean, what do you think is leading to that divide in sentiment?
Yeah, it's a great question. A lot of what we're seeing in particular is that oftentimes city revenue sources, whether it's property tax, income tax, sales taxes, city revenue sources are not aligned as well as they can be with the underlying sources of the economy. So although there are some segments of the economy that may be doing well, those are not necessarily revenue sources that cities can tap. We talk about online sales, although that should be coming online for cities, down in the next couple of years or so. Most cities are not able to collect sales taxes for online sales, whether they don't have access to a sales tax or that's just not set up from their state in order to allow them to do that at this time.
And what did you find on the opposite end? You talk about the Midwestern cities saying they've been hit the hardest. What are the areas that are in better financial condition or that are in the top financial conditions?
We're seeing cities in the West reap some more benefits, and again, robust economy happening in western part of the country, and as well as on the coasts. But even within in places that are doing fairly well, we're seeing that, again, the large cities that are in those places are seeing a larger gap between revenues and expenditures, meaning that they have more pressures on their budget for things like human services and housing and infrastructure.
Okay, Christiana McFarland, appreciate you joining us today.
Great, thank you.
Let's give you a quick recap of the tickers we've covered in this show today. Our first ticker was AT&T. It's made a peace deal with the activist hedge fund Elliott Management. The company will look to sell off up to $10 billion worth of non-core assets next year, and it's also considering adding 2 new members to its board. Second ticker was Microsoft. It's won a major Defense Department contract over rival Amazon. The $10 billion 10-year deal will play a critical role in developing cloud computing infrastructure for the Pentagon. Our third ticker, PG&E. It is another grim day for the company as those wildfires burn in Northern California and Southern California. Millions of people forced to lose power over the weekend as the utility scrambles to reduce further wildfire risks. We are seeing the stock down 26% now, and another forecast calling for windy conditions, certainly going to keep things really grim over in California. We'll continue to watch the latest developments on that front. And it's time for our last tick of the day. That is Restaurant Brands. The parent company of Popeyes and Burger King is sinking despite posting third quarter earnings that were in line with expectations. The focus, though, was on Tim Hortons' disappointing quarterly performance, as it accounts for nearly 60% of Restaurant Brands International's total revenue. Yahoo Finance's Jared Blickery, Inez Ferre, and Emily McCormick all back to weigh in. Jared, let's start with the Popeyes chicken sandwich. That's been driving a lot of the growth as well. Why do you think we're seeing the stock down? I mean, we talked about Tim Hortons as well, but it seems like we've talked a lot more about sort of these products that have driven traffic into the store more than the downturn.
Yeah, the chicken sandwich was a huge hit. Comp sales came in for that restaurant at 10% nearly. That's double what the street was expecting. They sold out very quickly, so obviously very popular. I think they spent 2 years making it, but Tim Hortons was a little bit of a disappointment. They went the Beyond Meat route, and then Burger King, of course, went the Impossible Whopper route. So Burger King was kind of a win, Popeyes big win, Tim Hortons disappointment, and that's kind of explains the stock price hum-ho reaction so far.
Emily, when that chicken sandwich came out, there was so much attention. We saw those long lines outside Popeyes. How sustainable do you think that kind of attention is? I mean, we've talked about the competition in this space and this need for a lot of these fast food companies to increasingly reinvent so they have new items on the menu.
It's a good question, but Popeyes was really the chain that started this chicken sandwich wars that we saw back at the beginning of August. So they do have the upper hand just in that sense and being the first mover. The other thing that Popeyes has been doing a good job of is really leveraging Twitter, leveraging social media and virality to drive interest. So we even saw them throwing shade at a competitor, Chick-fil-A, in its latest advertisement, showing that it would be launching on a Sunday, saying it's open Sunday and every day. Chick-fil-A, of course, notably being closed that day.
Okay, Inez, and Burger King, obviously one of the portfolio companies for the brand. How do they stay relevant?
Well, definitely the Impossible Whopper, the way Jared had just described, though the Impossible Whopper drove 5% comp sales growth in the U.S. And actually, Barclays had actually done a study on increased foot traffic in St. Louis, where they first had that test trial run of the Impossible Whopper before they rolled it out nationwide. And foot traffic had increased 18% there. So certainly it's a driver.
All right, let's go beyond the ticker. And today we are talking about the unintended consequences of Amazon. Traffic being a big one. The New York Times reports that 1.5 million packages delivered to New York daily are bringing the city to a halt. In the busiest parts of Manhattan, cars are crawling at just 7 miles an hour because there are just too many delivery trucks on the road, and that is 23% slower than speeds a decade ago. Emily, I'm going to start with you on this because I know you're from LA. There's a reputation of so much traffic, but it's striking to see that Manhattan, in a place that is so crowded, has now in some ways come to a standstill in some parts of the neighborhood because of delivery.
Well, I think part of it is just because everything in Manhattan is so much more compact. If we think about LA being a little bit more sprawling with the freeways and open spaces, but it really is extraordinary. I mean, Amazon really at the forefront here, driving that demand, saying they're spending $1.5 billion on one-day shipping in the fourth quarter, really making a push on this. 15% of New York households receive a package every single day. So it really is backing up traffic, really backing up just these apartments having to parse through these packages for their residents as well.
And of course, Jared, we're not just talking about Amazon, but FedEx, UPS, all these delivery companies, double parking, bringing streets to a halt. How much worse do you think it gets once that one-day delivery really kicks into high gear?
Oh, it's probably going to get a bit worse, and I'm part of the problem. I get maybe 1 or 2 packages every day. I think, look, we're reorienting ourselves around e-commerce, and so we're going to have to figure out new ways to do things. It's that simple.
And I guess, Inez, the final word to you, the test is going to be, just because we're talking about traffic here doesn't necessarily mean that New Yorkers are going to give up their e-commerce habits, right? They're going to continue to shop online and wait for that delivery to come through the door.
Yeah, I doubt that they'll give up those e-commerce habits. I will say that when you say that companies are trying to come out with innovative ways to deal with this, I will say that UPS, for example, has these drop-off locations. I know because I had ordered a cell phone through a site, and then instead of delivering it at my door because I wasn't there, they tried, but then they went to a deli nearby, literally 2 blocks away, and dropped it off at the deli there. The deli owner told me that he gets 50 cents a package for each package that he takes in, and people go to his deli and pick up the packages there. So there's certainly ways around to make sure that a delivery person doesn't have to go back to your location.
Okay, more creativity may be needed as we look to more deliveries. Thanks so much, guys. Coming up, the S&P 500 is on pace to set an all-time new record close. Stay tuned for the final round. That's coming up next.
everyone. I'm Jen Rogers in New York, and this is the final round. The S&P 500 hitting new highs as strong earnings boost stocks.
Now, Miles, other than this, as investors consider whether recession fears were overblown. And don't forget, the Fed kicks off its two-day policy meeting tomorrow afternoon. We'll have more on that in the market action coming up in just a bit.
Plus, Wall Street getting bullish on Facebook ahead of earnings. We're going to discuss that in the Analyst Rumble. And Boeing CEO heads to Capitol Hill tomorrow. We break down the tough questions he needs to answer. Plus, Microsoft pops on the big Jedi cloud contract. But did President Trump cut Amazon out? We're going to dive into that. With us now, Yahoo Finance's editor-at-large and co-host of The First Trade, Brian Sozzi, to talk about today's market action. Records. They're made to be broken.
I feel great.
Here we are.
I don't know about you guys.
Rarefied air. I mean, 41, above 27,000 stocks rallying on the S&P 500, hitting a new intraday record high for the first time in 3 months. The Dow and the NASDAQ are within about 1% of their records, so a little divergence, tech helping out. I feel like the Dow, it's just Boeing's fault, so otherwise it'd almost be here. But really, we're back to where we were.
It's great.
Next stop, where?
Another record. I mean, I don't know what you want me to tell you. Like, the market this year has clearly shown a desire to look past a lot of negative news, and there has been quite a bit of negativity, whether it's related to trade, whether it's related to Brexit. The president right now is currently dealing with an impeachment inquiry, and yet that's all fine because, things aren't quite as bad as a lot of folks had feared. And don't forget, what's so weird about the market, the hating of the market, which has been very consistent all year, is that the stocks are up a lot this year.
All the
hating is related to what happened last year when people love stocks. And so I think that's kind of what it is to me. The more I think about it today, it's like everyone just got caught so flat-footed and cross-footed last year that they're still mad about it. So they're blaming the Fed.
Isn't it good, though, that there's no euphoria around? I mean,
It's
this
great
is
news.
what could actually propel us to next stop, higher highs, given all of the headwinds here. This is your wall of worry. This is not irrational exuberance. People are like, what?
This is also potentially your fourth quarter market melt up. And I just wrote about this, getting back to what Miles said, and you retweeted my story I just wrote, and I appreciate the love. It is unbelievable. Look, at the bare minimum, earnings growth have decelerated every quarter this year. So at the bare minimum, stocks should be at least lower. I think the trade war is impacting businesses. It is impacting corporate confidence. So it's amazing to see these market records.
So here's the thing. It's like, I know that a lot of times, especially the way that I talk about the stock market, it's like a little bit jokey, a little bit tongue-in-cheeky. And these are clips you could play back if there's a recession in 2 months and say, wow, look at this clown.
It takes them 6 months to date it.
The thing is, the reason the market has acted the way it has been acting over the last, let's call it 6 weeks at this point, is because investors looked at everything that was happening in the economy during the summer, looked at how the Fed might screw this one up, looked at what the data were telling us about the economy in Europe, where the trade war is at, and the market has discounted the chances of a recession next year. Now, does that mean a recession is not going to happen? No, it just means the financial markets, whether it's the bond market or the stock market, Forex markets have been telling you, look at the price of gold over the last few months, have been telling you there is not going to be a downturn next year. It doesn't have to be great, right? It doesn't have to be gangbusters growth next year, but if there's no downturn, and based on the way people, some assets were performing, that was the base case for next year, then you cancel that, and here we are.
There is a component here, to your point, Miles, that the mood on Wall Street, at least the past 2 or 3 weeks, is the sense that the economic data just can't get any worse. So you take that, coupled with what looks to be another rate hike at the end of the week, and you're looking at a potential fourth quarter market meltdown. I'm not saying it makes sense. This is just what people are saying.
And I think you couple that with what's happening in earnings season. So heading into earnings season, a lot of people were saying it's actually not a catalyst for us to go higher because we have so much else on the table. But earnings season has confirmed to a lot of people that the consumer is doing okay. I mean, look at what we've had from Microsoft. This last week comes out. Here we are, back at all-time high for Microsoft.
Look at Popeyes today, a 9.7% same-store sales increase. This company hasn't reinvented the wheels. They're just selling premium-priced chicken sandwiches. Even at Burger King, Impossible Whopper, premium-priced products, so the consumer is doing pretty well.
Wait, Popeyes is a premium chicken sandwich?
Yeah, it is. KFC is where you get the cheap stuff.
I had no
Yum
idea.
Brands. Yeah.
All right, well, Jen, you want to know where we're headed next in the market? I'll tell you where we're headed next as a humanity, society, right?
To infinity and
Civilization.
beyond?
As a civilization, it's official. Virgin Galactic, the first publicly traded space tourism company. Yahoo Finance's Adam Shapiro got the chance to interview founder Sir Richard Branson earlier today about what this means for space travel.
Only 500 people have ever been to space, and that's including the Chinese, the Americans, the Russians. And we have the capability of putting hundreds of thousands of people into space in the years to come. And that's ridiculously exciting. And so here we are on the floor of the New York Stock Exchange, launching the first spaceship company. And it's going to, the resources we get from this are going to enable us to do wondrous things.
Well, let's go to Scott Gamm. He's live on the floor of the New York Stock Exchange. Scott, what's the reaction been to this debut from Virgin Galactic? And I got to ask you, are you going to be going to space anytime soon?
Well, I'm okay where I am situated here on the floor of the NYSE. No plans to go to space anytime soon. It's also should be very expensive. I mean, Richard Branson didn't exactly give a price tag on what a ticket might cost, but I think it would be more than a flight to LA. Let's just, say that off the bat. But look, there's a lot of excitement just to have Richard Branson here on the floor, as we just showed in his sit down with Yahoo Finance. Also, a lot of excitement about the fact that this is the first publicly traded space tourism company. So it's opening up investment opportunities in this space. Now, the stock is up about 2% right now off of session highs, but certainly a notable day here to have someone like that on the floor. Now, aside from Virgin Galactic, we're also keeping an eye on shares of Fitbit. We wanted to bring you an update on that because the stock was halted earlier today. It's up over 30% right now, but keep in mind, even with that gain, the stock is only up about $1.50 because it's still trading under $6 a share. The news here was that reports that Alphabet's Google had made a takeover offer for Fitbit, so that of course sending the stock higher. But about 4 years ago when the company went public, the stock was trading at about $42 a share, and again now it's under $6. So it's been quite a few couple of years for Fitbit, hence the attractiveness as a takeover target for Fitbit. So perhaps we'll see more developments on a possible Alphabet offer and takeover of Fitbit, guys.
All right, Scott Gamm live on the floor of the New York Stock Exchange.
French luxury group LVMH, which owns Louis Vuitton and Bulgari, confirming on Monday that it has offered to buy iconic jewelry brand Tiffany. Tiffany also coming out confirming the move, said the offer was worth $120 per share. That values the company at nearly $14.5 billion. The offer represents a 22% premium over the stock's closing price on Friday. When I saw this news break this morning, I thought, well, another consumer story, right? I mean, look, if you think that you're not going into a recession, that luxury is going to be going well, LVMH owns basically everything else in luxury. Why not keep scaling? Is this deal going to happen?
Well, this is a rumor that's been going around at least over 10 plus years. Constantly, this pops up. But $120 is not going to get it done. I think $150 to $160 ultimately is where something could come out. But if I'm Louis Vuitton, I would be worried about paying too much. Here's a company, Tiffany, that has continued to struggle the past 2 years. I think there's a fundamental sea change in the engagement jewelry market where you have a lot of people looking for lower cost options, and Tiffany just hasn't been able to keep pace. Also, keep in mind, you look at the product assortment online, really no handbags. They have a horrible business in the watches. I don't know, there's just not a complete business here for me.
They're very good in bridal. They're very good in diamonds. They own a lot of Oliver Chen, stuff. Who has been writing about them, talking about them being at 160, said that they are un-Amazonable, that you are not going to be going to Amazon to get any of the goods that you're going to Tiffany for.
Don't agree with that at all.
You think you're going to go to Amazon and get a fancy plate?
I think you have to take Amazon out of this equation. I'm just curious on who's going to Tiffany right now, paying some of the prices they're asking people right now to do. They've tried to push through a lot of price increases the past 5 years, and I think it's blowing up in their face.
No view on Tiffany.
No view.
No view on Tiffany.
And he's getting married. That's not good.
Well, I'll say this.
not
Tiffany has
there.
played no role in any of our processes.
I think bridal is like 25% of it. I mean,
you're buying
quite expensive.
You're buying a piece of history. This is obviously a franchise brand, and I think Louis Vuitton, they'll probably end up getting some form of bidding war at Richmond, and they'll pay up to own that piece of history.
Well, more, I'm sure, on this one, because it seems like a lot of people agree with the idea that it's got to be
Louis Vuitton.
Louis Vuitton.
Really, you didn't nothing at Tiffany's for the wedding?
No.
Maybe you can get him something there.
Yeah, please. I don't think we're going to register there, but if you'd like to get a gift, knock yourself out.
They sell dogs. They sell like dog cat bowls. They sell like pet supplies.
Yeah, but I don't have a pet, so no.
Moving from the luxury to the premium chicken people. Restaurant brands enjoyed a blowout third quarter thanks to soaring same-store sales at both Popeyes and Burger King. But Tim Hortons is putting a damper on those numbers. The donut and coffee chain, which accounts for roughly 60% of Restaurant Brands' total revenue, a laggard. Again, same-store sales declined by 1.4% in contrast to the 9.7% rise at Popeyes. Strongest quarterly same-store sales growth at Burger King since 2015. Brian Sozzi does not seem to care about Tim Hortons. You're waving this away?
I don't care about this faux Dunkin' Donuts. Listen, I talked to Restaurant Brand CEO Jose Sill. He's a friend of the program. He's been on before. He was feeling pretty upbeat. I asked him, are you going to have the Popeyes chicken sandwich supplies, the bun, the chicken in the fourth quarter? He says, we're ready for battle. We're ready to rock and roll. This is a Popeyes story first, at least for the next 3 months, followed by the Impossible Whopper at Burger King. I don't care about Tim Hortons.
But it's a really important part of their business, right? What if this whole fake meat in Popeyes is a flash in the pan? What if it's gone?
Realistically, they should probably.
Tim Hortons is they've got so much distribution through
They
there.
should, I think, potentially look to sell Tim Hortons and go out and buy Domino's Pizza at a discounted valuation, like it is right now. Boom.
Who's buying Tim Hortons?
I don't know.
LVMH?
Yeah, maybe. Why not?
3G. Right. Just get the 3G guys to repackage it and make something new there. Yeah, I mean, look, the stock has done tremendously well over the last couple of years because you've got all this success at Burger King and Popeyes. I think at this point, the street today is telling you that, hey, guys, by the way, this whole Tim Hortons thing, you should probably figure that one out.
Yeah, they bought Tim Hortons to try to expand into the U.S. market. It hasn't worked.
Hasn't
We're
worked.
Dunkin' Donuts.
I was going to
Starbucks
say,
culture.
meanwhile, Dunkin' Donuts has been a massive expansion, has been undertaking a massive expansion in the lower 48. And so, you go to California now, you see Dunkin' Donuts, and that's a big change from what it was.
They're opening up close to, I believe, 1,000 restaurants this year in the U.S.
Yeah.
Dunkin's an animal. They're a machine.
Yeah. Tim's not working south of the border. All right, coming up here on the final round, Wall Street getting bullish on Facebook ahead of earnings. Those are out on Wednesday. We'll discuss the call in the Analyst Rumble, but first, let's take a look at where European markets closed on this Monday.
It's time now for our Analyst Rumble. These are some of the biggest analyst calls today of stock names you know. And first up, We've got Facebook getting its price target raised by Stifel analyst John Egbert to $205 from $180. Even though regulatory concerns remain, he thinks the company has taken positive steps towards improving privacy and data security. Of course, Facebook reports third quarter results on Wednesday. Is this a bullish note or a bearish note?
I think it's a fine note.
It's
It's a hold. The rating is hold.
So
The
it
rating
is-
is hold.
Because why not?
But the price target, even though they transferred who was covering it, so there's a little change, the price target's higher, but it's a hold.
Yeah, I mean,
still am trying to get my head around
If
it.
you want the model to tell you that the stock is worth 20 more bucks a share, 10% more than it is trading at right now, sure, fine, no big deal. I mean, I think in general, fading government action against companies has been broadly a profitable trade. I mean, it's kind of difficult to get too excited about that. At the same time, Facebook stock over the last couple of years for various periods, and we're looking at one right now, has been stuck in these malaises, which I think are related to some fears over what could be coming down the pike for them regulatorily, however you want to, whatever made up word I want to use there, you know what we're going for. And so, look, there's only two players in the online ad business, and Facebook's one of them. So it's hard to get super bearish on the stock, but if you look at how great the company's fundamentals have been over the last couple of years, I do think the stock has been a little disappointing on that basis.
I think just to sum up this note, it's clear regulation will not be coming within 3 months, and the core business remains strong. You pack it together, and that's why Facebook stock is still rocking.
Yeah.
There's two notes here. There's the hold and the price target, also a little preview in here. And I did think it was interesting to note that Facebook has not disclosed Instagram's total DAUs or MAU figures.
Yeah, we guess it. We think they said it's $1 billion, right?
Yeah, but they've done some story stuff. They're guessing at it. They've told us in June 2018 it was $1 billion.
Yeah.
So kind of just spinning forward to tomorrow, kind of what data are we going to get from Facebook? That is something to look for. Maybe we'll be
Wednesday.
Oh, Wednesday.
I know.
I missed a day.
I
We have
thought
so
it-
many earnings, so little time.
No, it's fine.
Next, we have Cowen's Oliver Chen commenting on LVMH takeover bid of Tiffany & Co., saying that a fair price would be at least $160 to $180, not the reported $120. And Cowen finds Tiffany to be an attractive asset for several reasons, including its access to diamonds, bridal exposure, and the fact that Tiffany has a big watch opportunity in here. So Miles, I know you're not a Tiffany shopper.
But these are really hitting my sweet spots here.
Watches,
bridal,
so
diamond mine relationships.
did you see the case that is made here? Why this should be in LVMH?
I actually think you could. I mean, and I know that the point that Cowen is going for is about look, 20 times would be a fair takeout price for this kind of asset in this kind of environment. I think you'd also just sort of build a case like, all right, well, they come to you with 120, you say, I'd do it for 160. And so I think that just on a bargaining basis of where should this thing get taken out, if LVMH is in fact hell-bent on owning Tiffany, it's going to have to be a lot higher than that first leaked report.
Yeah. I'm just wondering where the growth comes from and the valuation accretion comes from when you pay that type of or if they were to pay that very, very type of high price. This company's not opening up stores aggressively across. This is no Dunkin' Donuts here, people. And yes, they do have an opportunity in watches, but they've let their customers down for years in the watch category. So it's not like they're going to turn on their website, launch 90 new watches, and people are going to be shopping. It doesn't work like that in retail.
The only thing, though, is like with these luxury assets, you don't have to have a big growth strategy. It's like there's value in having the Tiffany brand. I mean, the Tiffany brand is going to command a certain multiple that I think should be higher. I mean, I would agree that should probably be higher than its peers.
But should it?
It's Tiffany, yeah.
I think there's a generation of people that are no longer going to this place.
Well, he makes the point of the other luxury brands that have been taken out and with a higher multiple in here. I thought what was interesting in particular about what could Tiffany do in the future, because I kind of think it's an old brand as well and they're not expanding, was what they might be able to do with their margin expansion. And looking in here, Oliver Chen points out that Cartier, they estimate that they have their margins high 20% to low 30%. And that's well above Tiffany's operating margins that are 18%. So if Tiffany can figure out how to expand that margin base, that might be what gets you to your 160, to your 180. That made the case the best to me.
Yeah, part of the problem is operationally, Tiffany would probably be better run under Louis Vuitton. But the reason why those margins are not on par, because Tiffany is still seeing weakness in jewelry sales between $300 and $800. That's some of their most profitable lines of business. That's the silver stuff, and that is a fundamental change in the way people shop. People do not see the value in buying $800 silver necklaces from Tiffany anymore. It worked 15 years ago, not right now.
As
Maybe never again.
The Alex and Ani trade, eating
Yes.
at Tiffany, right?
Yes.
Yeah, I mean, that company has plenty of its
Yes.
own issues, but that's sort of that price point, that level.
It's gone.
It's gone.
Moving on to Lululemon, Citi
Here we go.
downgrading
Let's go.
shares
Love
from
it.
buy, a downgrade from buy to neutral, even though Citi thinks that Lulu remains a winner long term. Higher promotions make them question if they are as flawless as they have been. I felt like this read like somebody's report card. Lulu has done nearly everything right. but
yeah.
she went from like A+ to A-.
Yeah, exactly.
Right?
It was like, but given her success in recent math tests, we have noticed Lulu is not doing all of the homework with the same enthusiasm that she did in the first couple of months of the school year.
That is exactly how this read to me.
That's exactly what
I
it was.
thought Lulu was just being, you are not good enough,
It's
Lulu.
like, how do you have a parent-teacher conference with the best student in the class?
Yeah. This company's having a blowout holiday season. That's all I'll add. They have so much momentum at their backs. They're pushing through price increases. The merchandise is on point. And I don't even think a brand like Peloton, which is now starting to sell clothes, they're not on par with this company yet. They are. The clothes are nice.
Of course Peloton's not on par with Lulu.
there are
Who
a
sold
lot-
Lulu like that.
Just trying to work in Peloton.
But more promos, more, do you go to the website, the Lulu website, what
that's
we
great.
made too much of, that section? It does feel like they have a lot more that they made too much of, which is nice for the person that's trying to pay less than retail. But that's, you want to be selling everything for top dollar.
True, but in this age of retail where a lot of these companies are selling junk, Lululemon doesn't sell junk. They have stayed true to their message of selling high quality stuff. You will have to pay more for it, and that's all fine and good, but that's why the business and the earnings have been absolutely stellar.
Those running hats are like a little weird though. They have the unstructured running hats that are just kind of like floppy. But this actually reminds me of, we did a story last week, Target getting a downgrade at Goldman from conviction buy to regular buy because the stock had gone up so much. I mean, this is basically the same thing. Like the stock has gone up so much, we had a buy rating on it, so Citi's like, well, if we go to neutral, it'll be fine. No one will get hurt here if we're neutral rated.
Yeah, I wrote Lulu went from A+ to A-.
Well said.
That's it.
Well said.
A-, it's still okay.
We should always frame these as like parent-teacher conference report cards sort of things, and then read them in
You'll
that
get
same
them.
tone of voice.
Yeah. You know what it is.
Quite enjoyable.
A+ to A-.
In another life, an elementary school teacher.
Does Brian Sazzi leave?
Yeah, I got to watch Beyond Meat earnings are coming out. I'm very excited.
That's right.
Yes.
I had a Beyond Burger yesterday that Dan Roberts cooked for me.
He cooked it for you?
Yeah, he cooked it for me.
That's
It was
so nice.
It
How do
was,
you cook it on the grill?
Yeah, I mean he cooked it fine. The burger was.
I think the best thing about Beyond Meat burgers is
all the stuff you
they're
put on
so easy to cook.
Right.
Because with a regular burger, I'm worried about giving people raw meat. With Beyond Meat
Right, yeah,
burger,
you knew it
I'm
wasn't
just
gonna be
like,
raw meat.
Serve it
It's
raw.
ready.
May or may not get sick.
Brian Sazzi, Beyond Meat earnings coming up. We'll see you tomorrow.
All right, coming up here in the final round, we'll talk about stocks sitting at all-time highs with Invesco's Christina Hooper, what sector she likes here, and more. But first, let's take a look where big tech is trading right now. 37 minutes to go in the session. 5 minutes ago in the session, we got stocks basically at record highs. So what is next for this market? Christina Hooper is the chief global market strategist at Invesco, and she joins us now to discuss. So trade, Brexit, ECB changes, Fed meeting this week. But, stocks are kind of saying, at least as far as we can tell, that things are like fine, right? Do you agree, or does it seem like we are still as unsettled as we were a few months ago?
Like, stocks are clearly saying things are fine, but they're being powered by a few different factors that may or may not come to fruition. And so I would just stress that we need to see continued progress in the U.S.-China trade negotiations. We'd also, of course, need to see not just the Fed cutting rates, but providing enough language that is perceived as dovish enough, suggesting that they stand ready to get more accommodative, really to keep stocks in positive territory moving upward.
What do you make of sentiment right now? Because when we started the show, we were just talking about the fact that even though we're at records, nobody's popping champagne corks or getting out new hats on the floor of the NYSE, although I know the Dow's not at a record. But still, it feels a little different. What is consumer sentiment telling you right now?
Well, what we're seeing is, I think, a real difference between consumer sentiment and sentiment around stocks. Consumer sentiment has been very strong, but interestingly, sentiment hasn't been that positive around stocks. Certainly, we're seeing stocks moving up, but we've seen really significant amount of flows out of equities this year, which suggests a real mismatch between what's going on and what people are thinking. And many may be missing out on what could be a very nice year of capital appreciation.
Well, and so when you look at that, I think some people hold the view that it's something in the effect like that can't hold, right? Something would have to catch up with one another, right? If you have sentiment at this level and stock prices go up, either folks will rush into the market, or for some unknown reason to me, the market would catch down to sentiment. When you look at that data, does it say anything to you beyond just, well, here's what people have been doing? Does it have any predictive value on who might feel left out when they open their statements, first couple weeks of January?
Well, it's actually a positive to see that sentiment is fairly negative, just because that suggests that stocks have longer to go, because usually people pile in as we get closer to the end of a bull market rally. So I think that's very positive. What I would point out, though, in terms of caution, is that we do have to worry that some of the factors that have powered stocks thus far might dissipate a bit, and so we could see something of a pullback. I expect stocks to end where they are today or slightly higher. So it's certainly not a negative picture, but we might see volatility in the coming few months. But again, this is a time for investors to be invested rather than running for the doors.
So it seems like you have some reserved optimism. And if you want to be invested, what do you like right now?
Well, so I'm really positive on technology, U.S. tech and China tech. So China tech has been beaten down. Really, that started when the U.S.-China trade wars went into a higher gear. And what we saw was just conventional wisdom, assuming that China would lose the trade wars and Chinese stocks would just be pummeled. So China tech in particular has taken a hit. It's well off its 6-month highs, for example. But it's a pretty attractive place to be, in my view, in terms of growth prospects. And I do believe that the fate of China is not as negative as people expect, because China is throwing stimulus at its economy, which coincidentally the U.S. isn't.
And then quickly before I let you go, because everyone has to answer this question now, recession next year or no? Does it feel like that was a base case for some folks not too long ago, and now I think people have broadly decided it doesn't look likely?
No, our base case is no recession next year, but we want to watch the consumer closely because the consumer is quite robust. We're certainly hearing the Fed talk about how strong the consumer is, but underneath there is a level of vulnerability. And so we want to follow consumers closely. Many of them don't have a lot in the way of savings. So if we did see a hit to the labor market, it could actually trickle down and have spillover effects for the consumer and the greater economy.
All right, Christina Hooper is the Chief Global Market Strategist at Invesco. Thanks so much for joining us.
Thanks for having me.
Coming up, more on the final round, plus Boeing CEO heads to Capitol Hill tomorrow. We're going to break down the tough questions he needs to answer. We are back right after this.
everyone. Miles London here in New York. This is the final round in Yahoo Finance. Stock market hitting new highs here. Strong earnings boosting the markets. We'll have more on that and everything else coming up in just a bit. Plus, big after-hours earnings reports today. Alphabet, Beyond Meat. We will have the results for you live when they hit the tape. And Boeing CEO heading to Capitol Hill tomorrow. We break down the tough questions that he will need to answer. Plus, Wall Street is getting bullish on Facebook ahead of its earnings report on Wednesday, and it's our final round call of the day. Joining me now, as always, is my co-host, Jen Rogers. So let's take a look at where the market stands. 27 minutes to go in the session. We've got the NASDAQ and the S&P 500 both set for record closes. If it holds here, the Dow is about 200 points away from a record high. And for more on today's market action, let's go straight to Scott Gam. He is live on the floor of the New York Stock Exchange. Scott, we were just talking here about how there seems to be a muted enthusiasm around stocks at these record levels. What's your sense of trader sentiment down there on the floor?
Well, look, I think the market has been trying to eclipse some of those late July record highs for quite some time, and it finally happened today. But I think you could also argue that there's quite a bit of slack in this market. Just when you look at two really powerful names for the broader stock market, that's Amazon and Boeing. When you look at Amazon, I mean, the last time the broader market hit record highs in late July and early May, Amazon was trading above $1,900 a share. Well, today, even as the broader market is back at new record highs, Amazon is trading below $1,800 a share. And then, of course, with Boeing, we've talked about this for quite some time, Boeing's underperformance as a reason why the broader Dow has not been able to move back towards its record high in mid to late July. So I think the question now is, what happens to the broader market if we do see some sort of a turnaround in the stock prices of Amazon and Boeing? Now, one of the reasons why you're seeing gains across the board is because of earnings, but also consumer strength. And I have an article on yahoofinance.com today talking about what executives have been saying about the state of the consumer on earnings calls over the past couple of weeks. And we should point out that the CEOs of 3M, Procter & Gamble, and Hilton have all specifically mentioned a healthy consumer on their earnings calls. And of course, we'll get another window into the health of the consumer when we get that jobs report on Friday. But on the flip side, the CEOs of O'Reilly Automotive and Hasbro have sounded the alarm on possible consumer impacts from a prolonged trade war. So I think executives out there want more clarity as to what's going to happen with that next round of tariffs that's set to take effect on December 15th. I guess the good news is there's still plenty of time for the U.S. to delay or completely scrap that next round of tariffs, guys.
All right, Scott Gam, we will talk to you right after the closing bell.
Roku is hoping its new devices ramp up the audio quality when you watch TV, especially if purchased together. Yahoo Finance's Dan Howley is here now with a Roku review. Alliteration.
I like that Roku review.
So,
double R.
Yeah, we've had some.
We'll rename the Tech Howl the Roku
review.
Done.
Will they have enough hardware things to come out?
Maybe
What
not.
is this newest piece of equipment?
So it's two pieces. It's a Roku smart soundbar and a Roku wireless subwoofer. You don't have to buy them together, but they work a lot better when you buy them as a pair. And the smart soundbar is a 4-part speaker. It's 4 individual 2.5-inch, they call them drivers. They do the high and the lows for the speaker, and a full 4K HDR Roku player built into one. So it's a really great kind of combination there. And you plug it into a special HDMI port in your TV. So it doesn't matter which HDMI output you're on, it'll still always play the audio through that speaker. So it's really impressive in that way.
That's nice. You don't have to do all that input stuff?
No, you'll just, you can switch up your input to whatever, and it'll continue to play out of the Roku smart speaker. And then the subwoofer, they're both $179. If you get them together, it's $299. The subwoofer, though, just adds a good, chunky, beefy bass. Just, like slamming. I started playing music at like 9 o'clock, and I got very nervous because it was really just womp womp. And the good thing about it is it's got a 10-inch driver on it, so it's massive, but it's not overwhelming. Like I was using it while watching a horror movie, and I could still hear the highs of the people screaming as they were murdered in Midsommar, which is a terrifying movie, and the lows of when they would hit the floor. But it was it's really great the way it sounds together. I am not the biggest audiophile out there. I'm not, the type of person that says, I need this to be the greatest crystal clear sound ever. But for the price, for $299 for those two, it's well worth it.
I guess strategically, though, I would just ask sort of what is Roku after here other than just selling more stuff? Roku's whole thing is that we are the aggregator of all the places you're watching TV. I guess having a nice soundbar to go with it is a nice touch, but it's sort of like a need to have. It doesn't seem to me to be essential to the whole thing that everyone's been so excited about with Roku.
It locks
that stock today up about 10% on yet another positive comment from a Wall Street analyst.
It locks you in the ecosystem. You're not going to leave it because it's the Roku player that comes with this soundbar. And the more they can keep people locked into that system, the more ads they can sell against them. So that's really the big kind of play here.
Does Sonos need to be worried about this?
I think, Sonos is so...
I know it's different. I'm just thinking about, other ways that pieces of hardware have become... look, on the Fitbit news today, all you can think about is what was the hardware that was supposed to be great and what was the hardware that ended up being completely irrelevant. And you sort of say, does another sound player need to be nervous about Roku coming into their territory?
I think for the price, yeah. If you look at people like Vizio, kind of the entry-level to mid-range soundbar makers, they probably need to be worried. I think for Sonos, Sony, Sennheiser, kind of the higher-end ones, Bose, they're not going to be as concerned because that's not where Roku wants to hit. Roku wants to hit the general consumer market.
LG.
Yeah, LG is another one that should be concerned, Samsung. Yeah. And the fact that they are able to pair it with an actual Roku player, which has one of the best interfaces you can get,
the best,
is, you're really going to be facing a lot of competition.
And if you're going with the competition, let's say you have an Apple TV, and then you have Sonos, and then you have a different kind of TV.
Someone might have this.
Somebody might have this and is confused every time she has to deal with the inputs. So I would think that Roku has a reputation as plug and play and easy.
Oh my God.
And this extends that reputation.
It is stupid easy to set this thing up. And then to set up the subwoofer instead of all these different, you press and hold the home button on the remote for 5 seconds and the subwoofer's connected. Yeah. That's it. It's idiot-proof if I can do it.
Roku's going for easy.
Yeah, and they do a great job.
Dan Halley, we'll talk to you tomorrow.
Thank you.
All right, coming up here on the final round, Boeing CEO heading to Capitol Hill tomorrow. We'll break down the tough questions that he will need to answer. But first, let's take a look at how financials are trading right now with 19 minutes to go in the session.
Let's take a look at some of today's winners and losers. Stocks in the red include Restaurant Brands after the Tim Hortons operator reported a revenue miss for its most recent quarter, thanks to a surprise decline in the donut and coffee chain's comparable sales. Lowe's shares taking a hit after the conglomerate reported disappointing profits for the third quarter, blaming lower results at subsidiaries CNA Financial and Diamond Offshore Drilling. Stocks in the green on this day of records. Check out AT&T after the telecom giant caved in to activist investor Elliott Management, which pressed the company to cut costs and pursue management changes. AT&T announced it is considering the addition of 2 new board members and selling off up to $10 billion worth of non-core businesses next year. Tiffany, shares of the U.S. jeweler, are soaring on news that French luxury group LVMH offered the company a takeover, an all-cash bid of roughly $120 per share. That works out to $14.5 billion and represents a premium of 30% or more to where Tiffany traded when the offer was made.
All right, let's take a look at shares of Microsoft, up about 2% today. This after the tech giant beat out Amazon for a massive cloud computing contract with the Pentagon, known as the JEDI contract, worth about $10 billion. Joining the conversation now is Yahoo Finance editor-in-chief Andy Serwer. So, Andy, I think there's a lot going on in this specific story, and I feel, and I'm sure you feel the same, that I've been hearing about the JEDI contract for quite some time. It has been years and years in the making. The assumption was always that AWS would get it, and I believe now that Microsoft won that award, the assumption is it's just the administration saying, no, Jeff Bezos can't have a nice thing.
I think there's got to be something to it. I'm sorry. You know, it's just a little bit too coincidental. It reminds me, actually, you guys, of when the Trump administration said they had nothing to do with providing friction between the AT&T and Time Warner merger. Right. Nothing. It's just nothing. It's untrue. They were involved. And, you know, I think that that's sort of been established at this point. And here, you know, I mean, okay, Azure is a certainly viable product. It's a great product. It's growing strongly, about 60% a year right now, and a lot of big blue chip customers are using it and increasing the amount that there's of the spend there. But you know, AWS is number one, and the animosity is clearly there between, well, it's actually more one-way street, I think, between Donald Trump and Jeff Bezos.
No matter who got this, it's really messy. Right? We had Oracle sticking their nose into this earlier. This is competitive. People want this business, and it's political. But really, no matter what had happened, we would be talking about it today, even if Amazon had gotten the deal.
And you know, we talked about Oracle having that long-standing relationship with DoD. I mean, that was the company was based on that. You know, the database relationship that they had there. The other thing about what's interesting about JEDI as well is that, you know, the number itself is big. It doesn't seem that huge, especially over that period of time. But the thing is, it actually extends and will get you into other businesses and adjacencies as well. So that's why it's so huge.
Well, and I think on that basis, though, you could have, and I agree that clearly there was, I mean, look, it's the government awarding a contract. Obviously, there's politics involved. By definition, there's politics involved. But, I mean, you could say that if you look at what Microsoft's involvement already is with the computers they provide to the Pentagon or some of the programs they're already involved in there on the hardware side, it's like, well, it's not that big of a leap to say, let's also stick with their cloud services. So you could tweak it that way.
Right, exactly. I mean, it's certainly a legitimate choice that the government made.
Yes.
It's just, you know, boy, it's, you know, the Trump administration is going to be loath to hand money to Jeff Bezos.
It's not like the way that then when they were doing the contracts to do the cleanup for Hurricane Maria, they were awarding it to two-person firms that just so happened to be based in the same hometown as, you know, Ryan Zinke, Secretary of the Interior at that point, right?
This is why administrations and presidents in particular have been so careful in the past about what they say and what they get involved in, because decisions come up in front of you constantly where a conflict of interest can be perceived, even if nothing's there. And that's so what's so different about operating under President Trump, who's tweeting all the time and talking all the time. So it's different.
On the other hand, there, you know, President Kennedy used to feud with the steel industry. I mean, going all the way back, right? So
when I lend you my copy of Goliath, you'll see that there's a long history of people picking winners and losers. Let's go over to Boeing quickly. Dennis Muhlenberg will be on Capitol Hill starting tomorrow. He'll face questions from the Senate Commerce Committee. Now, obviously, those will be regarding the 737 MAX. We've had a lot of folks on Capitol Hill recently, Andy. It does feel like it's been a long time coming. I'm going to be very interested to see exactly what tactics some of these senators take in terms of hitting Muhlenberg and hitting Boeing, because we have a two-part issue here. There's the Boeing problem, but then also where was the FAA? And do certain lawmakers choose to attack the FAA rather than go after Boeing, even though the Boeing CEO will be sitting right there?
Well, it's interesting. You guys know I talked to Ted Cruz last week, who's the chairman of that committee, and I asked him all about this. And he's been sort of very fiery about the FAA historically, and as well, Boeing super critical as well. And he continued, though I actually thought he was a little bit more measured when he was talking to me and saying, like, I'm going to wait. I want to hear, how this company is addressing it. I want to understand the relationship between the FAA. I'm concerned that safety was not the number one priority at this company, which it absolutely has to be. And so, and actually, the other thing that impressed me about Ted Cruz was that he knew a whole lot about what went wrong with these crashes. I mean, it was very interesting. He'd obviously done his homework. He was explaining to me about the aerodynamics and the nose and the software and the, all this kind of stuff. So Dennis Muhlenberg's going to have his hands full, no doubt, tomorrow.
Lots of news coming out of D.C. In a letter today, House Speaker Nancy Pelosi says the House will vote Thursday to formalize the impeachment inquiry that establishes the procedure for the ongoing investigation. For more on this breaking news, let's go to Jessica Smith in Washington, D.C. Jessica.
Yeah, Speaker Pelosi says the House will vote this week on a resolution formalizing the next steps of this impeachment inquiry. That's been the big argument from the Trump administration, saying that the House is moving forward with an impeachment inquiry that's unconstitutional because there hasn't been a vote authorizing it. Now, that is not exactly the case. There is no requirement in the Constitution that the House actually has to vote to start an impeachment inquiry, but in the past, the House has. So President Trump and his allies are insisting that the House do this. So far, up until this point, Speaker Pelosi has said no. But now, in an effort, it seems, to just stop that criticism, she says they will move forward by voting on this resolution. She says, we are taking this step to eliminate any doubt as to whether the Trump administration may withhold documents, prevent witness testimony, disregard duly authorized subpoenas, or continue obstructing the House of Representatives. As you know, the Trump administration has been keeping people from testifying. They have not been cooperating with this investigation so far. So we'll see if the House does vote and pass this resolution, if that changes anything. But I'd have to guess that would be unlikely.
And of course, this comes on the day that Bolton's former deputy failed to show for a deposition. Jessica Smith with the breaking news from Washington, D.C. So, of course, we've got the we've got Fed, we've got Brexit, and we've got impeachment, and record highs. It's right. The market is still kind of nonplussed by everything that's happening. It's just not a story that seems to be ruffling too many feathers on Wall Street.
No recession, so it's fine.
You know what's funny is because everyone keeps talking about, we're talking about it every day, the market top. But we are, to use an old trope, we're climbing the wall of worry, which doesn't get you to a top, they say. So I don't know. I don't see any irrational exuberance happening in this environment.
Absolutely not.
So that's a good thing, maybe, Miles? Tell me.
First week I was in financial media, Ben Bernanke announced QE3, and all I heard in my office was, this is the top, it's an unsustainable bubble. And that was like, I don't know, S&P 1400 or something. So
a lot has happened.
That's it, right? But but it just feels like since the last crash, everyone's just waiting for the next one, because look at all, you might get a Michael Lewis book written about you if you get it right. So.
Yeah, right. Well, right. And yes. Oh, don't get me started about predictions and journalists. Right.
Well, as I said, I'm not wearing a hat today. Coming up, though, we've got the closing bell on Wall Street, less than 10 minutes away. There could be some records. First, though, we're going to get technical and discuss why Bitcoin, yes, Bitcoin soared over the weekend. 10,000? Can the charts explain the move? We're going to be back in 2 minutes.
Welcome back to the final round. The S&P on track for a record high here. Yahoo Finance's Jared Blicker joins us at the Wi-Fi Interactive Touchscreen to talk about a more exciting asset that's not only stocks, but of course, what happened in Bitcoin over the last several trading sessions.
Yeah, we're definitely going to get to that. First, let's start with the Dow, up 130 points, about 0.5%. Same thing for the S&P 500. NASDAQ and Russell up about 1%, and it's really been tech stocks driving this rally, although it is pretty broad-based. Financials doing well, too, as we'll see with the 10-year T-note yield up. And this is the S&P 500 today, just kind of gapped up and stood there for just about the entire day, maintaining those gains. Here's a candlestick chart, 3 months that we've been looking at, and finally just broke out of this range right here. And how far are we going to go? Some trend line analysis might put that target at 3060, 3100, at least in the intermediate term. And then the 10-year T-note yield here is up 5 basis points. So in the month of October, it's up about 18. And so that has been good for value stocks as well as financials. And then, as promised, we will get to Bitcoin here. And just some incredible price action over the last few days. I got an email from a friend of mine who I call the Canadian whale. He's been spot on with a lot of market timing. And the day after, we suffered this little decline. Well, it was actually a pretty big decline here. It looked like we might be heading towards 6,000. But then over the last few days, we just gapped up and made a 10-15% move on Friday, another 15% over the weekend. So it's really been incredible here, the run for Bitcoin. Guys?
Jared, the summer is more of the whale watching season in Canada, according to tourguidecanada.ca.
Every continent needs a whale. And so we got the Tokyo whale, we got the London whale, and now we got the Canadian whale.
Canadian whale. I love it. Moving crypto. All right.
First one in this hemisphere.
That's great. Jared Blicker at the Wi-Fi Interactive Touchscreen. Thanks for stopping by. I'll talk to you tomorrow. And coming up here today on the final round, we'll have the closing bell on Wall Street Plus, those big after-hours earnings reports, Alphabet, Beyond Meat, about to hit the tape. We'll have the numbers for you live when they cross. We are back with that right after this.
Welcome back to the final round on Yahoo Finance. I'm Jen Rogers with Miles Udland. We also have Yahoo Finance's editor-in-chief Andy Serwer and Brian Chung. It's a full house.
We have 30 seconds to talk about the Acela.
Because
That's
which is what we were doing in the break.
Local news story.
We're at records. Here we are. We got to bring in the full house to get us back to where we had last been.
We had New York Champagne Week here on Friday. We could have brought a bottle down.
Pop
bottles.
It's not that kind of rally, Miles.
Right, that's right.
Not
New York
that.
City
That's not
Sparkling
that.
wine?
The
Ellie's.
closing bell on the New York Stock Exchange
Killer.
and the NASDAQ market site. The S&P 500 on track to be at a new record high. And is the NASDAQ going to do it as well?
I think we're going to be just short.
Just short.
We're gonna be just short.
They got the confetti
We're going to
at
be
the
4
NASDAQ
points,
too.
4.5 points away.
It could happen on the end because tech has been big today, no doubt. 833, yeah.
Five-ish.
NASDAQ's not going to do it. 5 points for the NASDAQ. But S&P at new record right now.
You guys are demanding.
We are basically because
called a record
nobody
for a
else is
reason,
excited about this rally. Nobody else cares.
Yep.
It's just
Good.
us.
That's good.
And that is apparently very good.
That's
it's
a
a
good
great
thing.
contrarian signal.
Yeah, you don't want, the taxi drivers and the metaphorical shoe shine guys who probably don't exist anymore talking about the market, wanting to buy stocks. You don't want people talking about stuff like this.
Do you know what the taxi driver is talking about now, or the Uber driver? The Fed. I don't know what that. I don't know what that
My
says.
taxi driver is, that's for sure.
Well, he's hearing about it.
I knew
He's definitely
it was
hearing
either
about it.
that or it was, Brian, how much does Jay Powell care about stocks at record
Also
highs?
that, no, I think the only reason why I don't have a
segue.
5-star rating on Uber is because I talked about the Fed. They're like, this guy will not shut up. That's
like,
a 4-star for this guy.
Brian, I get it. You were an analyst at the Federal Reserve.
I mean, it's in my title.
I think that's a problem, no? That we have the Fed with a bullseye on their back from the president, and that it has jumped species, and people are talking about it in their Ubers and their taxis. People don't care about the markets, but they think that the Fed has messed up everything else in their lives.
I feel like all-time highs used to be a talking point for the Federal Reserve maybe 2 years or so, but what we've seen is that the economic expansion has still continued to a record, right? This is the longest economic expansion in U.S. history. And I think as far as the Federal Reserve is concerned, why can't the good times continue to roll? That's why they are easing rates in this cycle right now. I think that when we talk about, however, whether or not the Federal Reserve is keeping their eye on the ball, we do have to understand they are paying attention to asset valuation pressures. That's a code word that they would use to describe how closely they pay attention to equity markets. But I think right now, most policymakers would say it's not really equity markets that we're paying attention to. It's leveraged loans. It's the corporate debt sector. So I think that's really where policymakers are looking at. And we'll see if they put a little bit more steam into maybe some of these corporate loans, if they do indeed cut by another 25 basis points in the meeting on Wednesday.
But Brian, isn't it crazy? Come on. Unemployment is a 50-year low, and the stock market's at an all-time high. And I don't know how much attention we should be paying to the rest of the world, which is not in terrible shape. The Chinese growth is slowing, right? And Europe is stagnant. Gee, that's the same headline that's been around for the past decade?
Forever.
Decade. Yeah. Both of those headlines about Europe and China. And then the United States is in great shape, and yet we're going to keep pushing on that string.
Yeah, well, here's your argument from Eric Rosengren for Esther George,
Yes,
not to
they're my people,
not to make moves on rates. I think that we need to understand that the trade war has kind of been the big focal point and the reason why the Federal Reserve has not paid attention to a lot of the data that you just mentioned about unemployment and also about where the labor market stands right now is because they say we need to cut rates before the data starts to get sour because of this trade war. But if you look at the developments since the last Fed meeting, which was in September 18, the trade war developments have been largely positive, right? We have a phase one deal, and you could argue to what degree that is really anything more substantial than we had prior to the phase one deal being agreed to by two parties. But the fact of the matter is that we were trading on headlines that were saying whether or not the Chinese and the U.S. were going to meet in the first place. So I think to have at least something in writing or soon to be in writing is a positive development, which would be interesting to see how the Fed and Jay Powell kind of explain whether or not that fits within the narrative of needing to continue rates if they do decide to do so. For what's worth, I was looking at the Fed funds futures. It seems like almost a for sure shot that we're going to get another cut on Wednesday.
It's a lock, but we're still sending you
Slam
down.
dunk.
For more on today's record market action, let's go to Scott Gam on the floor of the New York Stock Exchange. Scott, if not for Boeing, would the Dow be there too?
No, Boeing was not in the top of the Dow leadership board today. Of course, we know Boeing has prevented the broader Dow from eclipsing its record high, which was back in mid to late July. But the best performing Dow stocks today were Microsoft, Goldman Sachs, and 3M, which wiped away all of that decline in 3M that we saw last week after the company reported earnings and had that pretty shocking guidance cut, which led to some stock declines there. But 3M rebounding today, and it also rebounded on Friday. But the real, bright spot in the market today was Apple, up a healthy 1% today, closing at a record high and also closing just a hair above $249 a share. We know Apple reports earnings on Wednesday, and today the company unveiling AirPods Pro, which will have a noise canceling feature, and that'll cost $249 as well. The laggards in today's session were McDonald's, Travelers, and Exxon. Travelers still has not been able to recover from the steep stock declines that it saw last week after reporting earnings. And then, Jen, outside of the Dow, we did want to make note of the surge in Fitbit shares. It ended up closing the session with a gain of more than 30% on reports that Alphabet's Google has made a takeover offer for Fitbit. Now, even with the big gain in Fitbit today, the stock is still trading below $6 a share. A couple of years ago when it went public, it was as high as $40 a share. And the market cap of Fitbit is about $1.5 billion, guys.
Scott Gamm, we'll talk with you tomorrow. So let's pick up right there where Scott left off.
Yep.
A little bit on, Google.
Yep.
And of course, Facebook as well. We've got earnings season in full force, but we are waiting for Alphabet right now after the bell. We're also waiting for Beyond Meat. So the Alphabet news today on Fitbit.
Yeah, I want to know if they announced it.
Will they talk about it?
I mean,
right?
it seemed like the kind of story where someone knows a person who says this is going to happen, and then it's going to happen today, so you can report it today, but only a few hours before it happens because it's already done.
Well, they're saying CNBC
like
confirmed. So CNBC is saying, we've confirmed this.
Yeah.
Right?
Yeah. So
That it's going through.
Yeah.
I mean, everyone has kind of said, like, well, what would Google
made
want?
an offer.
Okay, that's what.
What would Google want
Yeah.
Fitbit for? And they say the data, and it's like, okay, I mean, you're Google.
Yeah, and I was going to look at it as an acqui-hire, but like at this point, no. Right? It's curious to me.
It's a manufacturing hire. I mean, they do have,
Curious to me.
Google has been licensing out to Fossil and some other
Right.
watch brands. We've seen what Apple's been able to do with wearables.
Yeah, but you know what's so funny is because you always say, oh, this company, what's the plan? Oh, it could be acquired by Google. But then you always come back and say, oh, it's too small. Like they don't need it. I mean, it really is the case. It's hard to understand why they would spend any money on this, right?
I mean, I think what's notable is that Fitbit was a company I think everyone had kind of had questions about ever since they really went public about what their revenue streams were going to be. And when I think about a Fitbit, another company that I think about is GoPro, right? A lot of questions about whether or not the company really should have gone public with the possible, revenue streams that they could develop down the line. I think what we've seen from the recent fumbling with even the supply chain, getting their latest, Hero off the ground, which they've had supply issues. They said that, look, we have problems here. That's another company worth watching.
Yep. Still waiting for Alphabet, but Beyond Meat just out with its results for the third quarter. Let's go straight to Emily McCormick. She is in our newsroom with the numbers. Emily.
Well, strong results for the quarter from Beyond Meat, reporting its first ever quarterly profit in its several months as a public company. Here's what the numbers came out to. Net revenue of $92 million, topped expectations by about $10 million. That's up about 250% over last year. Net income was $4.1 million. That came out to adjusted pro forma EPS of 6 cents a share, topping expectations by 2 cents. This compares to a net loss of $9.3 million, or a loss of $1.45 per common share in the year ago period. Now, Beyond Meat also raised its full year sales guidance, now expecting net revenues in the range of $265 to $275 million. That's up from its prior expectations of guidance for $240 million, and now expects that adjusted EBITDA will be approximately $20 million for the year. We are seeing shares down a little bit in after hours trading. Very volatile stock, though. Shares were up about 300% for the year to date through today's close. Did pair some gains after being up as much as 850% in mid-July. So a very volatile stock, and we'll see where it goes from here.
Indeed, a very volatile name. Emily McCormick with Beyond Meat's Q3 results. We're watching shares off just about 5% right now. Trying to dive in here. I mean, as Emily pointed out, there's a lot that looks pretty good in here. Beyond has had good news, though, really in a couple times in the last few weeks, and sold off. This stock has not been one that seems primed to go higher on anything right now.
I mean, the stock was valued at like 100 something times revenue. Like, it was an insane valuation, and there still is a crazy valuation. It might be a great company, and it's a really interesting product, but and it's not rocket science. So think about the valuation here and look at the stock chart and say, oh, that was probably a little bit overheated.
Yeah, I mean, it's
I don't think Ethan Brown would have a problem with that either, right? He's focused on making Beyond Burgers.
He would be happy if it just got back to the fundamentals.
Yeah, it's nice that they're making money too. That's great. But you're right. I mean, $6.3 billion valuation at this point is, and $90 million of revenue in a quarter. And you can just do the math as you were doing, and it's amazing. I love the early backers of this company in venture. You got Kleiner Perkins, Bill Gates, Biz Stone, and Tyson. Makes sense. Another one, the Humane Society.
Yeah.
I love that.
Yeah.
Isn't that great? Very interesting.
What stands out to me in these results, you're seeing significantly faster revenue growth in the restaurant and food service side of their business. Year to date, up 390% sales are to third parties, basically, up 180% at the retail, so at the grocery store. And I think people have been very excited about what that wholesaler, that restaurant channel could mean for them. I am not as enthusiastic about that, only because those are the large suppliers that, while you get big orders from them, they will sometimes squeeze you on the price that you're getting for those orders rather than charging. I mean, this stuff is much more expensive than regular beef at the grocery store, but certainly a big opportunity on the restaurant side. We all see it more on menus. We see a lot more Beyond Burgers and Impossible Burgers and the like.
Yeah, and what's been interesting too is that the road to where Beyond has gotten to the crazy valuations here today was really paved by those constant announcements that they seem to have on deck at all times, that they were going to partner with this big fast food chain or that big fast food chain to launch a Beyond Meat product. Even this morning, there was one announcement with Denny's that they'd be offering the Denny's Beyond Burger and offering free Beyond Burgers on Halloween to celebrate. I mean, this is not just marketing, right? This is them trying to flex on Impossible Foods, which is not public yet, that they can get these deals before they can. Every single one of those partnerships is an addressable market that Impossible Foods might get barred out from. So I think that's really worth watching as we continue to try to talk about whether or not these valuations are appropriate.
And so from one tech company to another, Google's parent Alphabet is out with its third quarter results. Let's go to Emily McCormick in our newsroom with the latest. Emily.
Well, a disappointing quarter for Google. This coming just after those shares actually hit an all-time high during intraday trading today, so a double disappointment. If we look at third quarter revenue, excluding traffic acquisition costs, which is a cost of revenue, that came out to $33.01 billion versus $32.72 billion expected. Traffic acquisition costs, of course, being the amount that Google pays companies to run Google search as the default setting. If we look at the bottom line, that's really where things missed expectations. So those earnings per share were $10.12 versus $12.35 expected. And then operating income was just $9.18 billion versus $9.45 billion expected. Also a major mix on paid clicks on Google properties. That rose just 18% versus the 32% expected. A major deceleration too from a 28% increase over last quarter. We did see margins also get crimped. So that was just 23% versus 23.8% expected. So sort of a similar story with what we got with Amazon last week, seeing a little bit of narrowing of margins, and that really is impacting profitability and impacting that stock price right now.
Live in the newsroom with Alphabet's third quarter results. Andy made mention there, margins hurt. I mean, second major tech company in a row that we've seen have costs rise faster than revenues. Costs up roundabout low 20% and revenues up 20% last quarter.
Yeah, and I always wonder, we talk about them and Facebook in the same sentence, right? That they dominate digital advertising, right? You wonder, how much, when Facebook, look at what Facebook does and see, do they get any gains from this, right? In other words, this ship took a little bit of a hit. Is the other ship going to take a little bit of a hit too, or do they actually make some hay here? The other point I think that's worth making today is you're looking at, a 75-point swing here almost today. And, it's like they were up 2 and now they're down, 4? Well, now just 3.5. But a lot of people like to play here, and over the long run it's probably just fine, but I'm curious as to what these numbers actually mean, and it's always hard to say right off the bat.
Obviously, search and advertising is the big business here. I think it's always fun to look at other bets for Google as well, and Alphabet. Just looking at other bets for the 3 months ended in 2019, they're actually losing more than a year ago. So Google continues to spend on some of these expensive investments that they have out there. We all know there's a lot of people on the street that think, Waymo's going to be worth more than Uber, but this stuff costs money to continue to run.
Yeah, just quickly, Brian, sorry, but that, I talked about with Facebook, but talk about with Amazon. Amazon had a similar quarter maybe. Mm-hmm. What did they do? Big investment quarter. So maybe this is a big investment quarter.
Yeah, and I think what we've seen, Amazon was really the first company to set the tone, is that there is a breaking point, even with these giant companies that do have an immense amount of capital, for analysts saying, hey, I think the expenses here might be a little bit too much. I think that when we talk about the one-day shipping that Amazon was investing in and took a really big charge on for the last quarter, people were wondering, we know that's not going to be a one-time charge. This expense is something that you really have to continue to pour cash into. How long is that going to last? And I think that with Google, as we talk about the other headline that crossed today, which is them potentially buying Fitbit, you as an investor are not necessarily passing this off anymore as, well, they're Google. They have so much capital. They have so much cash to be able to handle this. It's really at this inflection point where, despite the fact they have 19% year-over-year increase in revenues, whether or not the bottom line is still being hurt too much by those expense saves.
Yeah, I mean, and look, I think the expense number actually looks a little bit better for the first 9 months of this year than it really is, because you are lapping a $5 billion charge last year on EU fines that this year to date, have only been $1.7 billion. So really, it's a $3.5 billion. The increase in expenses of $3.5 billion larger than that 9 months year-to-date number actually looks, and that's already up $12 billion. And so I think, again, we've heard a number of people use different analogies, but Facebook, Amazon, Google, these companies are spending money like industrial giants of yore, not light tech giants of today.
It's interesting. I mean, the point is this a secular change in margins? Mm-hmm. For various sort of reasons, though, right, you guys? Yeah. I mean, because Facebook, it's going to be people, right, to police the platform, right? And Amazon, to your point, Brian, is making a big bet in same day, right? And here, I'm not exactly sure what Google's charges are, but they just like to invest in everything.
Well, the other headline we had today, besides Fitbit, there was another report today out of CNBC that Google had a secret logistics meeting this week, and that they're interested in getting into logistics, and had FedEx there and JD.com and trying to figure out how the e-commerce logistics work, and maybe they want a piece of that as well.
It's the tyranny of being a platform company. I mean, it's the joy and the horror, which is to say you can get into anything. The market expects you to get into everything, right? Yeah. There's no barrier. We have so much scale and so much data.
And something I think that has enabled a lot of this thinking is really tax reform. I mean, think about the fact that Google's effective tax rate in 2018 was 24%. In this year, it was around 18%. So this has enabled a lot of the thinking that we can get away with more expenses because we have less money to pay to the government, right? But again, investors are not stupid, right? They see through those types of things, and at the end of the day, you can't just keep making acquisitions because you have this scale to do so. At some point, you're going to make so many acquisitions where people are saying, hey, I don't think this is right. Look at AT&T. Look at what's going on with them and fighting Elliott Management, right? So I think this is something that the tech companies are not immune from, despite the fact that what we've seen from the frothy IPOs is that there is still some exuberance, but I don't think the big companies can get away with it.
You got to have a flywheel sort of thing to be a story to tell, right? At the very least. And if you don't, I mean, Amazon does, and still people weren't buying it completely, although that's just people being a little impatient. But if you're just spending, or in Facebook's case, which I really think could be a secular change, that's not a flywheel. That's just more cost.
Well, right now, with both financial results that we've had after the bell, Beyond and Alphabet, we are seeing shares lower here. You can see Alphabet's off just about 2.5%. Coming up, we're going to break down Gen Z's app usage, what apps they like and use, and what they don't. Right now, let's take a look at where the social media names traded today. analytics company App Annie is releasing its new report on how to win Gen Z tomorrow. And this report shares insight on how to understand Gen Z, how they are consuming content, as well as ways for companies to best engage with this growing population. And joining us now is the CEO of App Annie, Ted Krantz. So Ted, we want to know how to make money off of Gen Z, what companies to invest in. When I read through the report, frankly, there were some things that I was surprised about. There's some apps that I don't even know about. From what you guys found, what do you think is the most important thing to know about Gen Z as an investor?
Right. Well, first of all, thank you for having me on the show. It's my pleasure to talk about how we help companies win on mobile. Gen Z could be a revolutionary point in terms of where we sit with mobile. It's really still in the first phase. It's been evolutionary up to this point. When you think about Gen Z and their behavior, there are just some distinct patterns that we haven't seen before. One is they tend to be in fewer apps, but immersed in those apps longer. That's one big thing that we pick up on. The other one that we see is they're really blurring the lines in terms of how we think about using apps. The apps are getting elongated in terms of the engagement opportunities. So one as an example is Twitch. Twitch started on esports. It moved into live streaming. Then there's a chat and a social component. So what we see in the data is during any given month, the typical user is in that app for 5.5 hours.
Owned by Amazon.
Owned by Amazon.
By the way,
that's for
if
sure.
you're interested in
there you go.
interested in the Twitch trade.
Yeah.
Ted, something that stood out to me looking at U.S. Gen Z users,
Yes.
the social app they're most likely to use is Snapchat. That's something that I think the street has sniffed out certainly so far this year. You look at that stock. What was not present in the top 10 for the U.S. was Messenger or Facebook. I mean, Instagram was in there.
Yeah.
But we didn't have WhatsApp and we didn't have any of the other Facebook properties. And so it does seem like younger consumers don't look at the Facebook world the way that some older folks might.
I think that's a fair statement, Miles. You know, when you look at social across the globe, certainly Snap is back cool, in vogue. They've got new filters, and there's a fear of missing out element of being engaged on Snap that's huge. But then we look at opportunities like with TikTok, that's just crazy, right? And it's a complete disconnect from where we've been with Instagram in the past. Picture perfect, you got celebrities influencing. Here you're authentic, you're staying true to yourself, and you and your friends are actually carrying influence. So some of these things that we're seeing in terms of where the market's going. But yes, there is a pretty big disconnect, almost a fragmentation from baby boomers, Gen X to Gen Z on these social platforms.
All right, so you just talked a little bit about what would be appealing to a Gen Zer. To make an app that would appeal to them, I should say.
Yes.
But what's the barrier? In other words, what's to stop someone from just coming up with another one next week?
Yeah.
I mean, and it's some of these are pretty new. Some of them have been around for a while.
Yeah.
But it seems like that would be a problem conceivably.
I think it's going to be harder to crack when you think about the fact that you're really trying to fill a lifestyle and an experience void. Mm-hmm. So some of these bigger players that can have more dimensions to their app and a longer engagement arena to play in, like Uber, right? Started Black Car, then it's, pick up a ride with your friends, and now it's like grab dinner on the way home.
So Ted, now it's interesting because I think Instagram and Snapchat and those big players are really kind of still figuring out, even with their scale, what the right way to monetize these kinds of impressions are. So what was interesting was that your research in terms of the shopping apps actually yielded none of those apps. It was Wish that I think was number one, which was news to Miles and I, who we were only familiar with it because it's on the jersey of the Los Angeles Lakers. But tell us a little bit about Wish, but then also broadly about what are the ways that app developers can successfully monetize these Gen Z trends.
Yeah, so for us, in terms of the report as well, it's important to keep in mind these other things are monetizing. These are just indexing more as a result of this demographic. So Wish is kind of a budget-constrained option for Gen Z to bring buyers and sellers together, like an eBay or Amazon experience for low-end items, and it's doing really well. Now, I think overall, there's still certainly, the big players in terms of commerce, but when it comes to monetizing Gen Z, what we're starting to see for the first time, this company, App Annie, was built on monetizing through the App Store. Downloads, revenue, MAU down, now we've got first-party analytics. But what we're seeing is this opportunity to monetize on the advertising side of the equation. So we made a big acquisition with a company called Libring that helps get us there and start driving some of those opportunities as well. And when you talk to big gaming companies, that's where they're focused. That arena looks to be 2 to 3 times larger over the midterm than the App Store side of the equation.
And just in general, do you think there's a bigger gap between Gen Z behavior and millennial behavior than there was between millennials and maybe Gen X or their parents? Because I'm starting to get the sense that the generation coming up behind me is much more different than I probably was to the generation I came up behind.
For sure, and even my opening statement, evolutionary versus revolutionary, it is the first time. The patterns between baby boomers and Gen X are much tighter. This range feels a little bit deeper, and it's pushing the envelope on how you think about apps.
Ted Krantz is the CEO of App Annie. Great research. Thanks so much.
Thank you so much for having me. My pleasure.
Coming up here on the final round, the latest on those big after-hours earnings reports. Plus, we'll have what we're watching tomorrow in the look ahead. We are back right after this.
And now here's Miles with a look ahead at what will be making headlines on Tuesday.
Well, you can either look at the data or you can just kind of tell. Everyone seems to hate this stock market rally. Now, stocks hit a record high on Monday, but money this year has been moving out of the market at the second fastest rate since 2004, while money is pouring in to both cash and bonds to the tune of more than $400 and $350 billion, respectively. That's the data. Now, earlier today, Donald Trump bragged about the stock market, as he is inclined to often do. The S&P just hit an all-time high, Trump tweeted. This is a big win for jobs, 401ks, and frankly, everyone. Our country is doing great. The snarky reply to this, of course, is that an all-time high calls for another rate cut from the Fed, which we are likely to get on Wednesday. But that so many following markets still rush to slam this rally also explains what continues to keep it going. Now, turning to the calendar for Tuesday on the earnings side, more than 40 members of the S&P will report their results. Before the open, we'll have Merck, Xerox, GM, and MasterCard among the notable companies. And then after the bell, Mondelez, AMD, Electronic Arts, and Amgen will report their results. On the economic data side, the Conference Board will release its latest read on consumer confidence in October. Pending home sales for September are also due out, as well as the latest Case-Shiller home price data. And don't forget, the Fed's two-day policy meeting kicks off in the afternoon. Their rate decision will come out Wednesday. Brian Chung will be there.
I can't wait.
You getting the nonstop Excella again?
No, they don't run it.
When do they run that? It's only in the morning, right?
It's only really early in the morning, and then there's
should have the Fed special.
So you've got to take the regular Excella tomorrow afternoon.
Regular, so it's unbelievable.
Slumming it. There really should be a Fed special. Coming up, more on the final round. Plus, we're going to recap the big earnings reports. We're going to be back right after this.
correspondent around here on Yahoo Finance. Miles London with you in New York. Full house today. I'm joined by, of course, Jen Rogers, Yahoo Finance editor-in-chief Andy Serwer, and Chief Fed correspondent Brian Chung. We're still at the desk, everybody. Feels like a very eventful after-hours session. Of course, before the bell, or at the bell, we had stocks hitting a record high. The S&P, that's a record 3039 for the benchmark index. The NASDAQ closing just about 4.5 points below a record. We'll watch the tech stocks tomorrow. The Dow, the laggard, 27,090. The record close for the Dow back on July 8th was 27,359. So we're about 100 or 250, 260 points away there. We'll see, if we can get any momentum going. Maybe Boeing says something nice tomorrow. I don't know.
You think he's going to say something nice?
I jest.
Right.
I jest. All right, let's go back to Emily McCormick in our newsroom for a recap of some of those after-hours earnings. Alphabet and Beyond Meat, both stocks lower. Emily, what do you got?
Well, Alphabet shares are actually paring some losses after being off by as much as about 3% in late trading, now off just about 1% as investors are digesting these mixed results. So that was a beat on the top line. Third quarter revenue, excluding traffic acquisition cost, that was just over $33 billion versus $32.7 billion expected. And then earnings per share were $10.12, so short of those $12.35 expected. Another miss on paid clicks on Google properties. That was up just 18% year over year versus the 32% increase expected. And then margins shrinking to 23% versus 25% last year and 23.8% expected. So quite a few more capital expenditures made. That was up 26% year over year. Headcount actually increased from 94,000 last year to 114,000. So just bringing on a lot more employees, of course, increasing cost on that front as well. And the last thing I want to point out for Google is that its other revenue, that includes things like hardware, like the Pixel phones and cloud products, that actually grew year over year. So that came in at $6.43 billion. That was up from $6.18 billion in the year ago period. Could be why we're seeing some of these losses actually getting paired, since that was one of those more closely watched segments that analysts were looking at. Again, Google Cloud is a smaller portion of revenue than advertising, but something that analysts are saying will be potentially the future of the company. Turning over to Beyond Meat, that was a classic beat and raise, although we are seeing shares lower in after-hours trading. Net revenue grew 250% year over year to $92 million, and the company turned its first quarterly profit as a public company. That IPO, of course, coming back in May. So net income was $4.1 million, and then adjusted EPS were 6 cents versus 4 cents per share expected. One of the reasons that we could be seeing these shares trading lower is because we do have that post-IPO lockup ending tomorrow, which means that about 80% of those shares outstanding will be available for trading by insiders and some of these early investors. Whether they'll actually go ahead and cash out on some of these gains remains to be seen, but investors might be expecting some more volatility during tomorrow's session. Miles?
All right, party time at Beyond Meat tomorrow. Emily McCormick live in our newsroom with the latest. All right, let's turn now to our top take stories we're watching today in this market. A story we have not talked about yet on the program, AT&T. That stock was higher on the session, the company announcing a 3-year plan earlier today to meet demands from activist shareholder Elliott Management. The stock actually giving up, or in after hours, up just a little bit. 38.50 was the close here. Now, what stood out to me about this agreement, they're going to add a couple guys to the board. They're going to buy back some stock. Remember, Andy, $60 a share is what Elliott thought AT&T was worth. And so AT&T is like, maybe the stock will go up 50% in 3 years, and these guys will just leave us alone, instead of demanding that we spin off one of these major acquisitions we spent so much time putting together.
I mean, I'm surprised by these developments because I feel like Randall Stephenson and AT&T, they're getting off easy here, it seems like. In other words, usually, Elliott, Paul Singer's like the consummate pit bull who never lets go. You got a long way to go between 38 and 60 till you get to Christmas time for him. And, $10 billion of costs, that's not what it's going to take probably to get there. And a Direct and Warner Communications not really addressed here. And those are the two big elephants in the room, right?
Both reporting this morning, subscribers continue to leave those services, yeah.
Right. And so I feel like, and this often happens if you look at their playbook, Elliott, that is, you think they're done and they come back, right? So stay tuned.
This can't possibly be done.
I agree
It feels
with that.
a
I agree
little
with
bit
that.
to me, to take it to a recent story, is the trade war. And with President Trump saying that the Chinese are going to be buying 40 to 50 billion in agricultural goods, and maybe phase one they're going to say like, yeah, we're going to do it based on demand. And then, like, how are they going to get to 60? How are they going to get
This is the
these
phase
cost
one
cuts?
side.
Yeah, I feel like
Ask
this is
Argentina,
exactly.
right?
This is phase
trade deal.
one of the Elliott AT&T
Right.
deal, and there's no enforcement. And where does it go from here? It's definitely going to come back and rear its ugly head.
I mean, one thing I have to kind of point out, though, is that, yes, the DirecTV is a real breaking point between Elliott and AT&T. I mean, why would you divest this enormous business that you spend so much money to dive into? But I think both sides could agree that AT&T's huge amount of corporate debt is definitely an issue. But Elliott's solution was, hey, you guys have to figure out how to sell DirecTV so that you could pay down some of this debt. But at the same time, we want you to increase your dividends and buybacks. I mean, you can't have your cake and eat it, too. So I think it was always kind of a tough battle for AT&T to fight back. I'm not saying I side with AT&T. Their corporate debt load and the DirecTV acquisition were questionable to begin with. But I think that as management is trying to reason through these debates, they do have to understand that that's a real issue. I'm just not sure if Elliott management's serum for fixing this was really the right.
Well, I think too, Andy's point, and we joke, but it's serious. I mean, this is only the beginning, just in the sense that what really stood out to me, and I remember talking about this at length with you, Jen, when they first put out their presentation, how many leadership folks from the old Warner Media and the HBO leadership had left. There was no one, John Stankey's the only guy left out of the whole thing. And so there does need to be some time to figure out who's going to run some of these assets. I'm sure Jeff Zucker is sitting there saying, I'd like a bigger job, maybe. But someone needs to have a couple quarters to settle down, because everyone you acquired, all the acqui-hires, they all left. They're all gone. So now you got to figure out what you got.
It's not obvious what to do here, and it's the timeless, like media and distribution. And, boy, I've seen that my entire life covering Wall Street.
We live it.
Goes back and forth,
yeah.
Right?
52-week high for AT&T today. A new study is out suggesting that racial, ethnic, gender, and cultural diversity can lead a film to profit from minority groups feeling representation from the movie. Research from Movio found large correlating numbers between a film's lead characters and its in-theater audience. And with us now is Movio's Chief Commercial Officer, Craig Jones.
It's great to be here. Thank you.
So we read your report, and what you did is you took different movies and you kind of paired them together. So you have Us and then A Quiet Place, or Coco and Incredibles 2. When you delved into the data at that level, what were you able to find?
Yeah, look, I think there's been an increase in focus on diversity and inclusion in Hollywood over the last few years, but very little understanding about how that actually relates to moviegoers. And so what Movio was able to do was take these pairings of movies, as you said, and look at the demographic, behavioural and transactional profile of movies that we would consider similar in terms of both genre and box office, and draw some correlations between the audiences of underrepresented leads and co-leads compared to those that did not have those in there. And the results were quite staggering. We were able to identify that there is a strong relationship between when a minority group is represented on the big screen and that group's attendance at the box office, with some of those groups attending at more than twice their usual rate, which is a staggering number in itself.
Well, and I think this research made me think about the conversation around moviegoing these days is sort of, well, all it is superhero movies, and that might be true, but what it ultimately does is it says there are fewer other movies that people will go see. So if everyone's going to spend $50 a year at the movies and it costs $30 to see all the superhero movies, you only got $20 left. But you think about the success of Black Panther, for example. I mean, audiences were seeing that movie who never see any of the superhero movies. So it was kind of a 2-for-1. You got the extra wallet share, as it were, and also got them into a blockbuster kind of experience.
Well, that's a fantastic point, and you're exactly right, is that while we were able to show that diverse content was able to draw out more diverse audiences, Black Panther is a fantastic example that wasn't able to just driving a greater percentage of Black and African American moviegoers, but also a significant number of moviegoers that were occasional or frequent, those that are only attending the movie theatre 1 or 2 times a year, and also the number of first-time moviegoers was significant for Black Panther as well, which might explain why it was able to defeat Infinity War at the box office.
But was that an aberration? I mean, Barry Jenkins, what a great director, right? I mean, Moonlight, If Beale Street Could Talk. I love those films, and they were award-winning films, but they were smaller films, certainly than Black Panther. I mean, is there a trend that we can look to?
Yeah, I think that you could probably assume that America's increasingly diverse population, and by extension, its increasingly diverse movie-going population, is more likely to turn up to the theatre if they see themselves represented in the stories and the characters that are portrayed on the big screen. And so I think this presents an interesting opportunity not only for the big studios, the likes of the Disneys and the Universals and the like, but also for those small to medium-sized studios to know that they can go out there and produce quality, diverse content, that there is going to be an audience out there for it. And if they can connect to that audience through effective marketing, they can drive meaningful box office results. And I think that that's really important when I think about the future success of this industry.
But at that point, how difficult is it for some of these smaller studios that don't have the name of a Disney or a Marvel, which are actually really just the same thing, get those impressions? Because, I mean, as an Asian American, I went out this weekend and I saw Parasite, which was
how was that? Did you like it?
Korean-made film. It was unbelievable. But I was sitting there in the audience looking at everyone else who, they were all also Asian Americans supporting the film. And I'm wondering, there's no way that the 10 or 11% of the Asian population in the United States would be able to financially support more films like this coming out. So, I mean, how do you kind of square those two things without the big superstar name that Black Panther was able to benefit off of?
Look, I think one of the biggest challenges that Hollywood faces is that traditionally they've never had access to movie-going data. And so I've had to rely a lot on gut and intuition, as well as broad demographic and behavioural-based assumptions when it comes to informing all aspects of the film's life cycle, from production and distribution and marketing. But I think one of the things that's really interesting is that while diverse content does draw more diverse moviegoers, as Parasite undeniably will, it also will draw in plenty of other moviegoers as well, which means that if we were to just pigeonhole Parasite as only being potentially an Asian American movie-going target, then we're leaving money on the table. So I think the most important thing that the industry needs to appreciate is that someone's tastes and preferences is influenced by their past movie-going behaviour, not by putting everyone into just broad demographic groups and targeting by that way. And I think if Hollywood could embrace the behaviour of moviegoers and celebrate the unique tastes and preferences of Americans moviegoers, then we'll certainly see a lot more successful films in that small to mid-sized bucket.
Movio's commercial officer, Craig Jones.
Thank you for having me.
I feel a lot more hopeful about movies now.
Yeah,
usually everything's so negative in Marvel, right?
No, go see Parasite.
And I'm glad you. I read about it. It sounds really cool.
It's
right.
mind-blowing.
Yeah.
Grubhub shares getting slammed here after hours. The company announcing earnings a day earlier than expected. They missed on earnings and revenue for Q3, but there are a few really bad headlines in here. Q4 revenue guidance of $315 million to $335 million is well shy of what the street was expecting. They thought a number was going to look like $387 million. EBITDA seen at $15 million to $25 million versus estimates of $79 million. Q3 EBITDA was also down 10% year over year, missing estimates. The stock right now off 20%. I know as New Yorkers, we all do our absolute best to just really pad the bottom line at this. I can't order anymore. That's it. That's all I've got. Yeah. But with all the third-party deliveries coming in here, we know the competitive landscape is incredibly difficult right now in terms of the promotions that we're seeing. And look, this is uncharted territory for Grubhub to be going up against everybody here.
I can't imagine if I'm an executive at Grubhub, I'm not sitting here saying, boy, it's going to be a tough couple quarters. Maybe more than that, because you know that you're well-capitalized competition that is not quite incentivized the same way you are to actually turn profits and return money to shareholders. They're coming after you.
What is this business? Delivery.
It's food delivery, right? Yeah.
Okay.
Yep.
Just checking.
Well, another thing too,
it's not a revolutionary. I know you're using data, et cetera, and that's all revolutionary. But at the core, it's pretty.
The revolution they're facing is DoorDash saying we'll lose money on every order.
And Uber.
Same with Uber Eats.
Caviar and
this doesn't even include the regulatory aspect of things, right? I mean, when you talk about the long-term challenges that these companies face, state, legal, even city-level regulation.
Everything.
There's going to be some action consolidating.
A reckoning?
Some companies.
A reckoning.
You can. I'm pretty.
Consumer subsidies are about to come to an end.
Something's gonna happen eventually. Andy Serwer and Brian Chung, have a great evening. You leave tomorrow?
Yep. I'll see you from DC.
Remember, Jen, when I used to go to the Fed and I used to do the
Oh
final
my
round,
gosh.
and then I would
You're
go
gonna air
down?
me out to dry here.
Even before there was the nonstop Pasella.
We only noticed because he does Tuesdays on the final round, and yet every 6th Tuesday he's not here.
I can move up to Monday, or I'll
here
talk
we
to
are.
Press. I'll
We're
talk to
on a
Press,
Monday.
Do you know what train he's taking? It's the stop Pasella.
It's the regular stop.
Not the nonstop. It's the stop.
You guys are like tracking the train number now.
Oh, yeah.
Think about how brutal that's
It's
going
like
to
a
be.
tail number
4
for you.
stops
These
between
guys.
here and DC. Oh,
In
terrible.
Wilmington, too.
Oh my God, of all places.
Yeah.
All right, coming up here, we'll have what you missed on a busy day on Yahoo Finance. We're back with that right after this. It's time now for all the best moments that you missed today right here on Yahoo Finance.
For the market, they just want a viable truce, not one that ends, in 2 days or next week. And that would be helpful for the market.
We're getting off already to a great start this week with earnings. AT&T reported this morning. The stock is up over 3%. That's a combination of both their earnings, their guidance going forward, and a settlement they have with their activist investor. And it's just setting the table for a blockbuster week of high-profile earnings reports.
Only 500 people have ever been to space, and that's including the Chinese, the Americans, the Russians. And we have the capability of putting hundreds of thousands of people into space in the years to come. And that's ridiculously exciting.
The markets and business could easily live with Joe Biden. I think his policies would be moderate liberal, not radical liberal. I think he would be more inclined to get a trade deal. So I think they would be a little bit more inclined to accept him.
Now you have these AirPods and also other services such as Apple Arcade, Apple TV Plus. Apple is diversifying more and more with its products and services, and we think it's going to be a good, healthy Christmas holiday season for Apple.
I think, companies that are not well capitalized have put plans on hold. Genco has a very strong balance sheet. We have a lot of cash, low debt levels. So we've been able to continuously look at new projects, different types of projects. The good news is that because of the lack of capital, the uncertainty, people are not building ships, they're not ordering ships.
Consumer sentiment has been very strong, but interestingly, sentiment hasn't been that positive around stocks. Certainly we're seeing stocks moving up, but we've seen really significant amount of flows out of equities this year, which suggests a real mismatch between what's going on and what people are thinking, and many may be missing out on what could be a very nice year of capital appreciation.
Coming up, Watch Time New York, America's largest watch show, popping off with glitz and luxury watches and uber expensive prices. We talk to watch fan and Seiko brand ambassador Fabien Cousteau after this.
Largest luxury watch show in America, Watch Time New York, kicked off over the weekend here in New York. We caught up with Seiko brand ambassador and Jacques Cousteau's grandson, Fabien Cousteau, about the importance of watches in extreme endeavors like ocean exploration and his commitment to conservation.
I'm here at Watch Time New York, the largest East Coast watch event here in New York City, and I'm with Fabien Cousteau, ambassador and also ocean conservationist. So Fabien, tell me, you're with Seiko Prospex. How did that relationship come about?
Oh, being a global brand ambassador for Seiko Prospex has been a dream of mine for a long time. How did that come about? Well, quite simply, my team and I went to Seiko originally to pitch them an idea of coming on board and sponsoring a project I had, and that conversation developed. We found kinship and synergies, and then, finally they offered me an ambassadorship for the Seiko brand, which I am hugely honored to have.
So you've been sort of a fan of the brand, is that right?
Oh, I've been a fan of the brand since I was a kid. I'm a geek of technology, but I've always loved having a watch on my wrist, regardless of what kind of watch, what mechanicals or electronics were in it. It's always been a security for me. When all else fails, the watch typically doesn't fail, especially a Seiko. So that's always been part of my life. And the fact that the Seiko brand has a number of various iterations of mechanicals and pseudo-mechanicals, hybrids, like the spring drive, one of my favorites, is just, to me, a dream come true.
So Seiko, obviously a big name with Prospex, the diving scene, the ocean exploration scene. What is the watch you're currently working on with them?
Yeah, so Prospex has always been an integral part of diving, scuba diving. And the reason why that is, for those who are not scuba divers, is in the old days, before computers, you used to dive with a watch and a pressure gauge, and you'd be able to time your dives so that you can avoid decompression obligations. Well, obviously now we have computers, but inevitably, you're going in an extreme environment, a salty environment, and electronics have a tendency to fail at the worst possible time. So you always have a backup, or at least that's the way I think, and that's why I always take a Seiko down to go diving.
A mechanical watch, not a digital or quartz watch.
To each their own flavor. I personally like mechanicals. I love the spring drive just because it brings the world of mechanical in with the world of quartz, or at least quartz precision. And so you have the best of both worlds. You have something that generates its own power in the mechanical portion of things, and you have the accuracy of quartz. So it's my favorite movement. I really love the high bead. I really love all those, so I certainly wouldn't say no to any of those either. Some people like quartz, and that's okay too. And one of the wonderful things about this particular brand is you have a choice for virtually any flavor that you might like.
You know, I'm a big Diver Watch fan too, so I get the appeal. So lastly, tell me about the Ocean Learning Center, something that I believe Seiko is working with you on. Is that correct? It's one of your projects.
Yeah, so the Ocean Learning Center is a platform that I created in 2016 because as an ocean explorer, I've been diving since I was 4 and going on expeditions since I was 7.
With your grandfather?
With my grandfather and then with my father, and it's a family endeavor. And we've seen a lot of things in our lives. We now read and watch a lot of things online, usually not very good news. So the frustration by people such as myself who go out in the field and people in general who are worried about what's going on the planet is, what can I do? And so the Ocean Learning Center is really a culmination of the education of what we've learned and the proactive movement of going out and doing aquatic restoration activities, such as planting mangroves, releasing baby sea turtles, all this through the guise of edutational movements.
Sounds like a great cause, and Seiko getting behind that, it's a wonderful thing, a big brand. Fabian, thank you so much for joining us.
We're very much a pleasure. We're really happy that Seiko is behind not only myself, but the OLC, especially with the Sea Turtle Restoration Project in Nicaragua. We can't be thankful enough.
Great, so hope you have a great show here, okay? Thank you.
Thank you very much.
That's going to do it for us here in New York after hitting record highs on the S&P 500. Nice job. But then selling off on Google and beyond. So who knows what's going to happen tomorrow? That's it for the final round on Yahoo Finance.